So let's start with the first case scenario. The first case scenario talks about section 44AD, 44AB, and so on and so forth. Okay. Now there are four brothers over here, four brothers in fact, Mr. Arvind and his three brothers Arjun, Anand, Akash. Now three brothers do business and one of the brother is doing some notified profession mentioned under 44 ADA. So according to that, we need to answer this particular question. Which of the following individuals are eligible to declare income on presumptive basis under the provision of the Income Tax Act 1961? So we need to answer which of the persons are eligible for presumptive income. Let's see. First of all, Arvind is doing business. If you check over here, Arvind is engaged in business. And if Arvind's turnover is up to 2 crore rupees, then he is definitely eligible for what? He is eligible for what? Presumptive income. So Arvind can go for presumptive income. Now, can Arjun also go for presumptive income? See, Arjun's turnover is 2.8 crore. Now, for presumptive income under 44 AD, if your turnover is more than 2 crore, but up to 3 crore, then also you can go for presumptive income. But in that case, you have one condition to fulfill, that your cash receipt should be up to 5% of total receipt. So if Arjun's cash receipt is up to 5% of total receipt, then even Arjun can go for what? Presumptive income. Now let's see what is Arjun's cash receipts. Arjun's cash receipt is 8 lakh rupees and Arjun's total turnover is 2.8 crore. So 8 lakh divided by 2.8 crore is up to 5% of total turnover. So it comes within the percentage of 5%. It comes below 5%. Therefore, even Arjun can go for what? Arjun can go for what? Presumptive income. Now let's come to the third one. Anand. Can Anand go for presumptive income? Now Anand cannot go for presumptive income because Anand is doing business and his turnover is 5 crore rupees. Anybody who has a turnover of more than 3 crore rupees, it is impossible to go for what? To go for presumptive income. I hope it is clear to all of you. Okay. Now let's go with Akash. Can Akash go for presumptive income? What does Akash do? Akash is engaged in some interior decoration. You can check over here. Akash is engaged in interior decoration and interior decoration comes under 44 AD presumptive income. Now Akash gross receipt is 52 lakhs. Now can a person with a 52 lakh rupees gross receipt can go for presumptive income under 44 ADA? By default, the limit under 44 ADA is 50 lakhs. If your gross receipt is up to 50 lakhs, you can go for presumptive income. But there has been an amendment in last 1 or 2 years that even if your gross receipt is up to 75 lakhs, above 50 lakhs, but up to 75 lakhs, then also you can go. But in that case, you have to fulfill one condition. Your cash receipt should be up to 5% of total receipt. So in this case also, if your cash receipt is up to 5% of total receipt, then also your benefit of 44 ADA will be up to 75 lakhs. Now let's see what is the cash receipt over here. The cash receipt is 2 lakh rupees. What is the total receipt? It is 52 lakhs. Therefore, the answer is 3.85 lakhs. And therefore, Akash limit is also within 5%. Therefore, Akash can also enjoy 44 ADA with a turnover of what? With a gross receipt of 52 lakhs. Therefore, three people can enjoy. Arvind can enjoy, Arjun can enjoy, Akash can enjoy, but Anand cannot enjoy the benefit of presumptive income. I hope it is clear to all of you. Now, question number 2. Which of the following individuals have to mandatorily get the books of accounts audited under 44 AB for AY 24, 25, 26. So we need to answer now who has to get their books of accounts audited under 44 AB. Now, let me tell you one by one. Arvind is following presumptive income. So obviously Arvind will not get the books of accounts audited under 44 AB. Obviously na, because if you are going for what? Presumptive income, then you will not do the audit. Arjun is also following presumptive income. He will also not do what? He will also not go for what? He will also not go for what? Audit. Now Akash is also going for presumptive income. He will also not go for audit. Obviously these three people are obviously not possible to go for audit because these people are following presumptive income. Let's talk about Anand. What does Anand has to say? Anand's turnover is 5 crore rupees. Can Anand follow presumptive income? Anand cannot follow presumptive income. Now, should Anand go for tax audit? Now that depends upon. Generally, the limit of tax audit is if your turnover is more than 1 crore rupees. If your turnover is more than 1 crore, you have to do tax audit. But, for some people, the turnover is 10 crore rupees. For some people, even if the turnover is up to 10 crore rupees, they need not have to do tax audit. Who are those lucky people? If your cash receipt is up to 5% of total receipts and if your cash payment is also up to 5% of total payment. Now let's see what is the cash receipt of Anand. The cash receipt of Anand is 27 lakh and the total receipt of Anand is 5.5 crore. If you divide this, it comes to less than 5%. You can check it over here. If you divide this, it comes to what? It comes to less than 5%, it comes to 4.91%. So this condition is fulfilled. Now let's talk about one more condition we have to fulfill. You have to fulfill the condition of payment also. The cash payment is 22 lakhs and the total payment is 4.5 lakhs. So 22 lakhs divided by 4.5 lakhs. This also comes below 5%. Check. Therefore, Anand is fulfilling the condition of cash receipt and cash payment both. And therefore, Anand turnover for tax audit is 10 crore rupees. Up to 10 crore, he need not have to do tax audit. Therefore, Anand will also not do tax audit because his turnover is only 5 crore rupees. Therefore, the answer to this question is none of them. Okay. I hope it is clear to all of you. Now, question number 3. What is the amount of profits and gains of business chargeable to tax in the hands of Arvind, Arjun and Anand, assuming they wish to make maximum tax saving? All of them want to make maximum tax saving, but with the condition that they don't want to get their books of accounts audited. They don't want to get into audit and all. Okay. It means all of them would like to follow presumptive income if available. If presumptive income is not available, they will follow the normal provision. So for Anand, for Arvind, let's talk about Arvind now. Arvind, what is the turnover of Arvind? Arvind's turnover is 95 lakhs. But out of that, 85 lakhs is received by NEFT and RTGS. Therefore, for Arvind, 85 lakhs is received by NEFT and RTGS. And remaining 10 lakh is received by what? Is received by it is received by what? It is received by cash. Obviously, it is received by cash. Therefore, for Arvind, what we are going to do? For Arvind, if we compute the provision now, if we compute the provision that 85 lakhs, how much? 6%, and 10 lakhs, how much? 8%. It will be more than the profits given under the normal provision. Okay. Now, therefore, it is better for Arvind. We should go for what? We should go for the normal provision. Okay. We should go for the normal provision. So, will he not be liable for audit? Why will he be liable for audit? He is below the turnover limit. His turnover is not crossing the limit of audit. He will simply say that I don't want to follow 44AD. I just want to follow the normal provision, and there is no need to do any audit. Why? Because his turnover is not crossing the limit mentioned under 44AB. I hope it is clear to all of you. Because if you go for 44AD now, 44AD, then your income will be more than 5.9 lakhs. You can check 85 lakhs into 6%, 10 lakhs into 8%. It will be more than 5.9 lakhs. I hope it is clear to all of you. Now let's talk about the second person. Who is the second person? The second person is Arjun. In case of Arjun, what is going to happen? In case of Arjun, if I go for presumptive income, Arjun's online receipt is 265 lakhs. That is, you can see over here. And the other receipts total turnover is 280 lakhs. So 15 lakhs is 8% because it is received by other than online receipt, and 265 lakh 6%, total comes to 17.1 lakh. So if Arjun wants to save his maximum tax without getting his books of accounts audit, he has to show 17.1 lakh. So if he wants to show lower profit like 15.5 lakhs, then he has to do audit because his turnover is more than 1 crore rupees. He has to do audit. So because he don't want to do audit, he has to follow the presumptive income and he has to show the income as 17.1 lakh. So for Arvind, it is 5.9 lakh. For Arjun, it is 17.10 lakhs. Okay. Now let's talk about Anand. Anand, it is very simple. For Anand, there are no two options. Presumptive income is not applicable only for Anand. So for Anand, you have to show the income as 30 lakh rupees. So in case of Anand, the income will be 30 lakhs directly because presumptive income is not applicable for him. I hope it is clear to all of you. Now, question number 4. Would your answer to MCQ 3 change? That is the profits and gains of business chargeable to tax in the hands of Arvind, Arjun and Anand undergo a change if they decide to get their books of accounts audited. Now we need to see if they do audit, will their answer change? Let's talk about one by one. For Arvind, the provision as per normal provision is 5.9 lakhs and the provision as per 44AD, it is coming more, it is 17.1 lakh. Okay. And for Arvind, there is no concept of audit only. Okay. For Arvind, nothing will change. For Arvind, normal is more beneficial. Therefore, for Arvind, nothing will change. Yes. For second person, Anand, for Arjun. For Arjun, presumptive income is showing 17.1 lakh, as you can see over here. But if he do audit, he can show lower profit, 15.5 lakhs. It is better that he should go for audit. Yes or no? Therefore, for Arjun, audit is better. Okay. For Arjun, audit is better. For Arjun, audit is better. And last person, for Anand. For Anand, the audit is not applicable only because for Anand, the audit limit is 10 crore rupees. Therefore, the answer to MCQ 3 will change only for one person. Who is that one person? That is the middle one, that is Arjun. Because in case of Arjun, the audit, if he does an audit, then he will show the profit of 15.5 lakhs. Without audit, he is showing a profit of 17.7 lakhs. Therefore, doing audit is beneficial for him. Okay. Therefore, only Arjun's answer will change and Arvind and Anand's answer will not undergo change. Okay. And last but not least, what is the due date of filing of return of Mr. Arvind, Arjun, Anand and Akash? Now, see, if they wish to make maximum tax saving, what? If they wish to make what? Maximum tax saving, what is the due date of filing of return for them? Now, listen carefully. Generally, there are due dates of filing of return. One is 31st July, one is 31st October. 31st October is for those people who do audit. So all those who are eligible for audit will go for 31st October. Now we all know that Arvind will go for normal provision because normal is beneficial. So for Arvind, 31st July will be the date. Arjun will go for audit because if he goes for audit, then his maximum tax will be saved. Correct? Why? Because in that case, his profit will be 15.9 lakhs. Okay. Otherwise, it is 17.1 lakhs. So for Arjun, the due date, because he is going to go for audit, because audit will save more tax. Therefore, he will file the return in October. Anand, he will follow the normal provision. Even Akash will follow the normal provision. Therefore, Arjun will file the return in October. You can see over here. And Arvind, Akash and Anand will file the return in what? In July. I hope it is clear to all of you. Okay. Is this clear? This is what this first question is all about. You can go through the solution. Then we'll go ahead with the second question. Now let's start with the next case scenario. Case scenario number 2. This is also on presumptive income only, 44AD, 44ADA, 44AE. Let's talk about the first question over here. Which of the four entities are eligible to declare income on presumptive basis under the Income Tax Act 1961? Let's see who all are eligible for presumptive basis. First of all, AB company is a firm and the turnover is up to 2 crore rupees. It is doing business. Therefore, it is eligible for 44AD. Second, LM company is engaged in leasing and hiring goods carriage and it does not have more than 10 goods carriage at any time during the previous year. Number of goods carriage are 10. Therefore, it is eligible for 44AE. Third case, PQN company is an LLP. LLP is not eligible for 44AD. It is engaged in wholesale trading business, but LLP is not eligible for 44AD. Fourth one is an interior decorator and the turnover is up to 50 lakh rupees. Therefore, it is eligible for 44ADA. Therefore, except PQN company, rest of the three are eligible and that is the answer over here. AB is eligible, LMN is eligible and XYN company is eligible. LLP is not eligible for presumptive income. I hope it is clear to all of you. Okay, let's go ahead with the next question. What is the business income to be declared by ABN company and PQN company for AY 25-26, assuming that the entities wish to make maximum tax saving without getting the books of accounts audited? Whenever this sentence will come, it means they don't want to get into normal provision. They want to follow the presumptive provision if possible. Okay. For ABN company, they want maximum tax saving without getting the books of accounts audited. So ABN company can go for what? Presumptive income. Total turnover is 200 lakhs. Out of which how much money is received online? 150 lakh is received online and then another 20 lakh is received online. You can check. And 30 lakh is received in cash. Therefore, out of 200 lakh, 170 lakh is received online. So on 170 lakh, deemed income will be 6%. And on 30 lakhs, deemed income will be what? Deemed income will be 8%. So 170 lakhs into 6%, you can see over here, and 30 lakhs into 8%, it will come to 12.6 lakh. Now for PQN company, obviously presumptive income is not applicable only. So for them, what is the provision? The answer will be 4.5 lakhs. They have to show the profit as 4.5 lakhs. That's it. Okay, 4.5 lakhs they have to show the profit. Now one more thing I would like to say you all, that when you follow the presumptive income for ABN company, from that you are not going to get the deduction of remuneration and interest under 44AD. Remember or not? But when you follow the normal provision for PQN company, you will get the deduction of remuneration and interest. Therefore, we are taking which profit for PQ? We are taking which profit for PQN company LLP? We are taking this profit which is after deducting the remuneration and interest on capital as per 40B. But for the first entity, we are not taking the benefit of 5 lakhs and 1 lakh because under 44AD, you don't get the deduction of these two items. Okay, I hope it is clear to all of you. Now, third question. What is the business income to be declared by LM company for AY 25-26? Again, if he wishes to make maximum tax saving without getting the books of accounts audited. Now, who is LM company? LM company is the second company. LM company is a company which is engaged, which is a firm which is engaged in hiring and leasing goods carriage. Now, for them, the income will be determined as per 44AE because they don't own more than 10 goods carriage at any time during the previous year. We want the profit as per the not auditing the books of account. We want to save maximum tax without auditing the books of account. So we have to follow the provisions of 44AD, 44AE. Now what is written in 44AE? 44AE divides all the goods carriage into two categories. One is light motor vehicle, another is heavy motor vehicle. If the weight of the vehicle is up to 12,000 kg, then it is light motor vehicle. Above 12,000 kg, then it is heavy motor vehicle. For light motor vehicle, the deemed income is 7,500 per month or part of the month for number of months the vehicle is owned by the SSE. And for heavy vehicle, it is 1000 rupees per ton. So for per ton, it is 1000 rupees per month, part of the month. For number of months, the vehicle is owned by the SSE. Now, one more important thing, this income as per 44AE, whenever we will determine this income, from this income, remember, we get the deduction of remuneration and interest also as per 40B, which is not allowed under 44AD and 44ADA. Remember, it is written in our book also, color book, easy notes, you can go and check over there. That remuneration and interest is allowed under 44AE, but it is not allowed under 44AD and ADA. Therefore, let's compute the income now. Now, here they have given us two dates, date of purchase and date of put to use. Remember, date of put to use is of no use. We are not interested in date of put to use. We are interested in date of purchase because the provision says for number of months the vehicle is owned by the SSE. So for now, how many months you are owning the vehicle, that is important to determine the deemed income. Now, the first one is a light vehicle, second is a light vehicle, third is a light vehicle, fourth is a light vehicle, fifth is also a light vehicle, up to 12,000 kg it is a light vehicle, and the last one is a heavy vehicle. So accordingly, you have to determine the deemed income. Now, in the first case, it is a light vehicle, therefore deemed income will be 7,500 into 3 vehicle into 11 months. 11 months, why? From May to March, it is 11 months. Second case, again light vehicle, 7,500 into 2 vehicle into 9 months. 9 months, why? From July to March. Okay. Then third vehicle is also light vehicle, 7,500 into 1 vehicle into 8 months. 8 months, why? August to March. Fourth one, 11,000 kg, 7,500 into 1 into 7 vehicle into 7 months. 7 months, why? 7 months because from September to March it is 7 months. Then 7,500 into 1 month into 5. Into 5 what? Because from November to March it is 5 months. Okay. And last one is not small light vehicle, it is heavy vehicle. So in case of heavy vehicle, it is 13,000 kg. Therefore, for every 1000, for every 1 ton, for every 1000 kg, it is 1000 rupees. So for 13,000, it is 13,000 rupees into 2 vehicle into 4 months. From December to March, it is 4 months. Whatever answer will come, from that you will reduce what? From that you will reduce the working partner salary, and you will also reduce the interest, and after that whatever answer will come, that will be your correct answer, and therefore the answer comes to 4,36,000. So 636 comes to the deemed income as per 44AE, and then you will remove remuneration and interest because that is allowed under 44AE, not allowed under 44AD and ADA. 436,500 will be your answer. I hope it is clear to all of you. Now, what is the income to be declared by XY and company under the head PGBP for AY 25-26, assuming that the firm wishes to make maximum tax saving without getting the books of accounts audited? So they don't want to get the books of accounts audited, they want to do maximum tax saving. Now, if they don't want to get the books of accounts audited, interior decoration, what is the turnover? The turnover is 50 lakhs. Of that, directly take 50%. That's it, the matter is closed. So 50 lakh, 50% will come to how much? Because you will follow for what? 44 ADA. Interior decorator is covered under 44 ADA. Therefore, 50 lakhs, 50% directly do. No need to do any audit. Nothing has to be done. 25 lakh rupees will be deemed income. But if you are following 44 AD, you are not going to get the deduction of remuneration and interest. We are very sorry for it. Remuneration and interest will not be allowed as deduction. Okay. And last but not least, what would your answer to MCQ 3 and 4 change if the firm decide to get the books of accounts audited? Let's see. In third case, if they do audit, will the answer change? In the third case, first of all, in case of LM company, if they do audit, will the answer change? Now, the answer will change because without audit, the answer is coming to 4,36,000, and with audit, the answer will come to 4.1 lakhs. Therefore, the answer will change. Yes. To MCQ 3, the answer will change. To MCQ 3, the answer will change to 4.1 lakhs. Now, will the answer change to MCQ 4 also? I think so. That will also change because with audit, the answer will change to how much? It will change to 20 lakh rupees because if they do audit, then they can do what? They can also reduce their income, and they can do what? They can take deduction of this and deduction of this, working partner salary and interest, and then therefore their income will come to 20 lakh rupees. Therefore, in this case also, if they do audit, their answer will change. Therefore, the answer will change in case of both MCQ 3 and MCQ 4. You can check it over here. Okay. Let's go ahead with the third MCQ case scenario, which is on capital gains and IFOS and PGBP, mix of all of them. Okay. Now, what is the first question? Let me see over here. It's a small case study, nothing great as such, just 2-paragraph case study. I'm reading the first question. What is the amount of income chargeable to tax in the hands of Mr. Hari in respect of transaction of sale of building to Mr. Rajesh, and under which head is it taxable? Now, let's see what Hari is exactly doing. Hari is a property dealer. So, if he is a property dealer and if he is selling a building, then obviously sale of that building will be considered to be a PGBP income. Okay. And therefore, I will apply section 43CA. Remember, if you sell an immovable property as a stock in trade, then 43CA is applicable. And if you sell an immovable property as a capital asset, then the provisions of 50C are applicable. Now, you are selling this to as a business. So therefore this is PGBP obviously. Now you are selling this for 100 lakhs. Now when you are selling at that time, the stamp duty value was 120 lakhs. Okay. But on the date of agreement, the stamp duty value was how much? 110 lakhs. Now which stamp duty value shall I take? Shall I take 120 lakhs or shall I take 110 lakhs? Now that depends upon one factor. If on the date of agreement, what is the date of agreement? That is on 1st September 2024. If on the date of agreement, if you have received some advance, if on the date of agreement or before that, if on 1st September or prior to 1st September, if you have received some advance in 4 modes. 4 modes means account pay check, account pay draft, ECS or such other electronic mode. Then you can take the stamp duty value on 1st September, or else you have to take the stamp duty value of the later stage. So on 1st September or before that, have I taken any advance by 4 modes? Yes, I have taken 15 lakhs by NEFT. NEFT comes in the 4 modes on the date of agreement. Therefore, you will take the agreement value, the stamp duty value on the date of agreement and not later stage 120 lakhs. You have to ignore. Now, the stamp duty value is 100 lakhs and your sale consideration is 100 lakhs. Sorry, stamp duty value is 110 lakhs and sale consideration is 100 lakhs. Now, is the difference between the two more than 110%? The answer is no. If the difference between the two is not more than 110%, then you have to take the sale consideration as the actual sale consideration 100 lakhs only. Yes, if the difference would have been more than 110%, then I would have taken stamp duty value. Otherwise, you cannot take stamp duty value. Therefore, my answer, my sale consideration is 100 lakhs. Now, what is the purchase price? The purchase price is 50 lakhs. Therefore, what is the income over here? 100 lakhs is the sale consideration, 50 lakhs is the cost of the asset, and 50 lakhs will be the PGBP income. It is as simple as that. You can check it over here. 50 lakhs is what? The PGBP income. I hope it is clear to all of you. Now, question number 2. Is any amount taxable in the hands of Mr. Rajesh? Who is the Rajesh? Rajesh is the buyer of Mr. Hari. Mr. Hari is the seller, Rajesh is the buyer. So, is any amount taxable in the hands of Mr. Rajesh? We need to answer that. Now, no. Mr. Rajesh is also not liable to tax any. Why, sir? Why? See, if you buy any immobile property for lower than the stamp duty value, then it is generally taxable as IFOS income, but you have to fulfill 2 conditions. First condition, the difference between the selling price and the stamp duty value has to be greater than 110%. This is the first condition. And the second condition, the difference has to be more than 110%. And the second condition, the difference has to be more than 50,000 rupees. Now here the difference between the selling price and the stamp duty value is not greater than 110%. It is exactly 110%. It has to be greater than 110%. Therefore, no amount is taxable in case of Mr. Rajesh. Mr. Rajesh is escaped from what? Income from other source. I hope it is clear. Now third question. What is the amount of income chargeable to tax in the hands of Mr. Ravi in respect of transaction of sale of residential house to Mr. Valish, and under which head? So the second paragraph talks about Hari. Hari's brother Ravi. So Ravi is a retail trader. So now Ravi is not a trader of immobile property, he is a retail trader. So now if he is selling a residential house, he will be liable for capital gains. Okay, because he is not a trader in immobile property. Now he is selling for how much? 50 lakhs on 1st Feb. And on 1st Feb, the stamp duty value was 70 lakhs. But on the date of agreement, the stamp duty value was how much? 55 lakhs. Now which one to take? See, again the same rule you have to apply. If on or before the stamp duty, if on or before the date of agreement, if you have received the advance by 4 modes, then you can take the stamp duty value on 1st August, or else you have to take the stamp duty value on 1st Feb. So now I have received the advance of 5 lakh rupees, but by cross check. That is the mistake I made. Cross check doesn't come under the 4 modes. Therefore, I am not receiving the advance on or before the date of agreement by 4 modes. I am receiving by other than 4 modes. Therefore, I cannot take the stamp duty value on what? On 1st August. I cannot take the stamp duty value as 55 lakhs. I have to take the stamp duty value as 70 lakhs. Now 70 lakhs is the stamp duty value. Sale consideration is 50 lakhs. Is the difference between the two more than 110%? The answer is yes. Therefore, the FVC will be how much? The FVC will be 70 lakh rupees in this case as per section 50C. Here 50C will apply. Here PGBP will not apply. Here capital gains will apply. Now 50C, 70 lakhs is the full value of consideration. Now one more thing we need to answer over here, and that one more thing is whether the nature of asset is long term or short term. Now you are selling in Feb 2025. It was purchased in August 23. Therefore, the period of holding is less than 24 months. Because it is less than 24 months, therefore the period of holding, because it is less than 24 months, therefore the gain will be considered to be short term capital gains, and sale consideration is 70 lakhs. Cost of acquisition is 32 lakhs. Okay. Therefore, 38 lakhs will be chargeable as capital gain tax. This is the answer to this particular question. 38 lakhs chargeable as short term capital gains. I hope it is clear to all of you. Is it clear? Now let's move on to the fourth question. Is any amount taxable in the hands of Mr. Valish? So again, is any amount taxable in the hands of buyer? Yes, the buyer is liable to tax. The buyer is buying the property for how much? The buyer is buying the property for 50 lakh rupees. You can see over here. He's buying property for how much? 50 lakhs. And what is the stamp duty value? 70 lakhs. Is the difference between the two more than 50,000 rupees? The answer is yes. Is the difference between the two is more than 110%? The answer is yes. Therefore, the buyer will be liable for income from other source on 20 lakh rupees in this particular question. I hope it is clear to all of you. And last but not least, is the Rajesh the first buyer and Valish the second buyer liable to deduct any TDS? The answer is yes. As per 194 IA, if you are buying any immovable property of 50 lakh rupees or more, if the selling price is 50 lakh rupees or if the stamp duty value is 50 lakh rupees or more, then in that case you have to deduct the TDS under 194 IA at 1%. So in this both the cases, in case of Rajesh also, in case of Valish also, the transaction is conducted at 50 lakh rupees or more. You can check it. It is at least 50 lakh rupees or more. Therefore, the TDS has to be deducted by both of them. But the TDS is deducted on what? On higher of the actual purchase price or the stamp duty value, whichever is higher. So this is what this small question is all about. Now let's move on to the next case scenario, which is on section 115BAA, 115BAB, so on and so forth. There are 4 companies which are given over here. Let's talk about the first question over here. What would be the tax liability of B Limited for AY 25-26 if it avails the beneficial tax rates under the special provisions of 115BAA and BAB, as the case may be, by fulfilling the condition? Okay. So if B Limited is following the beneficial tax rates, that is the concessional tax rates. So out of 115BAA and BAB, we need to choose first of all which is relevant for them, and then we need to compute the total income of the assessee according to that. So let's go to B Limited now. B Limited was set up on 1st of November 2024. Therefore, 115BAB is not possible. Why not possible? Because 115BAB is only possible if you set up the company, domestic company, from 1st October 2019 to 31st March 2024, and B Limited is setting up the company after 31st March 2024. Be very careful. Okay. Now, second thing, B Limited is engaged in apparel business. Therefore, now 115BAB is not possible, but can they take 115BAA? BAA is open to everyone. Okay, they can take 115BAA. BAB is not possible. Now, second thing is apparel business. Whenever the word apparel business will come, your mind should click. Apparel, footwear, leather. 80JJAA, only 150 days. Remember, generally in 80JJAA, you have to give an employment to the employee for 240 days. But in case of these 3 business, manufacturing of apparel, leather and footwear business, you have to give the employment to the employee for only 150 days. That is also sufficient. Now, what is the gross total income of the assessee? It is 2.8 crore rupees. That is 280 lakhs. How many employees have hired? 1000 employees. When they have hired on the date of setting up. Date of setting up means 1st November. So if I count from 1st November to 31st March, is it happening 150 days? The answer is definitely yes. 150 days are happening. How 150 days are happening, sir? You count it now from 1st November to 31st March. It is around 151, 152 days. If it is a leap year, then it is 152. If it is not a leap year, then 151 days are happening. We need only 150 days. Therefore, it is eligible for 80JJAA. And even if you follow 115BAA, you are eligible for 80JJAA. Okay. Now, 80JJAA, you are totally hiring how many employees? 1000 employees. Out of which 500 employees have an emolument of 26,000 rupees. Therefore, they will not be eligible for 80JJAA, because for 80JJAA, the emoluments per month should be up to 25,000 rupees. Therefore, the second 500 category emoluments, all those who are having emoluments of 26,000 rupees, they will not be eligible for what? 80JJAA. So only this employee will be eligible for 80JJAA. How will you compute? 500 employees into 25,000 rupees per month into how many months? 5 months, from November to March, into 5 months into 30%. Check it, please. 24,000 is the emolument into 5 months into 500 into 30%. It comes to 1.8 crore. And this is your total income, 1 crore. Sir, will I not get additional depreciation for buying plant and machinery, sir? No. When you are buying a plant and machinery, you will not be eligible for additional depreciation under 115BAA. 115BAA does not give you additional depreciation. It gives you 80JJAA. 80JJAA is allowed under 115BAA. Now, on this, you will apply the tax. What is the tax rate under 115BAA? It is 22% flat tax. 10% flat surcharge for everybody. Surcharge does not have limit. Always in 115BAA, surcharge is applicable. For plus 4% cess, this comes to 25,16,800, and this is the answer to this particular question. Okay, I hope it is clear to all of you. Now, second question. What would be the, similarly, we have to do this exercise for A Limited also. Let's go to A Limited now. Now, A Limited was set up on 1st of September 2019. Again, 115BAB is not possible. Why, sir? Because 115BAB is applicable if you set up your business on or after 1st of October 2019, and it was set up 1 month before that. Therefore, 115BAB is not possible. Okay. 115 BAA, yes, BAA is possible. What is the gross total income? 4.9 crore. Additional depreciation will be allowed? Obviously not allowed. Why, sir? Array, it has been purchased 5 years back. Yeah, assets are purchased 5 years back, and 115 BAA, anyways, you don't get additional depreciation. Sir, 80 JJAA will be allowed? That will also not be allowed. Why? Because the employees were employed on the date of setting up of the company. It means employees were employed on 1st September 2019, and 80 JJAA is available only for the first 3 years. That is in 1920, 2021, 21, 22. And we are computing income for which year? We are computing income for 2024-25. Therefore, 3 years have elapsed. See, in case of B Limited, why we have taken 80 JJAA? Because this is first year of business. So we are taking in the first 3 years. First 3 years the benefit is available. But in case of A Limited, this benefit will not be available because the employees were employed on what? 1st September 2019, and 3 years have gone. Therefore, 80 JJAA is not available. So in case of A Limited, the total income is directly 4.9 crore. That's it. So 4.9 crore is the total income. 80 JJAA is not available. On that, you will directly apply 22% tax, 10% surcharge, 4% cess. This is the answer which you are going to get, and this is the correct answer. I hope it is clear to all of you. Let's move on to the third question. What would be the total income of A and B if they do not opt for special provisions? C. If they do not opt for special provision, what will be the income of A? See, the income of A will remain at 4.9 crore. Why, sir? Because if they do not opt for special provision, then also they are not going to get 80 JJAA. Then also they are not going to get additional depreciation. Why, sir? Because the new plant and machinery of this 10 crore rupees, let me clear this, that has become very... Because this new plant and machinery in case of A was purchased on the date of setup in 2019. So in 2019, you would have got the additional depreciation. Now you cannot get additional depreciation in 24-25. So in case of A Limited, you will not get this additional depreciation. Therefore, the income will remain at 4.9 crore. In case of B Limited, this is the first year of business. Be very careful. Because this is the first year of business. So in case of B Limited, if B Limited follows the normal provision, does not follow 115 BAA, then it can be eligible for what? Eligible for what? Because this is the first year and they are setting up the plant and machinery in the current year only 24-25. So now they can take the benefit of what? Additional depreciation. But that also they will get half, only 10%, because the machinery has been put to use for less than 180 days in the current year. Therefore, they will get 40 crore extra, 40 lakhs extra benefit over here. I hope it is clear to all of you. So in this case, in case of B Limited, what will be the answer? 2.8 crore is the GTI. Obviously 80 JJAA they will get, and 40 lakh rupees extra benefit. And here, why we are not getting 80 JJAA? Because this is the 6th year of business and the employees were employed in the first year of business. Why we are not getting additional depreciation? Because this is the 6th year of business and the additional depreciation is available in the year in which you purchase the machinery and put to use, not after 5 years. Okay. Therefore, it is not eligible over here. Okay. I hope it is clear to all of you. Now, the next two questions are on computation of penalty. These are very simple questions. What would be the quantum of penalty payable by C Limited under section 270A? Assuming that underreporting is not due to misreporting. It is not misreporting. It is not misreporting. It means you are going to apply 50% penalty. And assume that C Limited has not opted for the special provision. It means they are going for the normal provision. Okay. Now, first of all, if they are going for normal provision, we need to find out the tax rate of C Limited. See, this is which year? This is 24-25. Therefore, to compute the tax rate, to find out the tax rate, I need to see the turnover of last to last year. The turnover of last to last year of C Limited is 499 crore, which is more than 400 crore. Now, because the turnover of last to last year is more than 400 crore, therefore, the tax will be 30%. The tax will be how much? The tax will be 30%. Okay. Now, we need to compute the what? Penalty. How will I compute the penalty? The formula for computing the penalty, step number 1, underreported income. What is underreported income? See on the board. Income assessed 20 crore minus income processed. That comes to how much? 4 crore. This will be your underreported income. Okay. Now, practically speaking, I should compute tax on 20 crore first, and then I should compute tax on 16 crore, and then I should take the difference. But if I compute tax on 20 crore, then I compute tax on 16 crore, and then I take the difference of the two, or if I directly compute tax on 4 crore, it will come to same only. Okay. I have to be just careful that I have to apply 12% surcharge here. Why? Because if I compute tax on 20 crore, I have to apply 12% surcharge about 10 crore. If I compute tax on 16 crore, I have to apply 12% surcharge about 10 crore. I hope it is clear to all of you. Yes or no? So therefore, I will compute tax on 4 crore directly. 30% tax, 12% surcharge. Why? Because the income is more than 10 crore and 4% cess. This will be the answer of that 50% penalty. And therefore, you will get the answer as 69,88,800. The last question is also similar only. What would be the quantum of penalty payable by deemed limited under 270A, assuming that the underreported is misreporting? Now it is misreporting. If it is misreporting, the penalty will be 200%. But again, I would like to check the tax rate of this company delimited. What is the turnover of last to last year? The turnover of last to last year is 251 crore. Therefore, the tax rate will be only 25%. Okay, I hope it is clear to all of you, because the turnover of last to last year is up to 400 crore. Therefore, it will be only 25%. Now, income assessed 22 crore, income processed 20 crore. Therefore, the underreported income is 2 crore. Again, you can compute tax on 22 crore first, then 20 crore, and then take the difference, or you can compute tax on 2 crore directly. Okay. Because on 22 crore also the effective tax rate is same only, and on 20 crore also the effective tax rate is same only. What is the effective tax rate on 22 crore? 25% plus 12% plus 4%. And the same is on 20 crore also. Therefore, directly compute on 2 crore now. On 2 crore, 25% tax, 12% surcharge, 4% cess. That comes to 58,24,000. Of that, 200% penalty because it is a case of misreporting. Therefore, 1 crore 16,48,000 will be your what? Will be your answer. And this is the answer over here, as you can see over here. I hope it is clear to all of you. Now let's move on to the next case scenario number 5, which is on business trust, that is REIT. Now there is a business trust. Okay, first of all, you need to understand the scenario. There is a business trust of which there are 5,000 unit holders. How many unit holders? 5,000 unit holders, of which 100 units are held by Mr. X, who is a resident. Therefore, 100 units amounts to how much? It amounts to 2% stake. And 500 units are held by a non-resident, Mr. Y. So 500 on 5,000 amounts to how much? It amounts to 10% stake. You need to keep all these things in your mind. So there is a business trust. There are 2 unit holders, Mr. X and Mr. Y. Mr. X holds 2%, Mr. Y holds 10%. And there is an SPV by the name called as Z Limited. Z Limited is a SPV. It's a SPV. It's an SPV in which business trust holds 100% shareholding. Now I will talk about one question. Okay. In respect of the component of interest income from Z Limited. What is Z Limited? It is SPV. Distributed by business trust to the unit holder X and Y. What will happen? Now listen carefully. I am a business trust, that is a SPV Z Limited. Now whatever interest the SPV will give to business trust, it is exempt in the hands of business trust. But yes, it is taxable in the hands of the unit holder. In the hands of unit holder, it is taxable. Now how much taxable? How much taxable? We have to deduct TDS also. So how much is taxable? Total interest income is how much? 10 lakhs. Out of which X is resident and he holds 2%. Therefore, in the hands of X, 20,000 will be taxable. Y is non-resident and he holds 10% stake. So 10% of 10 lakh comes to 1 lakh. So 1 lakh will be taxable. And what will be the TDS? For resident, the TDS is 5%. For non-resident, the TDS is 5.2%. For resident, the TDS is not 5%. It is 10%. Sorry. And for non-resident, the TDS is 5.2%. I hope it is clear to all of you. So for resident, the TDS is 10% without surcharge and cess. For non-resident, the TDS is with cess. Why not surcharge? Because the income is not exceeding the limit of surcharge. Therefore, only cess will apply 5% plus 4%, that is 5.2%. I hope it is clear to all of you. Is it clear? Now, in respect of short-term capital gains of 4 lakhs on sale of listed shares of Indian company. So who will pay tax on short-term capital gains on listed shares? It is the business trust who will pay, and it will pay under 111A. Business trust has to pay tax on 111A short-term capital gains at 20% plus 4%. Okay. And what about on short-term capital gains of property? On short-term capital gains of property, business trust will pay tax again at the rate of MMR. STCG on property at MMR. I hope it is, because it is very clearly written in business trust topic that if there is a 111A income, then business trust will pay as per 111A rate, which is 20% from 23rd July. And all other short-term capital gains, business trust will pay tax at MMR. I hope it is clear. Now, what about the dividend component from Z Limited? Now, the dividend from Z Limited in the hands of business trust are always exempt. Is always exempt, always. But what about in the hands of investor? In the hands of investor, it depends upon Z Limited. If the Z Limited has opted for 115BAA, if the SPV has opted for 115BAA, then the investor has to pay tax. If the SPV has not opted for 115BAA, then it is exempt in the hands of investor. So we need to check in this question what the SPV has done. SPV has not opted for 115BAA. Now, because SPV has not opted for 115BAA, it is exempt in the hands of investor also. In the hands of business trust, dividend from SPV is always exempt. In the hands of investor also it is exempt in this case because the SPV has not opted for 115BAA. You can check over here. It is exempt in the hands of business trust. In the hands of business trust, the dividend from SPV is always exempt. But in the hands of unit holder also in this case, it is exempt because the SPV is not opting for 115BAA. Now the next question is continuation of this question also. This question only. If Z Limited exercises the option under 115BAA, then what will happen? Then again, it will be exempt in the hands of business trust. As I have told you, it is always exempt in the hands of business trust. But now it will be taxable in the hands of the investor, that is X and Y. Because the SPV is opting for 115BAA, so the investor has to bear the brunt of tax over here. Okay. So investor has to pay tax on this particular amount. Next question. Interest received by business trust from investment in unlisted debentures of real estate. No special rate. Business trust has to pay tax at MMR on this income. So if the business trust is investing in some debentures, from there they are earning some interest, then that is not exempt. Only interest from SPV is exempt. Interest from unlisted debentures of some company is not exempt. MMR, the business trust has to pay tax at MMR. Investor, it is exempt. Okay, but that is not asked in the question. And last but not least, the business trust has invested in some properties. From that, they are earning some rental income. How much rental income they are earning? Rental income of 20 lakhs they are earning. Remember, rental income is exempt in the hands of business trust, but it is taxable in the hands of the investor. So rental income from property is exempt in the hands of business trust, but taxable in the hands of investor. So if it is taxable in the hands of investor, how much will be taxable? 2% and 10%. Mr. X 2%, Mr. Y 10%. So Mr. X will pay tax on 2% of 20 lakhs, that is on 40 lakhs, and Mr. Y will pay tax on 10% of 20 lakhs because he holds 10% stake, that is 2 lakh rupees. What is the rate of TDS? In case of resident, you have to deduct TDS at the rate of 10%. In case of non-resident, there is no special rate. There is rates in force that will be given under the Finance Act. You don't have to remember that. So in case of non-resident, you have to deduct TDS at the rates in force. Okay. I hope it is clear to all of you. Now let's move on to the next question. It's a very, very simple question. MNO is a firm liable for tax at 30%. Their income is given. We need to compute the penalty, etc. Now MNO is deemed to have underreported its income. Why? Because of which reason? MNO has deemed, when underreporting happens? Underreporting happens when your income assessed, see on the board, is more than income processed. Okay. Underreporting never happens because of income process compared with what is written in the income tax return. Never, never, never. Underreporting can only happen in the course of assessment. So when is the first assessment happening? Under 143. This is underreporting. When is the second assessment happening? 147. This is underreporting. Therefore, underreporting is what? When 143 is more than 143.1. And when 147 is more than 143.3, these two cases can be called as underreporting. When 143.1 is more than 139.1, this is not underreporting because this is not found by the assessing officer. This is found by a software under 143.1 while generating an intimation. So whatever is found by assessing officer, only that will be considered to be underreporting. I hope it is clear to all of you. Now Mr. N is deemed to have underreported his income. Now who is Mr. N? Mr. N is a separate person over here, is a resident individual and a partner of the above firm. So Mr. N is a partner of above firm. So Mr. N, when Mr. N is deemed to have underreported his income, he will be deemed to have underreported his income when he will not file the return and at the same time his income is greater than the basic exemption limit. So if a person whose income is greater than basic exemption limit, condition number 1, and still he does not file the return, then it is deemed to be underreported income. So these 2 points together will be considered as what? Will be considered as Mr. N's case for what? Underreported income. I hope it is clear to all of you. Now question number 3 is a computation of penalty, which we have done in the previous questions also. But we are not going to leave any question, don't worry. Assuming that the underreporting is not on account of misreporting. So it is not a misreporting. It means 50% penalty will be imposed. None of the additions or disallowances made in the assessment qualifies under 270A6. Penalty would be how much at the time of assessment? See, what is the income assessed? Income assessed is 65 lakhs. What is the income process? Income process is 50 lakhs. Therefore, the differential amount 15 lakhs will be called as what? Underreported income. Now, again, I would like to say you can compute tax on 65 lakhs and then you can compute tax on 50 lakhs and then you can take a difference, or the effective tax rate is same only. So you can compute directly tax on 15 lakhs. So I will compute tax directly on 15 lakhs. On 15 lakhs, I will take 31.2%, 30% tax, 4% cess. This comes to my tax on underreported income. On that, it is not a case of misreporting. Therefore, 50% penalty. 50% penalty comes to 2,34,000 rupees. I hope it is clear to all of you. Okay. Now, coming to question number 4. Question number 4 is the same question which talks about it is on account of misreporting now. Now, because it is misreporting, therefore 200% penalty will be there. And now you need to compute the penalty at the time of reassessment. So now, how will you compute the underreported income? The underreported income will be as follows. Income reassessed 85 lakhs minus income previously assessed 65 lakhs. Therefore, underreported income will be 20 lakhs. Now you will compute tax on 20 lakhs. Tax on 20 lakhs will be 20 lakhs into 31.2%. That comes to 6,24,000 rupees. And now you will take 200% of that because now it is a case of misreporting. Therefore, 12 lakh 48,000 will be the answer of this particular question. I hope it is clear to all of you. Okay. Now, question number 5. Question number 5 talks about what? Assuming that the underreporting of income is not on account of misreporting. Therefore, again, it is a case of what? Case of 50% case. The underreported income of Mr. N and the penalty leviable. So, in case of Mr. N, how will you compute the underreported income and the penalty? Let's talk about the Mr. N. Mr. N is a resident individual. His age is 58 years and is a partner of the above firm. Okay. He has not furnished the return and his income is 15 lakhs. Therefore, in his case, the underreported income will be how much? Income assessed minus the basic exemption limit. What is the basic exemption limit? It is 3 lakhs. Therefore, underreported income will be how much? It will be 12 lakh rupees. So 12 lakh rupees will be underreported income. Okay. I hope it is clear to all of you. Now, how to compute the penalty? Now, you will not compute penalty on 12 lakh rupees directly. You will make a mistake if you do that. First, you will compute tax on 15 lakh rupees and then you will compute the penalty. So how to compute the tax? You do not compute tax on 12 lakh rupees. You have to compute tax on 15 lakh rupees entirely. So you will compute tax on 15 lakh rupees entirely as per the new regime. By default, new regime is applicable for everybody. We know that. Don't follow old regime if the question is silent about it. And then you compute 50% penalty because it is not a case of misreporting, and that will be your answer. I hope it is clear to all of you. Now let's go ahead with the next case scenario. Next case scenario is on taxability of ULIP and life insurance policy. Now, first of all, one mistake is there in the ICAI solution. Here you have to write 40,000 rupees. Here it is written 0000, but the actual amount which has to be over here is 40,000 rupees. So just keep a note of this. Okay. Now I'm reading the first question over here. Which are the life insurance policy excluding ULIP? So initially we are not talking about ULIP. We are only talking about life insurance policy. Which are the life insurance policy in respect of which Mr. Manoj would be eligible for exemption under 1010D in respect of maturity proceed, and what is the quantum of deduction under ATC? So there are two questions which we need to answer. First, which of the life insurance policies are exempt on maturity, and second, what is the total deduction they are going to get under ATC for life insurance policy? So let me talk about the exemption first. First of all, let me tell you, there are two life insurance policy A and B over here. Okay. One is issued in 2016, another is issued in 2017. Now, for life insurance policy to become exempt, there are some conditions that we need to fulfill. First, if the policy is issued between 1st April 2003 to 31st March 2012, then the annual premium should not exceed 20% of sum assured. If the policy is issued after that, from 1st April 2012 to 31st March 2013, then the annual premium should not exceed 10% of sum assured. And if the policy is issued on or after 1st April 2013, then the policy premium should not exceed 10% in case of normal person, and in case of disabled person, it should not exceed 15%. Now, both our policies are issued on or after 1st April 2013. Therefore, we need to check the condition of 10%. Okay. So, if the premium exceeds 10%, then the policy is taxable. If the premium does not exceed 10% of sum assured, then it is exempt. Now, let's check. In first case, the premium is 50,000 and the sum assured is how much? It is 6 lakh rupees. So 50,000 divided by 6 lakhs is not more than 10%. Therefore, this policy is exempt. Okay. Now, in second case, the premium is 40,000 and the sum assured is 3,50,000. Therefore, now if I do 40,000 divided by 3,50,000, it is more than 10%. Therefore, it is taxable. Okay. I hope it is clear to all of you. So in this case, only policy A is exempt. Policy B will be taxable. Now, the second question asked in MCQ 1 is how much deduction will be available under ATC. So for ATC also they have given a restriction in ATC that up to 10% you will be allowed the deduction, above 10% it will not be allowed. So here, is this 50,000 within 10%? Yes, it is within 10%. Therefore, this 50,000 will be fully allowed. Is this 40,000 within 10%? No. 10% of 3,50,000 sum assured will come to 35,000. Therefore, in this case, you will get 35,000 deduction only because 40,000 is above 10%. So up to 10% you can claim deduction under ATC. So in case of first policy you can get 50,000. In case of second policy you can get 35,000, and therefore the total of the two will come to 85,000 rupees, and that is the amount of deduction that you can get over here. Okay, I hope it is clear to all of you. Okay. Now the second question is a beautiful question. Which are the ULIPs in respect of which Mr. Manoj would be eligible for exemption under 1010D in respect of maturity proceeds? Choose the most beneficial to Mr. Manoj. Now this is a beautiful question. Now for that you need to again know the provisions of the ULIP. Now for ULIP also, if you want to claim exemption, you should not, your annual premium should not exceed the percentage which I have said you, from 2003 to 12, then 12 to 13, and after 13. Okay. So the annual premium should not exceed 10%, 15%, 20%, depending upon when the policy is issued. Same like LIC, same like LSC. Here also you have to find out the annual premium. If it is within that limit, then it is exempt, otherwise it is taxable. Now, but from 1st of Feb 2021, keep the date in your mind, because this date is going to play the very important role in this MCQ. From 1st Feb 2021, the law has been changed, and now if you want to claim exemption of ULIP, you have to fulfill the percentage criteria, as well as your annual premium in the entire year should not be more than 2,50,000 rupees. Your amount of premium should also be up to 2,50,000. It should not exceed more than 2,50,000, and your percentage should also be within the percentage limit. Both the conditions have to be fulfilled if you want to claim exemption. What about the policies which are issued before 1st Feb 2021? The policies which are issued before 1st Feb 2021, only the percentage criteria has to be fulfilled. Now, if I see the 4 ULIP policy C, D, E, F, the policy D, which is issued on 1st Jan 2021, for this the new amendment is not applicable, because this is issued before 1st Feb 2021. So for this policy, only the percentage criteria has to be fulfilled. Let's see whether the percentage criteria is getting fulfilled or not. 3 lakh is the premium, 30 lakh is the sum assured, as you can see. Therefore, the percentage is exactly 10%. Therefore, this policy is fully exempt. There is no need to check this policy henceforth. It is fully exempt. Now, what about this policy? This policy, new amendment is applicable. For E also, new amendment is applicable. For F also, new amendment is applicable, because all these policies are issued on or after 1st of Feb 2021. I hope it is clear to all of you. Now listen carefully, all of you. Now listen carefully. Now, can I claim? First, we need to check for all of them whether the percentage criteria is fulfilled or not. Now, if you check for all of them, 1 lakh divided by 10 lakh, 1 lakh 40 divided by 14 lakh, 2 lakh 50 divided by 25 lakh, for all of them, the percentage criteria is definitely fulfilled. But I cannot claim exemption for all 3 of them. Why? Because the aggregate premium of all 3 of them is more than 2,50,000. So now I have to choose between them. I can either exempt policy F, then I have to pay tax on C and E, or I can either make these 2 policy exempt, because the aggregate premium of C and E is 2,40,000. Then I have to pay tax on what? The policy F. So which I have both the options. Option 1, C and E exempt, F taxable. Option 2, F exempt, C and E taxable. But the law says that you have to do it in the, and D is always exempt. See, okay, there is no question about D, because D was issued prior to 1st Feb 2021. But now the question over here is, the question says in question number 2, MCQ 2, that we have to choose the most beneficial one. Now, obviously, whichever option will have more tax, more taxable income, we will exempt that. Okay, it's very simple. And the option which has lesser tax, we will pay tax on that. Okay, so let's see how to compute tax in this case. Do you remember how to compute tax in this case? Whatever is the amount received by you minus whatever is the premium paid by you. So option 1 is exempt C and E. Option 2 is exempt only F. Okay, so if I pay tax on C and E, how much tax will come? So for policy C, I am going to get 11 lakh, and for policy E, I am going to get 17 lakh. So total I am going to get how much? 28 lakhs for these 2 policies, minus what is the premium paid by you on these 2 policies for the entire life. So 1 lakh I am paying on this, 2 lakh 40 I am paying on this, 1 lakh 40 I am paying on this. So total premium I am paying for is 2 lakh 40,000. For how many years? From 2021 to 2030. That is for 9 years. You count, there will be 9 premium which will come over here. Okay, 9 premium. So 1 lakh 40 into 9 will come to how much? Will come to 21.6 lakhs. Therefore, here the taxable amount will come to 6.4 lakhs. So if I make this exempt, I will save tax on 6.4 lakhs. Now let's talk about the option F. What does option F has to say? If I go for option F, then how much income will be taxable? It will be 28 lakhs is my consideration minus the premium of 9 years. Premium of 9 years will come to 22 lakh 50,000. So here the taxable income will come to 5 lakh 50. So it is sensible. What is more sensible? It is sensible to exempt option C and E and pay tax on F, right? Because on F the tax is coming lesser, the income is coming lesser. On C and E the income is coming more. Therefore, it is more sensible to exempt C and E. Therefore, what will be the ultimate answer? Which policies are exempt? D is by default exempt, because that is issued before 1st Feb 2021, and C and E. So C, D and E. C, D and E is the most beneficial option for the SSE. I hope it is clear to all of you. Okay. Now, considering the option given in MCQ2, what will be the capital gains? Now, if we go for this, then what will be the capital gains? If we are going for this, we are exempting C, D and E and we are paying tax on F. So what is the capital gains? So we have already computed that capital gains, that the capital gains on F will be 5,50,000. So we have already computed that 5,50,000 will be the amount of capital gains. I hope it is clear to all of you. Now let's move on to the next question, which is on TCS and TDS under 194Q and 206C1H. So here there are three brothers, Mr. Sunil, Mr. Sriram and Shyam are three brothers who are resident Indians. They are doing some business. Their turnover is 9 crore, 10 crore and 12 crore for the last year. Their last year turnover is 9 crore, 10 crore and 12 crore. Now they regularly purchase goods from another resident, Mr. Ashwath, and Ashwath's last year turnover is 18 crore. Okay. So the turnover of all the people of the last year is given in the question. Okay. Now they all follow mercantile system of accounting. The aggregate amount credited by the brothers to the account of Ashwath during the month of each month of financial year is shown in the table below. It may be assumed that the entire amount relating to Ashwath for a particular month is credited to his account on the last day of that month and it is paid on the last day of the following month. Now this is one of the most important line. That is the reason I was reading this particular line. So if I am purchasing anything in this month, then I am crediting at the end of this month, but I am not paying at the end of this month. I am paying at the end of next month. So if I am crediting in the month of July, I am paying at the end of August. You have to be very careful with this. Likewise, Ashwath also debit the amount of Mr. Sunil, Mr. Sriram and Shyam on the last day of the month, while the amount of sales affected during each month. Now, there is few more data which is given below. I'll be reading that after some time. Are the provision of TDS under the Income Tax Act attracted in respect of purchase transaction with Mr. Ashwath? If so, in whose hands, at what rate, and at what point of time? Ignore one-time transaction of Mr. Sunil's friend, Mr. Krishna, for the purpose of this MCQ. So the question asks, is the TDS provision applicable here? Now, be very careful. In case of Sunil and in case of Sriram, TDS provision is not applicable. Why? Because in case of Sunil and Sriram, the last year business turnover is less than 10 crore rupees. It is not more than 10 crore. Therefore, see now, the Sunil's last year turnover is 9 crore. Sriram's last year turnover is exact 10 crore. If the turnover of the last year is more than 10 crore, then only 194Q is applicable. Yes. But in case of Mr. Shyam, TDS is applicable. Why? Because Mr. Shyam's last year turnover is more than 10 crore, that is 12 crore rupees. So in case of Shyam, TDS has to be deducted. When it has to be deducted? When the purchase from Ashwath exceeds 50 lakh rupees. So now in the first month it is 9.8 lakhs, then it is 8.75 lakhs, then 9.45 lakhs, then 6.8, 6.3, 8.15, and then it crosses 50 lakh rupees in the month of October. So in the month of October, it has become 57.05 lakhs. Okay. So now in the month of October, you are liable to deduct TDS. When you are liable to deduct TDS? In the month of October. Why, sir? Because the 50 lakh purchase exceeds in the month of October, and as per 194Q, TDS has to be deducted on credit or payment, whichever is earlier. So when the sales are credited, when the purchase is credited in the books of accounts, in the same month. So October purchase is credited in the month of October only. So here you are liable to deduct TDS on 7.05 lakhs, 0.1%. Okay. So you can check the answer. Yes, Mr. Shyam is liable to deduct TDS on 0.1% after it crosses 50 lakh rupees from 31st October onwards. Okay. So from 31st October onwards, the buyer, Mr. Shyam, has to deduct the TDS. Now, are the provision of TCS applicable attracted in respect of the sale transaction affected by Mr. Ashwath? If so, from whom does he has to collect, at what rate and at what point of time? Now again, a very good question. See, in case of Sunil and in case of Sriram, Sunil and Sriram is not deducting TDS. 194Q is not applicable. So if 194Q is not applicable, always remember between 194Q buyer and 206C1H seller, the priority has to be given to 194Q. But if the buyer's last year turnover is not exceeding 10 crore rupees, then the seller has to collect TCS under 206C1H. So because the buyers last year, Sunil and Sriram's last year turnover is not exceeding 10 crore, therefore in this case, Mr. Ashwath has to collect TCS in case of Mr. Sunil and Sriram. Now, in 206C1H, be very careful. The TCS is collected not on debit but on receipt basis. TCS is not collected on accrual basis but on receipt basis once the sale crosses 50 lakh rupees. So now in case of Mr. Sunil, the sale is crossing 50 lakhs in the month of November, but the TCS will not be collected in November. The TCS will be collected in December because the sale of November, the amount is realized in the next month. Okay, because that's the most important line which I have highlighted over here. So if whatever sale has happened in the month of November, the amount is received in the month of December. So in this case, the TCS will be collected in the month of December. Similarly, in case of Shri Ram, the 50 lakh crosses in October. Therefore, TCS will be collected in November in excess of 50 lakh rupees. You can check it over here. So in case of Sunil, in case of Shri Ram, in case of one of the brother, it is October, it is December, and second brother, it is November. Okay, that is the following month. Whatever month you are selling in the following month. So in first case, it is December. In second case, it is November. Be very careful. In case of 194Q, for 194Q, TDS is deducted on credit and payment. But for 2061H, TCS is collected only on receipt basis, not on debit or receipt, whichever is earlier. So that's the reason in case of TCS, we are going in the following month. But in case of TDS, we are not going in the following month. This is the most important catch of this question. Okay. Now the third question, very, very simple, nothing great as such. What would be the applicable rate of TDS if Mr. Ashwath failed to furnish PAN? Also, what will be the applicable rate of TCS if the collectee failed to furnish PAN? See, in case of 194Q, if the seller is not giving PAN, then it is 5%. 5%. And in case of 2061H, if the buyer is not giving PAN, it is 1% or twice the rate. 1% or twice the rate, whichever is higher. Therefore, ultimately the answer will come to 1%. Okay, because the twice the rate will come to 0.2%. The rate is 0.1%. Twice the rate of 0.1 will come to 0.2. Therefore, in case of PAN, in case of TDS, the 194Q says that 5% if no PAN is given. In case of TCS, it says 1%. Therefore, the answer will come to 5% and 1%. Okay, I hope it is clear to all of you. Now, what would be the TDS or TCS implication in respect of single purchase transaction by Mr. Krishna from Mr. Ashwath? So now some single transaction is happening over here. Mr. Sunil's friend, Mr. Krishna, who commenced business. Commence means it is the first year of business. And he has purchased goods of 60 lakh rupees from Ashwath on 30th June. On which date he credited the said sum to the account of Ashwath, however, paid the said sum on 2nd July. So who will deduct TDS, who will collect TCS? See, Krishna is the buyer, Ashwath is the seller. But this is Krishna's first year of business. Therefore, last year's turnover of Krishna is 0. Therefore, Krishna will not be liable for 194Q because for 194Q, last year turnover has to be more than 10 crore rupees. And Krishna's last year turnover is 0 rupees. Therefore, Krishna, the buyer, is not liable to deduct TDS. Now, is the seller liable to collect TCS? Yes, definitely. Seller is selling the goods of more than 60 lakhs. It is sold on 30th June, but the amount is received on 2nd July. Again, I would like to ask you all, TCS is collected under 2061H when? On the date of debit or on the date of receipt? On the date of receipt. So on 2nd July, Ashwath will collect TCS on what? On 10 lakh rupees, 0.1%. You can check it over here. On 2nd July, TCS will be collected on what? On 10 lakh rupees. I hope it is clear to all of you. Now let's move on to the next case scenario number 9. Let's see what exactly is there in this particular case scenario. Here Mr. B is an interior decorator by profession. He delivers online lectures on interior decoration via e-commerce platform like what? Amazon. The name of the e-commerce platform is Indeco Limited, Indeco Academy. Now the relevant information from Mr. B's Indeco Academy account is given. Date of credit, date of payment, date of credit, date of payment, date of credit, date of payment. And in one of the transactions, the customers have directly paid to the seller, directly paid to be instead of via Indeco Academy. Sometime happens now, I am buyer, you are seller, and there is Amazon. I will directly pay to the seller. I will not pay to Amazon. So whether in that case also TDS under 194O is applicable? The answer is yes. This question is on 194O TDS. Let's read the question. Is Indeco Academy required to deduct tax on the amount received or receivable by Mr. B? If so, what is the amount of tax to be deducted? Let's see. Now, who is Indeco? Indeco is a e-commerce operator. Who is Mr. B? Mr. B is a seller. And how much he is selling through an e-commerce operator? First 2 lakhs, then 1,50,000, then 1,40,000. This comes to 4.9 lakhs. And then 20,000 directly. 20,000 directly. This comes to 5.1 lakh. So in case of individual and HUF, if the sale exceeds 5 lakh rupees, if the sale exceeds 5 lakh rupees, then this section is applicable, right? So in this case, because for individual and HUF under 194O, The government has given a relaxation up to 5 lakh rupees. No? So here the sale is exceeding 5 lakh rupees, therefore 194O is applicable. Therefore, Indeco Academy is liable to deduct TDS at the rate of 0.1% or 1%. Till 30th September it was 1%. From 1st October it is 0.1%. But one problem is there. The seller, that is Mr. B is not giving PAN or Aadhaar. Instead he is giving some driving license. Driving license is not a relevant document under income tax law. You have to give either PAN or Aadhaar. Now because he is not giving PAN and Aadhaar, he will not enjoy the relaxed rate of 1% or 0.1%. 1% till 30th September, and from 1st October it is 0.1%. Amendment has been made by Finance Act 24. So in this case, the Indeco has to deduct TDS at the rate of 5%. I hope it is clear to all of you. How much TDS they will deduct? 5%. Do you remember that or not? In case of 194O, if the PAN or Aadhaar is not given, then maximum 5%, it is not 20%. So 5 lakh 10 into 5% as the PAN is not given. Okay. Now, second, is Mr. N required to deduct tax at source under 194J? If so, what is the amount of tax to be deducted? Now, let's see what Mr. N is doing. Now, Mr. B provided interior decorator services to Mr. N. Now, Mr. N is an individual whose last year's turnover is more than 1 crore rupees. So, if your last year's turnover is more than 1 crore rupees, and if you are individual HUF, then 194J is applicable for you. But 194J is only applicable for business purpose, not for personal purpose. If you take any professional services for your personal use, then 194J is not applicable. So here, even though the last year turnover is more than 1 crore, you are making a payment of 40,000 and 60,000 for what? Official purpose and residential purpose. So whatever you are paying for official purpose, that will be subject to TDS at the rate of 10% because it is exceeding the threshold of 30,000, correct? But what you are paying for residential purpose, 194J is not applicable for residential purpose. Okay, I hope it is clear to all of you. Therefore, the TDS has to be deducted on 40,000, 10%, that is 4,000 rupees. So this is what this answer is all about. Okay. Let's move on to the next question. Is Mr. N required to deduct TDS under 194M? No, even 194M will not be applicable. See, if you don't come under 194J, then you can come under 194M. But under 194M, there is a very high threshold of 50 lakh rupees. And you are paying how much for personal purpose? Only 60,000 rupees. You are paying just 60,000 rupees for personal purpose. And the threshold mentioned over here is 50 lakh. Therefore, 194M is also not applicable. Okay. Now, next question. Is Mr. B required to deduct equalization levy on the amount payable to Tumble LLC or Doodle LLC? If so, what is the amount of levy to be deducted? Now, see. What is Mr. M doing? Mr. B doing whatever, whomsoever it is. Okay. First of all, he has paid 1,10,000 to Mr. B by Mr. B to Tumble LLC. 1,10,000 is paid to Tumble LLC. What is Tumble LLC doing? It's a social networking website. They do not have any permanent establishment in India. Okay. So you have to deduct TDS. So Tumble is a non-resident providing you some social networking website. Okay. You are making a payment of more than 1 lakh rupees. Tumble does not have a permanent establishment in India. You have to deduct TDS at the rate of 6%. Similarly, in case of Doodle also, you have to deduct TDS. Why? Because Doodle is providing you online advertisement. Doodle does not have any office relating to online advertisement. Doodle has office relating to some other activities, but not relating to online advertisement. You are making payment of more than 1 lakh to Doodle. And therefore, you have to deduct the equalization levy in case of 1,05,000 rupees also. So in case of both the transactions, you have to deduct equalization levy because it is more than 1 lakh. The other person is a non-resident. The other person does not have a permanent establishment relating to the service, and the payment is made by you who is a resident. Therefore, equalization levy is applicable over here. Check it, please. How much in case of first transaction? It is 6%, 6,600. In case of second transaction, it is 6,300. That is 1,05,000, 6%. Last but not least, what is Mr. B's gross income tax liability for previous year 24-25? Assuming he has opted out of the default regime. It means he is following the old regime. Now, first thing that Mr. B is earning is through Indeco Academy, 5,10,000 rupees. That we have already seen, correct? Apart from that, Mr. B is also doing some professional interior decoration business over here, 40 lakh rupees from there. Everything is earned from interior decoration only. Okay. This 40 lakhs. Plus, they are also earning from outside India. They have done some outside India also, some interior decoration, 3.5 lakh they have received after TDS of 50,000. Therefore, their net income will be, their gross income will be 4 lakh rupees. So they have also earned a revenue of 4 lakh rupees from there. So in all, they are earning from three places. 5,10,000 from a e-commerce operator, 40 lakhs directly from India, and 4 lakh rupees from where? From outside India. Total comes to 49,10,000. Now, because the assessee's nature of profession is interior decoration, it is eligible for about 44 ADA. Because the gross receipt is up to 50 lakhs, the assessee is eligible for 44 ADA, and as per 44 ADA, the deemed income will come to how much? 24 lakh 55,000, and on that, if I take tax as per old regime, then it comes to 5 lakh 70,960. As per old regime, up to 10 lakh it is 1 lakh 12,500, and about 10 lakh you have to apply 30% plus 4% cess. Okay, that comes to 5 lakh 70,960 rupees. So this is what this case scenario is all about. So let's go ahead with the next case scenario, that is case scenario 10, which is on transfer pricing 94B limitation of interest. Okay, now yeah, what is the first question over here? Let's see that. The first question is, what is the amount of interest to be allowed, not disallowed? What is the amount of interest to be allowed in computation of total income of UI Limited for AY 25-26 if for AY 24-25, that is last year, there was an interest expenditure disallowed to the extent of 4 crore under 94B. So what they are asking us how much interest will be allowed in the current year if in the last year 4 crore was disallowed under 94B. Now let's see what exactly is the structure. There is one company by the name called as UI Limited, which is in India. Now it has borrowed 50 crore from a company by the name called as MINC. You can check over here. At how much? At 9.5%, and the total borrowing is 65 crore. Now, they are there is another company HINC which is giving guarantee of this loan to MINC. Now listen carefully. Okay, pay attention please. So how much guarantee is given by them? It is given more than 10%. Okay. So if one enterprise gives a guarantee, total loan is 65 crore, out of which 50 crore guarantee this one entity is giving. So it is more than 10% obviously. So as per 92A, the definition of associate enterprise, if one enterprise gives more than 10% of the guarantee to another enterprise, then both of them are deemed to be associate enterprise. Yes. And now the loan is given by MINC, which is a third party, and the guarantee is given by associate enterprise. Therefore, this loan will be subject to 94B. Yes or no? This loan will be subject to what? 94B limitation of interest. So now we will see how much interest will be disallowed. For that, we need to find out first of all what is the EBITDA. The EBITDA is, the net profit is 8 crore after debiting interest, after debiting depreciation, and after debiting income tax. So I will add all of them. Therefore, I will get EBITDA of 18 crore rupees. Okay. How much EBITDA? EBITDA is 18 crore rupees, as you can see over here. If I add this, if I add this, I will get 18 crore rupees as EBITDA. Now, always remember, up to 30% of EBITDA is allowed to you. Yes or no? Up to 30% of EBITDA is allowed to you. Above 30% it is disallowed now. Therefore, 5.4 crore will be allowed to you. Okay. How 5.4 crore has come? 30% of 18 crore will be allowed to you. In this 5.4 crore, there is also the total 5.4 crore will be allowed to you. Okay. Yes. But the current year interest is only, pay attention, it's a tricky question. The current year interest is only 50 crore into 9.5 crore. Into 9.5%, sorry, that will come to 4.75. See, the cap is how much? The cap is 5.4 crore. You can get deduction up to 5.4 crore in the current year. But the actual interest which you are going to pay in the current year is 50 crore, 9.5%, that comes to 4.75 crore. Therefore, still you have a balance of 0.65 crore to exhaust. So therefore, out of the last year disallowance, sorry, out of the last year disallowance of 4 crore rupees, you can claim the balance 0.65 crore. And 4 crore minus 0.65 crore you will carry forward for the next few years, next 7 years. Okay. So how I have arrived at this amount? EBITDA is 18 crore, up to 30% it is allowed. So 5.4 crore, nobody can stop me. Out of 5.4 crore, 4.75 crore is the current year interest, and 0.65 crore is the last year brought forward interest. Plus you are also incurring some interest on local borrowing. So some local borrowing interest is 1.25 crore. That should also be added over here. Okay. That has nothing to do with 94B. Na? That is anyways allowed to you. So the local borrowing interest will also be allowed to you. So therefore, if I total all of them, the total interest comes to 6.65 crore rupees. That comes to this one, this point number A. I hope it is clear to all of you. Okay. I hope it is clear to all of you. Now, going to the next question. The transfer pricing adjustment for the arm's length price to be made in the computation of total income of UI Limited for AY 25-26 would be. Now let's see. UI Limited has imported an equipment of 30 crores from HINC. Import duty of 4.5 crore was paid and the equipment was sold to T Limited for 40 crores. The normal GP margin in an uncontrolled transaction is 20%. Now, we need to find out the transfer pricing of this particular transaction. Now here you are going to apply resale price method. Why? You are purchasing at 30 from associated enterprise. HINC is an associate enterprise. Yes, definitely. You are purchasing from associate enterprise and then reselling to third party. So you have to apply what? Resale price method over here. What is the first step in resale price method? Resale price method, first step is the resale price. At what price you are reselling? You are reselling at 40 crores. From that, what is the second step? You have to reduce the normal GP margin. Normal GP margin in an uncontrolled transaction is 20% in this question. That comes to 32 crore. Then you have to reduce your purchase related expenses like import duty, freight, purchase related expenses. You will reduce that 27.5 crore. Then there is a mistake over here. Your actual price is 30 crore and therefore the differential amount is how much? The differential amount is 2.5 crore rupees. This much amount will be added in transfer pricing. I hope it is clear to all of you. So how much will be added in transfer pricing? 2.5 crore will be added in transfer pricing. Okay. Now the third question. If UI Limited repatriated the excess money on 31st March 2026, what will be the interest income that would be added to its total income of AY 26-27? If SBI's 1 year's marginal of lending rate, marginal rate of lending, it should be, it should not be marginal of lending rate. It should be marginal rate of lending is 11.25% and 10.25%. Assume that UI Limited suo moto made the primary adjustment in this books of accounts and filed the return on 30th November 2025. Now listen carefully. What is the total? What will be the interest income that would be added? Pay attention, please. Now, what is the transfer pricing primary adjustment which has happened over here? The primary adjustment which has happened over here is 2.5 crore. Okay. Now, this 2.5 crore is done suo moto by the company on 30th November. Pay attention on the board. On 30th November, the company as suo moto does this. Okay. Now, it is the duty of the company to bring back this money within how much? Within 90 days from the due date of filing of return. But the company is bringing on what? On 31st March. So 90 days expires on 20th Feb 2026. The company is bringing on 31st March 2026. So they have to pay interest. Now up to 30th March. Up to 30th March they have to pay interest. So therefore 2.5 crore is the amount of deemed loan into. What will be the rate of interest? SBI's rate, MCLR, marginal cost of lending rate on the first day of the previous year. Which year the interest is getting charged? The interest is getting charged in 2025-26. Therefore, what is the first day of 2025-26? It is 1st April 2025-26. 11.25% plus 3.25% is 14.5% is the rate of interest. Multiplied by 121 days. From the due date of filing of return till 30th March. Why 30th March? Because on 31st March you have brought back the money. So, from due date of filing of return till 30th March, divide by 365. So, therefore, answer comes to what? The answer comes to, this is not correct, I am sorry for this. The answer comes to 120.1712 and this is the answer. I hope it is clear to all of you. Now, if UI Limited decides to not repatriate the money and instead pay the additional income tax on the entire money, then what they have to do? They have to pay 20.94664 tax, that's it. So 2.5 crore into additional tax, one time additional tax, then interest will not be charged after that. 20.9664% is the tax which you have to pay. So 2.5 crore into 20.9664 comes to 52,41,600. I hope it is clear to all of you. Now, if UI Limited decides to pay additional income tax on the entire excess money on 15th March, should interest be calculated? Yes. Now interest will be calculated from the due date of filing of return till 15th March. So now the interest will be calculated only till 15th March. So 2.5 crore into 14.5% into count from the due date of filing of return till 15th March. It comes to 105 days. Divide by 365 and the answer will change slightly. Okay. So this is what this question is all about. It's a beautiful question on transfer pricing. Okay. Now let's move on to the next case scenario, which is on 94B. What? Not 94B, 194N. TDS. When you withdraw money from bank or cooperative bank or post office, this case scenario is on that. Okay. Let's see. The amount of income tax that is required to be deducted by cooperative bank under 194N in respect of withdrawals by Mr. A and Mr. B are. Let's see what Mr. B has done. First of all, Mr. A regularly files the return. If he regularly files the return, for him the threshold for 194N will be 1 crore rupees. Okay. Now first he has withdrawn 20 lakhs, then 25 lakhs, then 35 lakhs, then 25 lakhs. Total he has withdrawn how much? 105 lakhs. He regularly files the return. Therefore, for him the threshold is what? Threshold is 100 lakhs. Therefore, in excess of 1 crore rupees, 2% TDS will be deducted in case of Mr. A. Now in case of Mr. B has not filed the return for the last 3 years. So if you have not filed the return for the last 3 years, the threshold is 20 lakh for you. So he has withdrawn 18 lakhs, 55 lakhs, 38 lakhs and 37 lakhs. Totally he has withdrawn 98 lakhs. Therefore, for him the threshold is 20 lakhs because he has not filed the return for the last 3 years. So about 20 lakhs up to 1 crore, it is 2%. Therefore, on 78 lakhs, 2% TDS will be deducted, 1,56,000 because he is not filing the return on time. Okay, I hope it is clear to all of you. Now, identify the accounts which are required to be reported in the SFT by the cooperative bank. So, the cooperative bank will report which transactions in the SFT. There are 2 transactions in this question, if you read the case study properly, which are to be reported. First, if you make a current account withdrawal of 50 lakh rupees or more, that transaction has to be reported. Who is making current account withdrawal of 50 lakhs or more? Mr. B. Therefore, Mr. B's transaction will be reported in SFT. Second, if you pay a credit card bill of 10 lakh rupees or more, that transaction has to be reported. So you can see over here, one of the customer of Mr. K has paid credit card bill of 15 lakh rupees by the account pay check. Therefore, this transaction has to be reported. Therefore, the transaction of K and transaction of B will be reported in this particular case. Is it clear? I hope it is clear. Third one, what is the amount of penalty leviable under 271 FA? What is 271 FA? 271 FA talks about if you don't file the SFT on time, there will be a penalty. Now, what is the due date for filing SFT? The due date for filing SFT is 31st May. If you don't file by 31st May, from 1st June, penalty of 500 rupees per day will be imposed. And once the officer send you a notice, and even after that you don't file, then the penalty of 1000 rupees per day will be imposed on you. So you can check over here, the government has issued notice on 30th September to file SFT. But the assessee failed to do. Okay. They have allowed them to file till 30th October. Assessee failed to do. Assessee filed on 25th of November. Therefore, from 1st June till 30th October, 500 rupees per day penalty will be imposed. And from 31st October till 25th of November, 1000 rupees penalty will be imposed because on 25th November, they have ultimately filed the report. Okay. They have ultimately filed the SFT. So this is how you are going to compute penalty in this particular case. You can check it over here. So from 1st June to 30th October, 500, and after that, for 26 days, you are going to pay penalty of 1000 rupees. Okay. And last but not least, this is also a very good question. Let us assume that on 26th of Feb, as a result of business reorganization of a cooperative bank, got succeeded by another cooperative bank, assuming that the deduction under 32 for 24-25 is 3,50,000 and the predecessor cooperative bank has incurred 30 lakh rupees during 22-23 on VRS. So how much deduction will be allowed to the predecessor cooperative bank? So, see, whenever there is an amalgamation of a cooperative bank with another cooperative bank, the provisions of 44BB are applicable. And the law says that whatever expense you have incurring in the form of depreciation or VRS, you have to apportion between both of them. In what ratio? In the ratio of number of days the companies were existing. So from 1st April to 1 day prior to the date of amalgamation, predecessor will get deduction, and from the date of amalgamation, successor will get the deduction. First of all, we will bifurcate into number of days. So from 1st April to 1 day prior to the amalgamation. Amalgamation happened on 26th of Feb. So from 1st April till 25th of Feb, there will be 331 days. How many days? 331 days. And from 26th Feb till 31st March, there will be 34 days. Now we will apportion between both of them. First, which expenditure is there? Depreciation. Depreciation will be divided between 3,50,000 into 331 divided by 365, and therefore the answer will come to 3,17,397. 3,17,000 will be allowed to predecessor and balance will be allowed to successor. Then VRS total is 30 lakhs. 30 lakh is not allowed in the current year. 30 lakh is incurred in 22-23, and we all know that VRS is allowed in 5 equal installments. Therefore, in the current year, how much VRS will be allowed? Only 6 lakh. So you have to apportion 6 lakh in the ratio of 334 is to 331 is to 34. I hope it is clear to all of you. 30 lakh is not the current year VRS. It is apportioned over 5 years, 6 lakh, 6 lakh, 6 lakh, 6 lakh, 6 lakh. So in the current year, 6 lakhs will be apportioned in the ratio of 331 is to 34. So if I do that, it will come to 544, 110, and therefore the total predecessor deduction will come to 861,507. You can check it over here. I hope it is clear to all of you. So let's move on to the next question, question number 12, which is also on transfer pricing only. Let me read the first question. Are X and Y associate enterprise? If so, why? What is the reason they are associate enterprise? Now they are associate enterprise because of 2 reasons. Let me tell you why. First of all, there is a person by the name called as Ayush who hold 30% in X and 30% in Y. So if I am Ayush and if I hold 30% in X and 30% in Y, then X and Y are obviously associate enterprise. There is no second thought about it. Okay. Now, the second reason why they both are associate enterprises, this is the balance sheet of X, okay? And Y has given a loan of 620 million. 620 million is 62 crores. And the total book value of assets of the X is 1200. So my total book value of asset is 1200 and you are giving me a loan of 620. Therefore, 620 divided by 1200 will come to 51.67%. So if one person finances 51% of the book value of assets of the another person, then both of them are deemed to be associate enterprise. Yes or no? So because of these two reasons, X and Y are associate enterprise. First is this 30%. Second is this because of 51% criteria. Okay. Now, second question. What is the amount of primary adjustment required to be made to the total income of X for AY 25-26? So how much primary adjustment has to be made? Now, listen carefully. Suppose I am X, you are Y. You have given me loan. You have given me loan of how much? 620 million. 620 million is 62 crores. Now, you have given me loan at what rate? You have given me loan at 6.5%. Whereas to others, you give at only 4%. Then why you are charging more from me? You are charging more expense from me, more interest from me. Therefore, the differential amount has to be added back as a primary adjustment. Therefore, 62 crores into 2.5% into 9 months, because the loan is given on 1st of July. Check here, please. Because the loan is given on 1st July, you have to charge interest for 9 months. That comes to 1,16,25,000 rupees. And this is the amount of primary adjustment that will be made by X in its total income. Okay, I hope it is clear to all of you. Now, fourth question. If X has accepted the primary adjustment made by the AO, what should X do if it does not want to treat the excess money as advance, deemed advance? So X has accepted this 1,16,25,000. Now he does not want to treat that as deemed advance. It means he does not want to get into all those secondary adjustment provisions. So he can do two things. First, he can bring back the money within 90 days from the date of order of the assessing officer. Why? Because the assessing officer has made the primary adjustment. Therefore, it has to be brought within 90 days from the date of assessing officer. If you suo moto make an adjustment, then you can bring within 90 days from the due date of filing of return. Be very careful. If assessee suo moto does an adjustment, primary adjustment, then 90 days is counted from the due date of filing of return. But if assessing officer does an adjustment in the assessment order, then 90 days counts from the date of assessment order. I hope it is clear to all of you. So what he can do to get escape from secondary adjustment, bring the money within 90 days. Or second option, one more option is there. Pay additional tax of 20.9664. Either of the things you do, you'll be escaped from what? You'll be escaped from the secondary adjustment. I hope it is clear to all of you. Next one. If X has accepted the primary adjustment made by the assessing officer on 31st March 2026 and the excess money has not been repatriated into India up to 31st March 2027, what would be the consequence? If X has not opted to pay additional tax also, assume SBI's 1 year lending rate is 10% on 26 and 11% on 27. So now we have to charge interest. See, the AO has done adjustment on 31st March 2026. That is the last day. Therefore, now you need to charge the secondary adjustment in the next year. Next year is which year? 26-27. The assessee has not brought back the money. Neither the assessee is ready to pay what? Ready to pay the additional tax. So now the assessee has to pay the interest for 26-27. For that, what is the amount of loan? Deemed loan. Deemed loan is 1,16,25,000 rupees. Okay. Multiply by. You have to take the SBI's marginal cost of lending rate on the first day of the previous year in which the interest is charged. So interest is charged in 26-27. Therefore, the first day of the previous year is 10% plus 3.25%. That comes to 13.25%. Into 12 months. For the entire year, you have to charge the interest because you are not bringing back the money. Therefore, the answer will come to 15,40,313 rupees. I hope it is clear to all of you. Is it clear? And last one is a theoretical question, nothing great as such. Which factor is relevant in determining whether the penalty under 270A of the Income Tax Act will be leviable in respect of primary adjustment to X total income? See, the only factor which is relevant is X has not reported the transaction as international transaction and X will be considered to have misreported the income. Therefore, he will be liable for 200% penalty. This is the only relevant factor. When penalty is imposed? If you do not report the transaction in the form 3CEB and that is considered to be what? That is considered to be a misreporting of income as per section 270A and 200% penalty will be imposed on you. Okay. And last but not least, in the case scenario given above, what would be the situation on account of application of transfer pricing provision? If X, the Indian company would have been a lender and Y, the US company would have been the borrower, then transfer pricing would not apply. Why, sir? See, very simple. If the lender is lending you at 6.5% and if the transfer pricing is saying that no, the interest rate is 4%. So now if I apply transfer pricing, the income will fall or not? Tell me. If I am giving a loan at 6.5% and the transfer pricing says that no, the rate of interest is 4%, then my interest income will fall, na? Yes, therefore transfer pricing provisions does not apply. Why? Because as per 92 subsection 3, transfer pricing provisions are not applicable if there is a reduction of income or if there is an increase in loss. Yes, in the reverse situation it was applicable. In the reverse situation it was applicable here. Here it was applicable. When X was borrower and Y was lender, it was applicable. Because there the matter was of expense. Here the matter is of income. Therefore, here the transfer pricing provision shall not apply. I hope it is clear to all of you. Let's move on to the next case scenario number 13, which is on partnership firm. Let's read the first question over here. How much interest can the firm claim as deduction for AY 25-26? Now, how much interest is allowed as a partnership as a deduction to the partnership firm as per section 40B? It is 12% per annum. Now, let's see how much interest they have given. They have given 5,40,000 as the actual interest, but out of that, if you see, 1,20,000 is paid to Gopal for giving loan by Gopal HUF. Who is Gopal? Gopal is one of the partner. Who is Gopal HUF? Gopal HUF is not a partner. So 1,20,000 rupees out of 5,40,000 is not given by a partner, but it is given by somebody else. It is other than partner. HUF is not the partner of a partnership firm. Therefore, this 1,20,000 will be directly allowed. It will be directly allowed. There is no harm in that. Now, how much is left after that? 4.2 lakhs. Now, there is some mistake in this 4.2 lakhs. There are two mistakes that the company has done. First mistake that the firm has done is they have paid 16% interest. That is wrong. They should have paid only 12% now. It means this 4,20,000 is computed as per 16%. Similarly, the partnership deed has mentioned about the payment of interest in the deed from 1st of Jan 2025. The clause regarding the deed, the clause regarding the payment of interest to the partners was mentioned in the deed on 1st Jan. But the firm is giving the interest from 1st of July. That is also wrong. So what we will do is, we will try to compute the capital of the firm first. Okay. See how I am going to compute the capital of the firm. 4,20,000 is the total interest paid by the firm. This is as per 16%. So, and this is for 9 months. It should be only for 3 months. So I'll do backward working and compute the capital of the firm first. 4,20,000 is the total interest paid by the firm. This interest is for 9 months. I want 12 months period. I want 12 months data. So I'm multiplying by 12 and dividing by 9. Okay. Then I'm dividing by 16% so that I can get my capital amount. Okay. Again, I will like to tell you how I have done. 4,20,000 is the interest. This is for 9 months. I want the interest for 12 months first of all. So I'm multiplying by 12, divide by 9. And then this is as per 16%. So I'm dividing by 16%. So I will get the capital amount. Now the capital amount is 35 lakhs. Now I will compute the correct interest. What is the correct interest allowed? 12%. Multiplied by, for how many months it will be allowed? You are mentioning in the deed from 1st Jan. So you will only get deduction for 3 months. Multiply by 3, divide by 12. Therefore this comes to 1,05,000. So 1,05,000 this plus 1,20,000 paid to the HUF of Gopal. Total of them will come to 2,25,000. That will be allowed as deduction. I hope it is clear to all of you. Okay. Now coming to the next question. How much salary can the firm claim as deduction for AY 25-26? So now we need to compute for salary. We need to compute book profit. Now how to compute book profit? You have to start with your net profit. Okay. Net profit you will start. Then you will add back the interest which is not allowed as deduction. Okay. So your book profit is 4,72,000. Then you will add back salary. First of all, whatever remuneration is debited to P&L, that you will add back. Then you will add back the entire interest and then you will reduce whatever interest is allowed as deduction. Okay, 5,40,000, add back entire interest and then reduce what is actually allowed as per 40B, that is 2,25,000. And then you will also reduce unabsorbed depreciation. Why, sir? Because while computing book profit, you have to compute book profit as per section 28 to 44. And when you compute book profit as per section 28 to 44, you have to reduce unabsorbed depreciation also. Unabsorbed depreciation is given in the question as 1,50,000 rupees. Sir, what about business loss, sir? Business loss should not be reduced while computing book profit because business loss is not computed between section 28 to 44. It is computed between section 70 to 80. Therefore, while computing the total income later on, you can reduce business loss. But right now you cannot reduce business loss. I hope it is clear to all of you. Therefore, my book profit is how much? My book profit is 10,95,000. Sorry, 15,25,000. Okay. Now, on that, I will apply what? I will apply this new amendment. Up to 6 lakhs, 90% of book profit. Or 3 lakh, above 6 lakhs, 60% of book profit. So this has been an amendment made by Finance Act 2024, as you all know. So the maximum amount is coming to 10,95,000. But what is the actual salary paid to the partners? See, out of the three partners, we will not consider Madhav because Madhav is a sleeping partner. You can check over here, Madhav is not actively engaged in the affair. Therefore, he is sleeping partner and remuneration paid to sleeping partner is not allowed. Therefore, we will only consider Jay and Gopal. So 30,000 into 12 plus 28,000 into 12 will come to how much? It will come to, check here, 6,96,000. The maximum amount was 10,95,000, but allowable salary, actual salary is only 696. Therefore, only 696 will be allowed in this particular question. Therefore, 696 is allowed as deduction. I hope it is clear to all of you. Is it clear? Okay. Now, question number 3. The business loss. This is a very good question. And unabsorbed depreciation to be set off while computing the income of the firm for AY 25-26 are as follows. Now, how much is the business loss of the firm? The business loss of the firm is 3 lakh rupees. But there is one problem over here. There was one partner in the last year, Mr. Jayesh, he died. And in place of him, there is a new partner, Mr. Jay came. Okay. So in place of Jayesh, Jay has filled the gap. So there will be no impact on the business loss. Okay. Because the provision says under section 78 that if a partner is dead or if a partner is retiring, then his proportionate loss should not be allowed as deduction. But in this case, Mr. Jayesh is died, but his place is getting filled by Mr. Jay immediately. So therefore, with respect to his loss, nothing will be lapsed because immediately the place is filled. What about one more partner? Another partner, Mr. Raj, also retired. Yes, his proportionate loss will be disallowed. So the total loss is 3 lakhs. There are 4 partners, therefore his proportionate loss will be 75,000. Therefore, his 75,000 will not be allowed. Only 2,25,000 will be allowed. Sir, because of the retirement of the partner, will there be any impact on the depreciation? No, no, no. The section 78 is only for losses. Section 78 is not for depreciation. Therefore, the unabsorbed depreciation of 1,50,000 will not be impacted. Therefore, in this question, the loss will be 2,25,000 and the unabsorbed depreciation will remain intact at 1,50,000. I hope it is clear to all of you. Check it, please. The loss is 225 and the unabsorbed depreciation will remain 1,50,000. Last but not least, it's a formality now. What would be the total income of the firm? See, we have already done everything. How to compute total income? Very simple. We have already reached till book profit. Yes, sir. We have already reached till book profit. So from book profit, reduce remuneration. What was the remuneration? 6,96,000 from here. Okay. Very simple. And then reduce loss because loss was not reduced while computing book profit. Unabsorbed depreciation already reduced. So don't reduce unabsorbed depreciation. Only reduce loss. How much was lost? 2,25,000. If I do this, I will get 6,04,000 as the answer. That's it. So this question is merely a formality. You can check it over here also. So book profit less remuneration less loss 6,04,000 is your answer. I hope it is clear to all of you. Next case scenario number 14. Let's talk about this case scenario now. In this case scenario, what is the first question? What would be the amount of disallowance, if any, of interest paid by X to Y in computation of total income of X for AY 25-26? Now let's see what is X and Y exactly. Y IMC is a foreign company and X holds 30% shares in Y and X is an Indian company. Therefore, X and Y are what? Are associated enterprise. There is no second thought about it. Okay. And you have to apply limitation of interest provision over here because they are asking about disallowance of interest. Okay. For limitation of interest, we want EBITDA. What is the EBITDA? The profit before interest, tax and depreciation is 6 crore rupees. Therefore, the EBITDA is 6 crore. And what is the interest paid by the SSE? The interest paid by the SSE is 6% of 50 crore. 6% of 50 crore comes to 3 crore rupees. So how much interest is disallowed as per 94B? It's a clear case of 94B. In 94B, interest is how much? 3 crore minus 30% of EBITDA. 30% of 6 crore comes to 1.2 crore. Okay. So 1.8 crore. Therefore, the difference comes to 1.2 crore. See properly. Interest 3 crore minus 30% of 1.8 crore will come to how much? 30% of 6 crore is 1.8 crore and therefore 3 crore minus 1.8 crore will come to 1.3 crore. And interest paid to associate enterprises 3 crore, whichever is lower, therefore 1.2 crore will be disallowed under the income tax law as per 94B. It's a very simple question. The previous question of 94B was much better. Now at what rate of tax will the income of X from manufacturing business and dividend be taxed assuming X opts for special provision of 115BAA. Ignore health and education cess and surcharge. Now, X is doing manufacturing, X is also earning some dividend income and X is following 115BAA. So in 115BAA, both these incomes are considered to be a general income and general incomes are taxed at 22% for all the above incomes. Okay. So both these incomes will be taxed at what? At 22%. I hope it is clear to all of you. Okay. Now, which of the statement is correct as regard taxability of royalty in the hands of X? Now, let's see what X has done in the form of royalty. X has registered a patent in India for treatment of virus, novel virus, which has developed in collaboration with Y. So X has done some collaboration with Y and developed some treatment for virus, and they have registered patent in India. 90% of the expenses are incurred in India in Uttar Pradesh, while the remaining has been incurred outside India. And from this, X has earned a royalty of 5 crore rupees. Total expenditure incurred is 42 lakh rupees. Now, remember, X is resident. We all know that X is resident. So if a resident develops something and makes a patent in India and more than 75% of the expenditure is incurred in India, then the provisions of 115 BBF will be applicable on royalty income. You have an option to follow 115 BBF. In 115 BBF, you can pay 10% tax flat, including surcharge and cess if applicable, without any deduction of expenses. Deduction of expense will not be allowed. So in this case, 115 BBF, this is the classic case of 115 BBF, which we have done in the chapter of MAT also. You can go and check over there. So this is a classic case of 115 BBF. This royalty will be taxable at 5 crore rupees at 10% under 115 BBF. This statement is absolutely correct. In 115 BBF, you don't get the deduction of expense. Therefore, I am not taking the deduction of expense here also. Okay. I hope it is clear. Now last, if X desires to avail the benefit of rate of taxation provided under 115BAA, then, so if he follows 115BAA, then he cannot claim additional depreciation. It is very clear. But he can claim 80JJAA. Therefore, answer number D is correct. So for people, for assessees who follow 115BAA, 80JJAA is allowed to them, 80M is allowed to them, but additional depreciation is not allowed to them. I hope it is clear to all of you. Now let's move on to the next case scenario number 15. This is a beautiful case scenario on 115JB and also on royalty FTS, also on MAT. Multiple things are there in this particular case scenario. In the context of the provisions of 115JB, which of the following statement is correct? Now I don't want to read the statement. Before that, I would like to explain you something. See, there is a company over here, DEF Inc., which is a foreign company. Now for foreign company, when MAT is not applicable, I am telling you when it is not applicable. So for foreign company, MAT is not applicable if the foreign company is located in a country with which India has DTAA, and at the same time, that foreign company does not have a permanent establishment in India. Listen carefully. So if the foreign company is located in a country with which India has a DTAA, but that foreign company does not have a permanent establishment in India, in that case, foreign company will not be liable for MAT. But unfortunately, in this case, DEF is located in foreign country, no doubt about it. India has DTAA with foreign country, but DEF has a branch in India. Therefore, whether MAT will be applicable to DEF or not, the answer is yes. And therefore, the answer to this question is DEF is a resident of a country with which India has DTAA, and the branch office of DEF constitutes permanent establishment. Because of this reason, the provisions of 115JB are applicable to DEF. I hope it is clear to all of you. Because of this reason, the provisions of 115JB are applicable to DEF. Is it clear, all of you? I hope it is clear to all of you. So this is your first question. Let me talk about the second question. What is the rate at which the fees for technical service received by DEF is chargeable to tax in India? Let's see how much they are earning fees for technical service. Fees for technical service of 75 lakhs from ABC Limited, an Indian company, in pursuance of an agreement approved by central government. Okay. So there is an agreement which is approved by central government. Therefore, the provisions of 115A is applicable. And as per 115A, what is the tax rate? It is 20% or DTAA, whichever is lower. Now, as per DTAA, the tax rate is 20%. Okay. And the fee for technical service is not connected with the branch office in India. It is not, there is no branch in India. Therefore, 100% 115A is applicable. If there would have been a branch in India, then 44DA would have been applicable. So this is a classic case of 115A. But which rate you will apply? DTAA rate or 115A rate? I will apply DTAA rate. Why? Because DTAA rate is final and conclusive. This is final 20%. And 115A rates will be subject to surcharge if applicable and cess always. Therefore, here the lower rate is DTAA rate. You have to apply as per DTAA rate. So to apply DTAA rate, if I apply 115A, then it will become 20.8%. 20% tax, 4% cess. Therefore, the tax rate in this case will be how much? The tax rate will be 20% flat on 75 lakh rupees. And this is as per what? This is as per DTAA, not as per 115A. I hope it is clear to all of you. Now, next question. In respect of sale of shares of Bottle Private Limited, state which of the following statement is correct. Now, When are you selling the shares of Bottle Private Limited? You are selling the shares of Bottle Private Limited on 15th of April 2024 for 2 crore 60 lakh rupees. It's a closely held company and it was purchased in 2004. Therefore, it is long term. Okay. Therefore, it is long term. And it was purchased in foreign currency. So before 23rd July, what was the provision? After 23rd July, the provisions have changed. So if a foreign company or non-resident is selling the shares of a closely held company, then the provisions, then the tax rate will be flat 10%. How much tax rate? 10% tax rate is applicable here. But without indexation and without first proviso to 48. What is first proviso to 48? Without doing the TTBR, TTSR. Even though they are purchasing the shares in foreign currency, you are not going to do TTBR and TTSR. Therefore, in this case, the shares will be taxable at 10% without indexation and without TTBR, TTSR. Check it please, because this is the provision as per section 112 before 23rd July, and after 23rd July, this rate has become 12.5%. That's the only difference. Okay. I hope it is clear to all of you. And the fourth question, which of the following statement is correct? Assuming that the rates specified in the DTAA are the same as provided under the Act. Now listen carefully, and this is a beautiful question. Do you remember? For foreign companies, on some income MAT is not applicable. On 5 incomes MAT is not applicable. For only for foreign company. Which are those 5 incomes? Capital gain on securities, royalty, FTS, dividend and interest. On these 5 incomes, foreign company is not liable to MAT, but there is a condition. Only if their normal tax rate is lower than MAT rate. It means only if their normal tax rate is less than 15%. The MAT rate is 15%. So if the normal rate is less than 15%, they are not liable for MAT. So in this question, wherever the normal rate is less than 15%, MAT will not be applicable. So in this question, whether on technical service, MAT will be applicable. The answer is yes, because the normal rate of technical service is more than 15%, it is 20%, therefore MAT will be applicable. On capital gains of sale of Bottle Limited shares, whether the MAT will be applicable. MAT will not be applicable in that case because the normal rate is less than 15%, it is just 10%. Therefore, MAT will not be applicable in that case. I hope it is clear to all of you. Is it clear? Therefore, only capital gains have to be reduced while computing the book profit. Why? Because capital gains is chargeable at 10%, which is less than 15%. Therefore, MAT will not be applicable. Therefore, you have to reduce from the book profit. What about technical service? Technical service is chargeable at more than 10%, 15%. It is chargeable at 20%. Therefore, MAT will be applicable. Do not reduce from the book profit. I hope it is clear to all of you. Let's go ahead with the next case scenario. It's a big case scenario, but it's a simple case scenario. They have given a very big story over here, okay, of the SSE. There are some expenses which are given over here with respect to the business of the SSE, and then they have given us the questions. Now, what is the very first question? Is Wellness Private Limited required to get its books of accounts audited under 44AB for AY 25-26? Now, what is the turnover of Wellness Private Limited? The turnover of Wellness Private Limited is 1.1 crore. Now, generally, if your turnover is more than 1 crore rupees, you have to get the books of accounts audited. Generally, that is the limit given under the law. Okay, we all know that. Okay, but for some people, the limit has been increased to 10 crore rupees. Now, who are those people? That is first of all only for business people, not for profession. For profession, this benefit is not available. Now, who are those people for whom the limit has been increased to 10 crore rupees? Let's talk about them. If your cash receipt is up to 5% of total receipts, and at the same time, your cash payment is up to 5% of total payment. Let's check if both the conditions are fulfilled. Then there is no need to do audit up to 10 crore rupees. Okay. Now let's check both the things. The turnover is 1.1 crore. The cash receipt over here, you can check over here, is 5.5 lakhs. So if I check the cash receipt divided by the turnover, so 5.5 lakhs divided by 1.1 crore comes to exact 5%. It does not exceed 5%. Therefore, this condition is fulfilled. Okay. The cash receipt does not exceed 5% of total receipts. Now let's talk about cash payment. What is the cash payment? The cash payment is, this is the cash payment, this is the cash payment. Okay. This is the cash payment. The total cash payment is 5 lakh 40 plus 70 plus 90. And if I make the total payment, this plus this plus this plus this, if I make the total, it comes to 70 lakh 84,500. So this is the total payment, and cash payment is 7 lakh rupees. Okay. There are 3 payments which are cash payment, and the total payment is 70 lakh 84,500. Therefore, the cash payment comes to 9.89%. Therefore, this condition is violated. Here, you are not within 5%. Therefore, you will not enjoy the benefit up to 10 crore. You have to get the books of accounts audited after 1 crore. I hope it is clear to all of you. Therefore, the answer to this question is Wellness Private Limited required to get its books of accounts audited? Yes, since the turnover is more than 1 crore. And since the cash payment is exceeding 5%. Cash receipt is not exceeding 5%. Cash payment is exceeding 5%, because of which he has to get his books of accounts audited. Okay. I hope this question is clear to all of you. Now, what is the amount to be disallowed for non-deduction of TDS while computing the PGBP income? So, because you have not deducted the TDS, okay. So, how much amount has to be disallowed? Let's check. They have made lot of payments over here. First of all, you are making payment of 35 lakh rupees to 20 professionals. So obviously you have to deduct TDS too if you make payment to professionals in excess of 30,000 rupees. So you are making 35 lakh rupees payment. So this will be subject to TDS disallowance. How much it will be disallowed? 30% will be disallowed. Okay. Then you are paying salary to staff of more than 8 lakh rupees. So if you are making a payment of more than 8 lakh rupees, therefore they are within the taxable limit. And if they are within the taxable limit, you have to deduct TDS. You have not deducted the TDS, therefore 30% will be disallowed for this also. Third one, you are making some wages payment of 15,000 rupees. So 15,000 is a small amount. So TDS will not be applicable. You are purchasing computer for computer, TDS is not applicable. You are making payment of interest to bank, SBI. So when you make a payment of interest to bank, TDS is not applicable as per 194A. Remember or not? If I take a loan from SBI and if I make a payment of interest to bank, then TDS is not applicable. Next, other expenses of less than 8,000 rupees, very small amount, TDS not applicable. Advance given to supplier, TDS not applicable. So the TDS is applicable only in the first two cases. So in the first two cases, the total payment is 60 lakhs, and on that 60 lakhs, how much TDS will be applicable? 30% will be disallowed, assuming that it is paid to resident. 30% of that comes to 18 lakh, and therefore the answer to this question is what? It is 18 lakh rupees. Is it clear, all of you? I hope it is clear to all of you. Okay. Now, what is the amount of depreciation allowable under section 32 subsection 1 for previous year 24-25 on the computer purchased? So for computer purchase, what is the amount of depreciation? See, first of all, you have purchased the computer for 3,50,000 rupees on 15th of May, but you have put to use from 15th of October. So for 6 months, you are not putting for use. You purchased on 15th of April, but you put to 15th of May, sorry, but you have put to use on 15th of October. For 6 months, you are not using it. You purchase it for 3.5 lakhs. So first of all, the cost of the computer is 3.5 lakhs. That I will write down. Okay. Now you have taken some loan to purchase this computer. You can check it over here. Interest for previous year on loan availed on 15th April from SBI for purchase of computer, 34,500. So you have taken a loan on 15th of April, but you have put to use the computer on 15th of October. So the interest from 15th of April till 15th of October has to be capitalized to the cost of asset. So the total interest is from 15th April to 31st March, 11.5 months. How many months interest it is? It is 11.5 months interest, out of which 6 months interest has to be capitalized. And 5.5 month interest you can take as a revenue expense. Okay. So I will divide this into 6 and 5.5. I hope it is clear to all of you. So 34,500 into 6 months. This much period will be capitalized. Divide by 11.5 months. Why 11.5 months? Because you are paying interest from 15th of April, not for the entire year. So 18,000 will be capitalized. So therefore the cost of the computer will be 3,50,000 purchase cost, 18,000 interest. Total cost is, actual cost is 368. Multiply by 40% rate of depreciation into 50%. Why 50%? Half depreciation, because you have put to use for less than 180 days. You have put to use on 15th of October, which is less than 180 days in a previous year. Therefore, you will get only 50% depreciation. I hope it is clear to all of you. Okay. Now, what is the total income of Wellness Private Limited for AY 25-26? Now, this is a very simple question. Yeah. See, the revenue of Wellness is 1 crore 10 lakh. We all know that. Now, out of remuneration and interest of 60 lakh rupees. Check. Total remuneration interest is 60 lakhs. 18 lakh is disallowed. Therefore, only 42 lakhs will be allowed. Correct? Then depreciation on computer. Just now we have computed 73,600 that you will claim as a deduction. Okay. Then the interest for the last 5.5 months is 16,500. How did I get that? Total interest is 34,500 and interest which is capitalized is 18,000. Therefore, post-use interest will come to 16,500. And then you are incurring some admin expenses of 70,000 rupees. You can claim that also as a deduction over here. Okay. Now, so you have claimed this as a deduction, but after disallowing 30%. You cannot claim this as a deduction because you are making payment of more than 10,000 rupees in cash. Okay. You have claimed depreciation as a deduction. You have claimed interest as a deduction. You have claimed this as also as a deduction because it is less than 10,000. You can pay in cash. Last one cannot be claimed as a deduction because that is an advance. That is not an expense. Okay. So if you do this, you will get the answer as 66,39,900 rupees. This is your total income. I hope it is clear to all of you. And last question, is any penalty imposable on the company for cash receipt from customer X. If yes, how much? Now see, you have sold some goods to customer X. Check it please. Of how much? 5,50,000 rupees. Dated 26th June. So if I'm selling you some goods of 5,50,000 rupees and I'm making a bill of 5,50,000 rupees, then I cannot receive even a single rupee in cash because the billing amount for a day is 2 lakhs or more. 269 ST will attract, 271 DA will attract. So the bill amount is of 2 lakhs or more, then I cannot receive cash in multiple days also. So that's the mistake that I'm making over here. I'm making a bill amount of more than 2 lakh rupees, more than equal to 2 lakhs. Exact 2 lakhs also not allowed. So the billing amount is 2 lakhs or more, and now I am receiving that 5,50,000 in 4 different days in cash. Not allowed. Entire 5,50,000 will be considered as a penalty as per section 271 DA. Check it please. I hope it is clear to all of you. Let's move on to the next case scenario, which is on section 45 subsection 2 of capital gains when you convert your capital asset into stock in trade. Okay. So pay absolute attention. It's a beautiful case study. Case scenario 17. Let's read the first question. What is the amount of capital gain chargeable to tax in the hands of Malika for AY 25-26? So first of all, we need to read the case studies little bit. Otherwise, I will not be able to explain you the scenario. Malika has purchased land in Pune for 50 lakhs in 2008 December, and till 30th September 2022, she was treating that as a capital asset. And from 1st October, she started her real estate business and she converted the land into stock in trade. Okay. So 1st October 2022 is the date on which she converted the land into stock in trade. Therefore, date will be considered to be the date of conversion. That date will be considered to be the date of transfer, and that date's FMB will be very important to us. FMB of land on that date will be considered to be very, very important to us to compute capital gains. Okay. Now, what she did on that land, she constructed 20 apartments of equal size, and the apartment was completed in December 2024. The cost of construction of one apartment was 15 lakh rupees, and then out of the 20 apartments, she sold 14 apartments at 40 lakh rupees in Jan 25 to Feb 25, and remaining 6 apartments. So 14, if she is selling 14 out of 20, it means she is selling 70% of the stock. So 70% of the stock is sold in 24-25, and remaining 6 were sold in 25-26 at 40 lakh rupees per annum. Okay. Now, further, she also has some penthouse. She has also invested in some bonds of NHAI, REC. We will talk about all of them in a while. Okay. Now, let me read the first question. What is the amount of capital gain chargeable to tax in the hands of Malika? See, how capital gains is charged? Capital gains is charged in the year in which you sell the SIT. So, first of all, FMB on the date of conversion is considered to be what? Is considered to be your full value of consideration. So, what is the FMB on the date of conversion? The FMB on the date of conversion is 3 crore rupees. So that will be your full value of consideration. Now, whether the asset is long term or short term, you will count till the date of conversion. So till 30th September 2022, you are going to count. It was purchased what? It was purchased long back. The land was purchased in 2008. Therefore, it is definitely long term. The period of holding will be counted till September 22. The indexation will also be available. Why, sir? Indexation is removed now? No. This property, this asset is transferred before 23rd July 2024. Therefore, the transfer date is 2022-23. So, therefore, the indexation will be available till 2022-23. Therefore, what is the cost of acquisition of the land? It is 50 lakhs. Multiplied by year of indexation, 22-23, you will multiply it by 331 and divide by 137. So, into 331 divided by 137. Why into 331? Because 331 is the year in which you are converting the land, and year of conversion is considered to be year of transfer, divided by year of purchase. Year of purchase, it is 137. Therefore, the long-term capital gains which is coming is 179,708. Now, this is the total capital gains of the assessee. Out of this, only 70% of the stock is sold in AY 25-26, because out of 20 flats, only 14 flats are sold in AY 25-26. Remaining 6 flats are sold in AY 26-27. Now, therefore, only 70% will be taxable. Therefore, 70% of 179 will come to 125,43,795. So, this is the taxable capital gains. But, one more catch is there. Now, what is the date on which it is transferred? The stock in trade is transferred in Jan 25 and Feb 25. Now, do you remember? Within 6 months from the date of this, if you invest in NHAI, REC bonds, then you are eligible for exemptions under 54 EC. See, generally exemption under 54 EC is available if you invest in the bonds within 6 months from the date of transfer. Now, the date of transfer has gone in 2022 because that is the year in which you have converted the capital asset. But there is a CBT circular which says that in case of conversion of capital asset into stock in trade, the 6 months period will be counted from the date of sale of SIT and not from the date of conversion. So the SIT is sold in Jan 25 and Feb 25 and you are investing 20 lakhs in NHAI bonds. On 31st March. So this will be eligible for deduction. Another 20 lakhs you are investing on 30th June. So this is also within 6 months. So this also you are eligible. Next 10 lakhs you are investing on 30th September. This is beyond 6 months. So this will not be eligible for deduction. The next 10 lakhs is invested in 31st December. This is also beyond 6 months. So that will also not be eligible. So the first 20 lakhs will be allowed. Therefore the total deduction exemption under 54EC will be 40 lakhs. And therefore the final answer will come to 85,43,796 rupees. So this is what this question is all about. Beautiful question. Question number 2. What is the amount of income chargeable to tax in the hands of Malika under PGBP? Now how much PGBP will be chargeable? See, 14 flats they have sold for 40 lakhs. So that is 5 crore 60 lakhs. What is the cost of land? The total cost of land will be considered to be the FMV of the land on the date of conversion. But I will take only 70%. Why? Because I am selling only 70% flats. I am not taking entire 100% flats. I am not selling entire 100% flat. So therefore the FMV of land will also be only 70%. So I will take 70% FMV of the land. What is the cost of construction of one flat? The cost of construction of one flat in the question you can see it is 15 lakhs. Into 14 flats will come to 2 crore 10 lakhs again. Therefore ultimately the answer will come to 1 crore 40 lakh rupees. How did I get this answer? Selling price minus the cost of land. The cost of land is nothing but the FMV of the land plus one more thing, the cost of construction. Okay, I hope it is clear to all of you. Now let's go ahead with the next year. Next year, how much capital gains and how much PGBP will be chargeable in AY 26-27? See, very simple. The total capital gains was how much? The total capital gains was 179,19708, out of which how much is chargeable in the last year? How much is chargeable in the last year? 125,43,795 is chargeable in the last year. See on the board. The total capital gains was 179. See on the board. Total capital gains was 179,19708, out of which 125,43,795 was chargeable in the last year. So the balance will be chargeable in the current year. That is 53,75,913. But from this also you can take what? 54EC exemption. So you are selling this 6 flats when the 6 flats see on the board are sold in April. So within 6 months from April you can, if you have invested in the bond, you can claim exemption. So this bond of 10 lakh rupees I have invested on 30th September. This comes within 6 months from April. The second bond is invested in December. This will not be eligible for exemption. So only this 10 lakh will be eligible for exemption. You can claim that 10 lakh as exemption and that will be your answer. Okay, I hope it is clear to all of you. Next one, PGBP also same. 240 lakhs, 6 flats into 40 lakhs per flat is the sale consideration. The FMV of the land is the balance amount. In the previous year it was 2 crore 10 lakhs, so now it will be 90 lakhs, and the cost of construction will be 15 lakh into 6 flats. So 15 lakh into 6 flats comes to 90 lakh rupees. So therefore the answer will come to 60 lakh rupees. So the PGBP is 60 lakhs and capital gains is 43,75,912. Okay, I hope it is clear to all of you. Is the annual value of penthouse held as stock in trade taxable? If so, under which head and what is the amount taxable for AY 25-26? Now let's come to the question. He has let out some penthouse to Mr. Harish for how much? For 60,000 per month. The municipal tax is paid by Harish. Who pays municipal tax? Tenant pays the municipal tax. So now the income from that will be chargeable under income from house property. Whether you hold a property as a capital asset or stock in trade, it doesn't matter. It is chargeable under income from house property only. Don't play emotional card over here by saying that the property is held as stock in trade. Doesn't matter. It will be considered to be what? It will be considered to be income from house property only. Okay, I hope it is clear to all of you. And let out of residential property is always house property. Finance Act 2024 amendment. Yes or no? If I let out a residential property, then it is always income from house property. The question of PGBP does not arise only. So now 60,000 into 12. 7,20,000 minus municipal tax deduction won't be allowed because it is not paid by the landlord. It is paid by the tenant, Mr. Harish. Therefore, only 30% standard deduction will be allowed here. Only 30% standard deduction you take. After that, the answer will come to 5,04,000 rupees. You can check it over here. Okay. I hope it is clear to all of you. 5,04,000 will be chargeable under income from house property. Last question over here. Is Mr. Harish liable to deduct tax at source on rent paid to Malika in financial year 25-26? If so, what is the amount of tax to be deducted and when? See, Mr. Harish is a salaried person, as you can see in the question. He is a salaried person and he is paying a rent of 60,000 rupees. Now, for salaried person, 194I is not applicable. 194I is not applicable because 194I is applicable to individual HF only if they do business and if the last year turnover is more than 1 crore or more than 50 lakhs. So for salaried person, 194 IB will be applicable. Why? Because the rent is more than 50,000 rupees. Therefore, the total rent is how much? 60,000 into 12, 7,20,000 into 2%. Because from 1st October, the rate has been reduced to 2% from 5%. Till 30th September, the rate was 5%. From 1st October, the rate is 2%. Therefore, 2% of 7,20,000 will come to how much? Will come to 14,400, and it will be payable in the month of March. Because in case of 194 IB, TDS is not payable every month. It is paid in the last month of the year. Or if the assessee, if the tenant vacates earlier, then in that case, you have to pay earlier. I hope it is clear to all of you. Is it clear? So this was a very, very good question. Okay. Now the next question is a very simple question on 10 AA, 35 AD, MAT, AMT, so on and so forth. Okay. Now, so let's read the question. Assuming PQR has fulfilled, PQR LLP has fulfilled all conditions specified for claim of deduction under 35 AD and has not claimed deduction under Chapter 6A. Under the heading C, deduction in respect of certain income. What is the quantum of deduction under 35 AD which is eligible to claim as deduction? Let's see. So PQR LLP has started with what? A new 3-star hotel. They have incurred 75 lakh on land, so that will not be allowed. Okay, 3-star hotel is covered under 35 AD. But if you purchase land, land is not allowed. Further, they have incurred 3 crore rupees as expense, out of which 1.25 crore is again on land. That is also not allowed. 1.75 crore on building, that will be allowed as deduction. So that is the only deduction that they are going to get. 1.75 crore. Therefore, the answer is 175 lakhs. I hope it is clear to all of you. Okay. Now, question number 2. Assuming that PQR LLP also has another existing business of running a 4-star hotel in Ahmedabad. Another hotel. This is 3-star. Another hotel of 4-star is there, which commenced operation 15 years back. The profit from that 4-star hotel is 130 lakhs. So can they set off the loss and profit here and there? Absolutely yes. One specified business can set off against another specified business. So the current business has a profit of 80 lakhs, as you can see over here. The current business has a profit of 80 lakhs and the deduction is how much? Deduction is 175 lakhs. Therefore, the loss will be 95 lakhs. Profit of 80 lakhs, deduction of 175 lakhs. Therefore, the loss of 95 lakhs. Can I set off this loss of 95 lakhs against this hotel? Against this hotel whose profit is 130 lakhs? The answer is yes. You can set off that. Therefore, ultimately, your taxable profit will come to 35 lakh rupees. I hope it is clear to all of you. Is it clear? Third one. If out of the amount of 1.25 crore paid for acquisition of land, 75 lakh was paid by cash, would the answer to MCQ 1 and 2 above? It will remain same only. Why, sir? See, you are purchasing a land of 1.25 crore. Is the deduction of land allowed to you? Not allowed. Na? Now, whether you pay by cash or whether you pay by online, it doesn't matter. Na? Anyways, deduction of land is not allowed under 3587. Therefore, the question whether it is paid in cash or whether it is paid by check or online or any other mode, it doesn't matter only. Because deduction of land is not allowed. Therefore, the answer will remain same only at 175 lakhs and 35 lakhs. I hope it is clear to all of you. Considering the assumption given in MCQ 2 above, what would be the tax payable by PQR LLP for AY 25-26? See, you have to answer as per MCQ 2. As per MCQ 2, what is the profit of the assessee? It is 35 lakhs. Therefore, now you have to follow two computation. One regular provision, one AMT. As per the regular provision, 35 lakhs into 30% tax plus 4% cess, you have to compute this. And as per AMT, you have to compute the adjusted total income. What is adjusted total income? It is total income, 35 lakhs plus 3580 deduction, 175 lakhs minus depreciation on that 3580 building. Yes, this is how you compute adjusted total income. So total income 35 lakhs plus 3580 deduction 175 lakhs minus depreciation on building, that is 17.5. Therefore, the total adjusted total income will come to how much? Will come to 192.5. Now you will compute AMT, 18.5% tax plus 12% surcharge. Why? Because the adjusted total income is more than 1 crore. So 12% surcharge plus 4% cess. And therefore, whichever is higher, that will be the answer. And therefore, the answer which is coming as 41,48,140 rupees, this is coming as a higher answer. This answer is higher, this answer is lower. Therefore, you have to pay tax as per 41,48,140. Last but not least, would Mr. P be eligible for deduction under 80 JJAA in AY 25-26? If so, what is the quantum of deduction? Let's see whether it is eligible for 80 JJAA or not. First of all, the assessee is engaged in manufacturing of apparel business. I have told you earlier also, if you are engaged in manufacturing of apparel business, leather business, footwear business, then 150 days is also sufficient. It is sufficient. 150 days is sufficient. 240 days are not required. Okay, this is very important. They are testing this again and again. Check. Secondly, the employee should participate in recognized provident fund. If an employee is not participating in recognized provident fund, then you are not eligible for ATJJAA. Thirdly, your emolument per month should not exceed 25,000 rupees. So first of all, the casual employees are not participating in recognized provident fund. So I will strike off the casual employees. Only regular employees are participating in recognized provident fund. Therefore, you will get deduction only for regular employees. You will not get deduction for casual employees. I hope it is clear to all of you. Now, for regular employees, you will get deduction even if it is for 150 days. So in the first case, it is 40 employees hired on October. So 6 months. So 24,000 into 6 into 40. That comes to 5,76,000. Second also 24,500 into 6 into 80. Third, you will not get. Fourth, 30 into 5 months. From November, will it be 150 days? Yes, 150 days will happen. Don't worry. From 1st November also, if you hire, it amounts to 151 days. So 30 into 5 months into 25,000. If I total these three and then I take 30% of that will be the deduction that is going to come over here, 63,81,000 rupees. I hope it is clear to all of you. Now let's start with the next case scenario 19, which is on 194Q, 206C1 and so on and so forth. So first question over here is, are provision of TDS or TCS under the Income Tax Act attracted in respect of purchase or sale transaction between Mr. Harshit and Mr. Pranav? If so, what is the quantum of tax deducted or collected for the previous year 24-25? Now let's talk about Harshit and Pranav. Now Harshit is a buyer. His last year turnover is 9.9 crore. And Pranav is a seller and his last year turnover is 10.10 crore. Now, if the buyer's last year turnover is not more than 10 crore, it is below 10 crore, then the buyer is not liable for 194Q. But yes, the seller's last year turnover is more than 10 crore, therefore the seller, Pranav, is liable for TCS. Now, when he will be liable for TCS? When the sale exceeds 50 lakh rupees. Now, the total sale is 80 lakhs. First 20 lakhs, no TCS. Why? Because it should exceed 50 lakhs. Next 25 lakhs also no TCS because it should exceed 50 lakhs. Now, third 20 lakhs, yes, on 18th October TCS will be applicable on 15 lakh rupees because up to 50 lakhs no TCS, above 50 lakh it is TCS. So, on 18th October 15 lakh TCS and on 11th Feb again 15 lakh TCS will be applicable. Check. So, on 18th October TCS will be applicable on 15 lakhs. On 11th Feb again TCS will be applicable on 15 lakhs. I hope it is clear to all of you. Okay. Now, in case of failure to furnish PAN, we have done similar question earlier also. In case of TCS under 206C1H, if the buyer does not give the PAN, then it is twice the rate or 1%, whichever is higher. Correct? So, it is twice the rate or 1%, whichever is higher. Therefore, the answer to this question will come to how much? 1%. Generally, if the buyer does not give TCS, it is twice the rate or 5%. But in case of 206C1H, it is twice the rate or 1%, whichever is higher. I hope it is clear to all of you. Okay. Now, all the questions that we have done in this particular case study are going to be is already repeated in some of the other case study in the previous 17 one. Is Thomas Cook required to collect tax at source on receipt of 5 lakhs from Mr. Pranav for holiday package to Singapore? Now, Mr. Pranav is going for some holiday, etc. See, Mr. Pranav paid 5 lakhs to Thomas Cook for a holiday package to Singapore for a week. So now we all know that if you go for a holiday package, then in case of overseas tour package and program, up to 7 lakh, the TCS is 5% and above 7 lakh, the TCS is 20%. There is no basic exemption limit in that. Therefore, on 5 lakhs, because it is below 7 lakhs, therefore 5% TCS will be applicable on this 5 lakh rupees. Okay. So the TCS will be 5% on 5 lakhs, which will come to 25,000 rupees. I hope it is clear to all of you. Now, what is the amount of tax to be collected from Pranav in respect of remittance towards overseas for his sons and daughters' education? Now, we all know that 206C1G. What happens in 1G? If you take a loan from a financial institution in India and then you send money outside India, then up to 7 lakh, no tax, above 7 lakh, 0.5%. And if you send money outside India for education out of your personal saving, then it is 5% above 7 lakh. But the limit of 7 lakh is aggregate for both of them. The loan case and the other case, both of them are aggregate 7 lakhs. The limit is aggregate for all the things. So now what he is doing? See, first of all, he is sending some money of 15 lakh rupees on 1st of Feb from a loan taken from SBI for his son's education in Columbia University. So on 1st Feb, he is taking a loan of 15 lakh and sending money. So if he is taking a loan and then sending money outside India, then up to 7 lakh, no tax. Above 7 lakh, that is on remaining 8 lakh rupees, 0.5%. Okay. So on remaining 8 lakh rupees, 0.5% will be applicable. Then he is sending some money of 12 lakh rupees for his daughter's education out of his personal saving 15 days after that, that is on 15th of Feb. So now you are not going to get again 7 lakh exemption because you have already exhausted 7 lakhs earlier. The limit of 7 lakh is per remitter point of view. It is not from the point of view of the bank. It is from the point of view of the sender, remitter. Therefore, this 7 lakh already exhausted earlier. Now you cannot claim. So now, but you are sending this money out of your personal saving. Therefore, on this 12 lakh rupees, you have to pay TCS of 5%. I hope it is clear to all of you. Here, you cannot get the relaxed rate of 0.5% because this is out of personal saving, not from loan. Okay. And one last question over here. Are TCS provision attracted in respect of remittance of gift to sister? If so, what is the amount of tax to be collected from Pranav? Now, Pranav is sending some gift to her sister on her 50th birthday outside India. How much money he is sending? Let's see. Mr. Pranav also remitted 6 lakh rupees out of his personal saving. So on 6 lakh rupees. Now we have already exhausted 7 lakh rupees. Now on this 6 lakh rupees, you are not going to get again exemption. Now this 6 lakh rupees you are sending is neither for medical, it is neither for education. So apart from medical and education, all other TCS are subject to 20%. So on this 6 lakh rupees, 20% TCS will be applicable because this is neither education, this is neither medical. Therefore, yes, 1,20,000 TCS will be applicable on this case. I hope it is clear to all of you. Okay. I hope it is clear. So this is what the simple question is all about. Let's go ahead with the next case scenario number 20. This is also a very simple case scenario on 3580 10AA MAT AMT. Okay. Now, what is the amount of deduction under 10AA and 3580 available to Ganga LLP while computing the income under the regular provisions of the Income Tax Act? Now, see, Ganga LLP was set up in 1920. They have set up a unit in SEZ in 1920. Now, this is which year? This is 24-25. Is it more than 5 years? Yes, it is more than 5 years. Therefore, Ganga LLP will be eligible for 50% deduction under 10AA. Is it clear? Because under 10AA, you get deduction only deduction of 100% for the first 5 years. From the 6th year onwards, you will get 50% deduction. Ganga LLP is eligible for 50% deduction because this is the 6th year of business. Now, how much deduction they will get? First of all, they have purchased under 3580. I will talk first and then I will talk about 10AA. They have purchased some warehouse for what? Storage of sugar. Yes, it is covered in 3580. What is the cost of the warehouse? 97 lakh. But out of which 32 lakhs is land. Land is not allowed as deduction. Therefore, only 65 lakhs will be allowed. So for 3580, 65 lakhs will be allowed. Okay. What about 10AA? For 10AA, what is the profit? Profit is 60 lakhs. Multiply by what is the export turnover? Export turnover is 1 crore 20 lakhs. What is the total turnover? Total turnover is 1 crore 20 plus 40. 1 crore 60 lakhs. So 60 into export turnover 120 divided by total turnover 160. This is the deduction, but you will get only 50% of that. Therefore, 22.5 lakhs will be the amount of deduction. I hope it is clear to all of you. Is it clear? I hope it is clear. Okay. Now, what is the tax liability of Ganga LLP under the regular provision? Now, under regular provision, let's compute the tax. See, the SEZ profit is 60 lakhs as you can see over here. And your 3580 profit is 160 lakhs. How much? 160 lakhs as you can see over here. Okay. So SEZ profit 60 lakhs, 3580 profit 160 lakhs. From that, you will get 3580 deduction 65 lakhs, which you have purchased in the form of warehouse. And 10AA deduction 22.5 lakhs. Therefore, your total income is 132.5 lakhs. On that, as per the regular provision, you will apply 30% tax for a partnership firm and LLP, 12% surcharge because the income is greater than 1 crore and 4% cess. Therefore, the answer will come to 46,30,080. I hope it is clear to all of you. Now, what is the alternate minimum tax payable by Ganga? Now, for alternate minimum tax, we need to compute the adjusted total income. How to compute adjusted total income? Check on the board. It is total income 132.5 lakhs plus deduction under 10AA plus deduction under 3580 minus depreciation on 3580 asset. So depreciation on that 3580 asset is your warehouse. So on warehouse is nothing but building. On that you will claim 10% depreciation. So after doing that, you will get your adjusted total income is 213.5. On that you will apply 18.5% tax, 12% surcharge because the income is more than 1 crore and 4% cess, and therefore your answer will come to 46,670. Next question, is there any AMT credit to be carried forward? See, no. The answer is no. Why? See, when AMT credit comes, when your AMT is more and your normal provision is less, AMT comes. But in this question, your AMT is less and your normal provision tax is more. You can check. The AMT is 46,670 and the normal provision is 30,000 more. 46,30,080. Therefore, the question of AMT credit does not arise only. I hope it is clear to all of you. Is it clear? I hope it is clear. Okay. And last but not least, what is the income to be declared by Mr. Ganesh for AY 25-26 under the head PGBP so that he makes maximum tax saving without getting his books of accounts audited? We have done similar question earlier also. Okay. Now Ganesh, what is the turnover of Ganesh? The turnover of Ganesh is doing business. And the turnover of Ganesh is 200 lakhs, out of which 190 lakhs is received by RTGS and NEFT, and 10 lakh is received by cash. As simple as that. 4480. 190 lakh is received by RTGS NEFT 6%, 10 lakh is received by cash 8%. Therefore, if he does not want to get his books of accounts audited, he has to follow 4480, and as per 4480, his income is 12.2 lakhs. I hope it is clear to all of you. Now let's go ahead with the next case scenario, that is case scenario number 21, which talks about tonnage taxation. Tonnage taxation is a small topic which is in your syllabus, which covers if you are an Indian shipping company and if you fulfill certain conditions, then you are eligible for tonnage taxation scheme. It's an optional scheme. Okay. So this question is based on that. Now, very first question over here is, the first question is the most important question of this particular case scenario. Rest of the questions are very simple. What would be the tonnage income of BMT shipping company computed under section 115 VG for AY 25-26? Now, you have to be very careful with this. Now, the tonnage taxation says that the income will be computed based on the weight of the vessel. Heavier the vessel, more will be the income. Lesser the vessel, that is lighter the vessel, less will be the income. And the tonnage taxation provision tells you the daily income. You have to multiply by number of days the ships are operated. So in this question, the BMT shipping company is an Indian company. Yes, tonnage taxation is only available to Indian company. Plus the poem should also be in India. The poem has to be in India. If the poem is not in India, then the provisions of tonnage taxation are not applicable to you. So yes, they are fulfilling all the conditions. Now, what is the weight of the vehicle? They have two vehicles. One is 33,840 ton and second one is 24,950 tons and 370 kg. And the first one is 230 kg extra. The first one is operated for 212 days and second one is operated for 347 days. Now, let's try to compute the deemed income of both of them one by one. Let's talk about the first one. The first one is 33,840 ton plus 230 kg. So first of all, you have to ignore the kgs. As per the provision of tonnage taxation, ignore kgs. Now what is left? What is left after that is 33,840 ton. Now, if the last two digit is less than 50, then you have to round off to the previous 100. And if the last two digit is more than 50, then you have to round off to the next 100. Now, because first of all you have to ignore kg, then you have to see the last two digits. The last two digits are less than 50. Therefore, this will become 33,800 tons. You have to convert this into this first. Okay. Now you have to compute the deemed income. Now, what is the deemed income? Your net weight is 33,800 ton. Now, the deemed income is for first 25,000 kg. For first 25,000 kg, it is 11,770 rupees. You can go and check the provision, open the textbook and check the provision in front of you. So for first 25,000 kg, it is 11,770 rupees. And after that, for every 100 ton, it is 88 rupees. It is 29 rupees. For every 100 ton, it is 29 rupees. So after 25,000 kg, till 33,800. 100 ton is coming how many times? Check. From after 25,000 ton, after 25,000 ton, till 33,800 ton. How many times 100 ton is coming? 100 ton is coming 88 times. So for every 100 ton, it is 29. Therefore, 29 into 88. 29 into 88, that will give you the answer. I hope it is clear to all of you. Okay. Now, what is the weight of the second vehicle? Let's see the weight of the second vehicle. The weight of the second vehicle is 24,952 and kgs and 370 kg. Kg has to be ignored. And if the last digit is more than 50, then you have to round off to the next digit. Therefore, 24,950 will become 25,000. Okay. I hope it is clear to all of you. Now, here, for the first 10,000 kg, that is for the first 10,000 ton, not kg, it is 5470 rupees. And after that, for every 110, it is 42 rupees. So 110 will come for how many times? It will come for 150 times. So 150 into 42. If you total these two, you will get the answer as 71,20,454 rupees. This is the correct answer as per question number 1. I hope it is clear to all of you. Okay. So it's a very simple question, nothing great. You have to remember the deemed income rates. Then you also have to multiply by number of days the ships were operating. In the first case, it will be multiplied by 212 days. In the second case, it will be multiplied by 347 days. Okay. I hope it is clear. Now, what would be the written down value on 1/4/2024 of qualifying ship of BMT for tax purpose as per section 115 VK? Now, see, they have given us some data over here that the WDV for tax purpose is 1200. Now 1200 is the WDV as per tax of all the vessels, out of which qualifying vessels are these two. Now this is the WDV as per the accounts. Therefore, as per accounts, the WDV of all the vessel is how much? 1080. Okay. So the WDV as per tax of all the three vehicle is 1200 and WDV as per accounts of all the three vehicle is 1080. Now, as per accounts, the WDV of the qualifying ship is how much? These two, 850. So as per accounts, the WDV of the qualifying ship is 850. Therefore, you will cross multiply. You will get the WDV as per tax also. As simple as that. Okay. So you have to cross multiply 1200 into 850 divided by 1080. Therefore, the answer will come to 944.44 rupees. I hope it is clear to all of you. Is it clear? I hope it is clear. Now, the next question. This is a very simple question. The minimum reserve requirement as per 115 VT is how much? So, see, any assessee who is following tonnage taxation scheme, they have to transfer 20% of their book profit to a tonnage taxation reserve account. Now, what is the book profit of this particular assessee? The book profit of this assessee is 100 lakhs. So, you have to transfer 20%. It means you have to transfer 20 lakhs. Okay. So, if you transfer 20 lakhs, you will enjoy this benefit. Otherwise, there is some deemed income provision which is going to come in the next question. Okay. So, you have to transfer 20 lakhs as per the provisions of 115 VT. Now, would any amount be taxable under other provisions of the Income Tax Act as per 115 VT? If BMT Shipping Company has transferred 15 lakh to tonnage taxation reserve during the previous year 24-25. Now, how much money they are supposed to transfer? 20 lakhs. Just now we have seen 20%. How much they have transferred? Only 15 lakhs. It means they have made a commitment of 75%. Out of 20 lakhs, they have transferred 15 lakhs properly. 75% it is correct, 25% it is incorrect. Therefore, whatever is the profit of that, 25% profit will be deemed to be income. So, what is the profit of the assessee? The profit of the assessee over here is from core activity it is 70 lakhs, from other activity it is 14 lakhs. Therefore, the total profit is 84 lakhs. If entire 20 lakhs would have been transferred now, then there would not have been any deemed income. But 25% there is a default. You are transferring 15 lakhs instead of 20 lakhs. Therefore, you are not transferring 5 lakhs. 5 lakhs is 25%. Therefore, 25% of your profits will be deemed to be income as per the provisions of tonnage taxation. And 25% of 84 lakhs comes to how much? It comes to 21 lakh rupees. 25% of 84 lakhs comes to 21 lakh rupees. 21 lakhs rupees will be chargeable to tax in your hands. I hope it is clear to all of you. Is it clear? I hope it is clear. Now, let's move on to the next question. Question number 5. What shall be the income computed under 44B? Now, this question has nothing to do with tonnage taxation. It is a provision. It is a question on provision of section 44B, non-resident shipping business. So, let's see. They have given us the data. There is a non-resident foreign company whose goods are shipped at port in India. If the goods are shipped at port in India, then all of them are taxable. You have to charge 7.5% as deemed income. Okay, 7.5% of this will be deemed income. But if the goods are shipped at port outside India, then only if it is received in India, it is taxable. If it is received outside India, it is not taxable. Because the goods are shipped at port outside India, then the income has to be received in India. So this first one will be taxable, second one will not be taxable. So if I total 200 plus 150 plus 180, it comes to 530. And for that 530, I will take 7.5% as deemed income. Therefore, the answer will come to 39.75 lakhs. I hope it is clear to all of you. Now let's go ahead with the next case scenario. Case scenario number 32. What is given in this question? What is the amount of interest allowable as deduction under section 24 to Mr. Sachdeva for AY 25-26? Now which interest is allowed under section 24? That talks about house property interest. So let's check whether the house property interest will be allowed as deduction to Mr. Sachdeva or not. So Mr. Sachdeva has bought a residential house for 4 crore at Worli, Mumbai, and he has let out the property to Mr. Akhil. On that, the interest due is 40 lakh rupees, out of which only 37 lakh is paid. Now listen carefully. In house property, first of all, in case of let out property, there is no limit of 2 lakh rupees. You can get the full amount of interest as deduction. Okay. The limit of 2 lakh is only for SOP. Secondly, in house property, interest is allowed on accrual basis. So out of 40 lakhs, only 37 lakh is paid, is of no use. Entire 40 lakh will be allowed as deduction on accrual basis, and fully it will be allowed because it is on a let out property, not on self-occupied property. Therefore, entire 40 lakhs will be allowed as deduction. I hope it is clear to all of you. Second question. What is the amount of deduction permissible under chapter 6A? Now, under chapter 6A, there are a lot of things he has invested in chapter 6A. Let me show you one by one. First of all, he has taken a property on let out. So he is paying the principal amount of the loan, which is around 50 lakhs, 30 lakhs and 5 lakhs. but he will only get deduction of how much? 80C, only 1.5 lakhs principal deduction will be allowed to you. Okay, this is the first thing that you can claim as a deduction. Second, he has also paid some loan interest for daughter's education. So 50,000 he has paid as an interest on loan to daughter's education, that he can claim under 80E. Third, he has paid 20,000 to insurance company for mediclaim, so he can claim that much under 80D also. Fourth, he has purchased some electric vehicle and the loan is sanctioned in 2022. So remember, if you are purchasing an electric vehicle and if the loan is sanctioned between April 2019 to March 2023, then you are eligible for a deduction of interest on loan of electric vehicle up to 1.5 lakhs. So you are paying an interest of 7 lakh rupees on electric vehicle and 5 lakh on petrol vehicle. Petrol vehicle you are not going to get any deduction. For electric vehicle you can claim 1.5 lakh rupees deduction. Therefore the total deduction, principal repayment 1 lakh 50, 80D 20, 80E 50,000 and 80EEB 1,50,000 rupees. So this is the total amount of deduction that you are going to get under income tax law, that is 3,70,000 rupees. I hope it is clear to all of you. Now next, is notional interest on interest-free deposit received in respect of shop let out on rent chargeable to income tax? If so, under which head of income? Now this is absolutely wrong by ICAI. Why? Because this is based on one case law of house property, and that case law has been removed by the ICAI from the study material, because house property chapter is removed from the study material. Now how the hell they can ask this particular question here? If that case law itself is removed because the chapter is removed, then why they can put how they can put this particular question over here? But nevertheless, I will explain you the reasoning of this. Suppose I am giving my property on let out to you, and I am taking some security deposit from you, which is interest free. Okay, I am taking some security deposit from you. So can the assessing officer charge notional interest on that deposit and take tax from me? The deposit is interest free. It is refundable. Can the assessing officer charge notional interest on that deposit and charge that as income from house property or income from other source? The answer is no. That is what it was written in that case law, which is removed by the ICAI from the study material. Nevertheless, next one. This is a good question. The assessing officer came to know about the transaction of sale of property at BKC Mumbai on 15 December 2024 and wants to hold Mr. David as agent of Mr. Ajay under section 163. Can he do so? If no, why? For that we need to know who can be called as an agent. As per section 163 of the Income Tax Act, listen carefully. If a non-resident sells any property in India to another non-resident, or if a non-resident sells any property in India to a resident, the seller is non-resident and the buyer can be resident or non-resident, and the property is transferred in India. In that case, the buyer can be treated as an agent. The buyer can be treated as an agent. It means the agent will be responsible for everything under the income tax law. The agent will be responsible for paying the taxes, to attend the scrutiny. The agent will be responsible for filing the income tax return, so on and so forth. So in this case, Mr. Sachdeva's brother, Mr. Ajay, who is a non-resident. So the seller is non-resident. The house is in Bandra Kurla Complex, Mumbai. The house is located in Mumbai, India. And it is selling to another non-resident, Mr. David. So Mr. David can be called as an agent or not? The answer is yes. Because the seller is non-resident agent, seller is non-resident, the buyer is also non-resident, and the property is located in India. Therefore, the buyer can be called as an agent. Therefore, Mr. David will be called as an agent in this particular case. I hope it is clear to all of you. And last one is also a beautiful question. In whose hands Raisha's rental income from house property would be taxable? Who is Raisha? Raisha is daughter of Sachdeva. Check. Now, Mr. Sachdeva, check on the board. Mr. Sachdeva has transferred a property to his minor daughter Raisha. Raisha is a minor daughter. Now generally if you transfer the property to your daughter, your income will be clubbed in your hands. But in this case, clubbing provision is not applicable. Why, sir? Because you are transferring immovable property to your minor daughter. Clubbing is not applicable. Here the concept of deemed owner is applicable. Clubbing is not applicable. Therefore, the income will be taxable in the hands of father only. Now they are giving you one data to confuse you, that the mother's income is more than father's income this year. Generally what happens in clubbing, whichever parent's income is higher, we club in that hand. But we don't do that particular exercise in deemed owner concept. Again, this question cannot be asked in the exam because the concept of deemed owner is removed by ICAI from the study material. Okay, they are not keeping house property chapter in your study material, but still they are asking the question on that. They are asking technical question on that. So why I am not putting this income in the hands of the mother, even though the mother's income is higher? Because this is not a concept of clubbing. I have to keep this in the hands of the father only, because in case of deemed owner, There is no concept of whomsoever's income is higher. That concept is applicable in case of what other than immovable property where clubbing provisions are applicable. Therefore, the income will be clubbed in the hands of Mr. Sachdeva only. Deemed owner is applicable. Clubbing is not applicable. I hope it is clear to all of you. Let's move on to the next case scenario. Case scenario number 23. Let's talk about this case scenario. Which of the following statement is correct in respect of loan of 10 lakh obtained by Mr. Rajat from XYZ Private Limited? Now, let's study the history of Rajat. What is happening in case of Rajat? Mr. Rajat holds 20% voting power in XYZ Private Limited, which is a closely held company. Now, if I hold 10% or more voting power in a closely held company, and if that company gives me a loan, then it is deemed dividend in my hands as per section 222E. But the deemed dividend cannot be more than accumulated reserves. So how much loan the company is giving me? 10 lakhs. What is the accumulated reserve? 8 lakhs. Therefore, the deemed dividend will be restricted to 8 lakhs. It cannot be 10 lakhs. I hope it is clear to all of you. Is it clear? Coming to next question. Would cash withdrawal by Mr. Rajat during the previous year 24-25 attract TDS? Let's see Rajat has withdrawn how much money and from where. So Rajat's data is given here. Mr. Rajat is here. He has withdrawn 1.2 crore rupees from the bank, from his current account. And he also withdraw 50 lakhs from another bank account from cooperative bank, and he regularly files the return. Now, because Mr. Rajat regularly files the return, for him, the limit of TDS is 1 crore rupees. Above 1 crore, 2% TDS will be deducted. Therefore, from the first bank, he has withdrawn 1.2 crore. So on this, on 20 lakh rupees, 2% TDS will be deducted by ABC Bank. But the second bank will not deduct TDS because from the second bank, he is not withdrawing more than 1 crore. Therefore, the TDS is not applicable in this case. Okay. So yes, 2% TDS on 20 lakh rupees. That's the only answer to this particular question. From the second bank, he will not deduct the TDS. Okay. The second bank will not deduct TDS. Now, would cash withdrawal by Mr. Rahul attract TDS? Let's see what Rahul has done over here. Rahul has not filed the return for the last 5 years. Now, if Rahul has not filed the return for the last 5 years, if for the last 3 years also, if Rahul has not filed the return, then the TDS limit will be 20 lakh rupees. So here Rahul is withdrawing 50 lakh rupees from a cooperative bank. So about 20 lakh rupees up to 1 crore, it is 2%, and above 1 crore, it is 5%. So here about 20 lakhs, how much amount he is withdrawing? He is withdrawing 30 lakh rupees. So on 30 lakh rupees, 2% will be applicable in this case. 30 lakh rupees, 2% will be applicable in this case. I hope it is clear to all of you. Now next question. What is the total income of Mr. Rajat? Assuming that he is shifted out of the default regime, it means he is following what? He is following old regime. He is following what? He is following old regime. So what is his total income? Let's see what all things will come in his total income. Okay. First of all, net profit of 60 lakhs will come in his total income. Yes. This is the first thing that will come. Second, dividend of 12 lakhs will also come because he has received some dividend from a private company. Okay. Third, he has some SOP, self-occupied property, on which interest payable is 2.5 lakhs, out of which interest paid is 1.8 lakhs. In SOP, you get a deduction of 2 lakh rupees, whether you pay or not. Even on accrual basis, you will get a deduction. Just now I told you, in house property, interest is allowed on accrual basis. Okay. Fourth, he has received some gift of jewelry from his friend, check, 5 lakh rupees. And fifth, he will be receiving some deemed dividend of 8 lakh rupees. So all of them total will come to what? Come to 83 lakh rupees. I'll show you how. Loss of house property 2 lakh rupees allowed on accrual basis, whether paid or not doesn't matter. 60 lakhs profit I have shown you. Dividend of 12 lakhs I have shown you. Gift from friend jewelry that I have shown you in excess of 50,000. If you take a gift, it is taxable. And deemed dividend 8 lakh rupees. Total 83 lakh rupees is the gross total income of Mr. whomsoever it is, Rajat, whatever it is. Okay, Mr. Rajat. And last question. What is the amount of gross tax liability if he shifts out of the default tax regime? It means again if he is following the old regime, what will be his tax liability? So his total income is 83 lakhs. So up to 10 lakhs, what is the tax as per old regime? It is 1,12,500. And above that directly 30% on 73 lakhs. Balance 73 lakhs, 30%. Plus 10% surcharge because the income is more than 50 lakh rupees. And 4% says, if you do this, your answer will come to 26 lakhs, 34,060. I hope it is clear to all of you. Let's go ahead with the next question. Question number 24 now. Is the action of assessing officer entering TR and hotels at 11:30 p.m. valid? Let's see what assessing officer has done at TR hotel. Assessing officer has surveyed TR and hotel which was within his jurisdiction at 11:30 p.m. on 15th August for the purpose of obtaining information which may be relevant for proceedings under the Act. Now, the restaurant is kept open every day from 11 a.m. to 12 midnight. Now, what happens? Generally, if you go for a survey, you have to enter the premise after sunrise, but you have to enter before sunset. Now in this case, for doing a survey, the assessing officer is entering the premise after sunset. He is entering when? At 11:30 p.m. He is entering after sunset. Can he enter? The answer is yes, he can enter, because the business hours are from 11 a.m. to 12 midnight. So he can enter in the business hours. There is no harm in that. Okay. But the problem is everything is correct. The time of entering, there is no issue in that. But the problem is he should have taken an approval from higher authority, from commissioner. That he has not done. That is the reason his action is not correct. So the answer to this question is it is not valid, since the prior permission of income tax authority equivalent to chief commissioner or above is not obtained by the assessing officer, though he entered during the hours at which the such place is kept open for the business. So the timing is not an issue. The issue is with respect to approval. I hope it is clear to all of you. Okay. Now, question number 2. Would your answer to MCQ 1 change if the AO had surveyed TR and hotel only for the purpose of verifying whether the tax has been deducted or collected at source? Now, if you can go and see the provisions of 133A, that is survey, in that there is one subsection 2, which says that the assessing officer can also enter a premise for the purpose of checking the TDS and TCS compliance. Now remember, now listen carefully. For the purpose of TDS and TCS compliance, it is not allowed to go after sunset. It is not allowed to go after sunset for the purpose of TDS and TCS compliance. Plus, approval should also be taken. Okay. Therefore, the action of the assessing officer is not valid since he entered after sunset. Here, it is not allowed. For TDS and TCS compliance, it is not allowed only to go after sunset. Yes, for doing a normal survey, you can go after sunset, but during the business hours. But for TDS and TCS, you cannot go after sunset. Okay, I hope it is clear to all of you. So he has done 2 mistakes. First of all, he has entered after sunset, plus he has not taken the permission of the higher authority. He has not done that also. Okay, I hope it is clear to all of you. Let's go ahead with the third question. Is the action of the assessing officer entering RR and hotel at 9:15 p.m. valid? Now, what is happening in RR and hotel? Let's see. On 25th of August 2024, the AO entered RR hotel, which was also within his jurisdiction, at 9:15 p.m. for the purpose of collecting information. So here the AO is exercising the powers given under section 133B, sorry. That is the power to collect information, which may be useful for the purpose of income tax. The restaurant is kept open for business every day from 7 a.m. to 10:30 p.m. First of all, under section 133B, that is the collection section, there is no need to enter after before sunset. There is no concept of sunrise, sunset in 133B. In 133B, you don't have to take approval also. There is no need to take any approval also in 133B. In 133B, you only have to enter during the business hours. So we need to check, is the assessee entering during the business hours? The assessee is entering at 9:15 p.m. The business hours is from 7 a.m. to 10:30 p.m. Therefore, the assessing officer is correct. There is no need to take approval here. There is no condition that you should enter before sunset. There is no need to take approval also. Therefore, it is valid since the AO entered during the hours at which such place is open for conduct of business. Prior permission of higher authority is not required to be obtained. In this case, there is no need to obtain any prior approval. I hope it is clear to all of you. Let's go ahead with the fourth one. Is the action of the assessing officer impounding and retaining in his custody books of accounts and other documents of TR hotel, that is the first hotel, after recording the reasons for doing so without taking the prior permission from the income tax authority equivalent to commissioner and above, valid? C. Assessee is impounding the books of accounts. Assessee is recording the reason, but assessee is not, AO is not taking the approval from the higher authority. It is not taking permission from the higher authority. Is the action valid? Let's see. That depends for how many days you are impounding. If you are impounding for 18 days, check. So the law says that if you are impounding for more than 15 days, then the AO has to do 2 things. First, he has to record the reasons. Which he has done properly. Second, he has to take an approval from commissioner. Prior permission from commissioner is mandatory. So in this case, because the assessee is not taking the prior permission from the commissioner, therefore it is not valid. Therefore, the action of the assessing officer is not valid since the prior approval of commissioner or above authority is not obtained in this case. Okay, I hope it is clear to all of you. And last question over here. Would your answer to MCQ 4 change if the AO had surveyed TR hotel only for the purpose of verifying TDS and TCS in accordance with the provision of Income Tax Act 1961? Again, the action of the assessing officer is not valid since he cannot impound only or retain books of accounts or other documents if he goes for TDS or TCS survey. So if he goes for TDS and TCS survey, he does not have the authority to impound books of accounts or other documents in that particular case. Okay. So this is what this question is. Very, very, very different from all other questions. It's a very, very unorthodox type of question which has been put by the ICAI over here. Okay. Now let's go ahead with the next question. Question number 25. It's a very simple question on penalty. First of all, for the purpose of answering this question alone, assume that the intimation under 143.1 was sent to element on 1st of Feb 2026. Would such intimation be valid? Now let's see, when was the return filed by the assessee? The return was filed by the assessee on 2nd December. So the intimation has to be sent within 9 months of the end of the financial year in which the return was furnished. So return was furnished in 24-25. So from the end of 24-25, 9 months time is there to send the intimation. So 9 months time expires when? It expires on 31st of December 2025. And when is the department sending the intimation? The department is sending the intimation on 1st of Feb 2026. What is the last date to send the intimation? 9 months from the end of the financial year in which the return was furnished. The last date to send the intimation is 31st December 2025, but the department is sending on 1st of Feb 2026. Therefore, it is not a valid intimation as it is sent after the expiry of 9 months from the end of the financial year in which the return was furnished. I hope it is clear to all of you. Second question. For the purpose of answering this question alone, assuming that in case of element LLP, certain other incomes which has escaped assessment and came to the assessing officer's notice subsequently in the course of reassessment were also assessed under 147, in respect of which provisions of 148A were not complied. Examine whether the action of the assessing officer is valid while making the reassessment order in respect of such income. See, there is a condition that before initiating section 147, the AO has to send an enquiry notice under 148A. Once enquiry notice is sent, then AO will send a 148 notice to file the return, and then the assessment will start. And after the assessment has started, later on, if assessing officer finds any subsequent income during the course of proceeding, the AO has the power to assess that also under the income tax law. So the question is, the income which has been found subsequently during the course of proceeding, for that also, is there a necessity to do inquiry under 148A? The answer is no. The inquiry under 148A is only supposed to be done before the assessment has started. Once the assessment has started, and if something has found later on as an escaped income, there is no need to do inquiry for that particular case. For those incomes, the AO can directly assess them under the provisions of section 147. Therefore, the action of the assessing officer is what? Is absolutely valid. There is nothing wrong in that. Okay. I hope it is clear to all of you. Now, the next two questions are very, very simple questions. Compute the amount of penalty leviable under 270A at the time of assessment under 143, assuming that underreporting is not on account of misreporting. Therefore, 50% penalty will be imposed. So now, at the time of assessment under 143.3, what was the income assessed? It was 35 lakhs. And what was the income processed? It was 22 lakhs. Therefore, income assessed minus processed will be considered to be underreported income. Therefore, underreported income is 13 lakhs. On that, we will apply tax. What is the tax for a partnership firm? This is an LLP. 31.2% tax you will apply, and on that 50% penalty you will impose. Very simple question, nothing great as such. Okay. Now, the fourth question. What is the amount of penalty leviable under 270A at the time of reassessment under 147? Assuming that it is a case of misreporting. Now, at the time of reassessment, how much was the income? At the time of reassessment, the income was 42 lakhs. And at the time of previously income assessed, it was 35 lakhs. Therefore, underreported income is 7 lakh rupees. So, on this 7 lakh rupees, you will apply tax of 31.2%. And on that, you will apply 200% penalty because it is a case of misreporting. I hope it is clear to all of you. Now, the last question. In continuation to MCQ 4, assume reassessment order was made under 147 and received on 12 December. Element does not prefer appeal against such order. Can element make application for grant of immunity from penalty? If yes, what is the time limit for making the application? They are talking about immunity under section 270AA. 270AA immunity is not possible in MCQ 4 because 270AA immunity can be given by the assessing officer only for the 50% penalty cases. It cannot be given for misreporting cases. Therefore, because in MCQ 4 it is a case of misreporting, therefore the doors of 270AA are closed for this particular assessee. Therefore, LM and LLP cannot make application. Reason I have mentioned over here. You can check it over here. I hope it is clear to all of you. Let's go ahead with the next case scenario. That is case scenario number 26, which is on taxation of trust. It's a beautiful case study on trust taxation. So let us read the first MCQ over here. Question number 1. Seva Niketan wants to avail exemption under 1023C, subclause 3AD and 1023C, subclause 3AE in respect of educational institution and hospital. For the previous year 24-25, can it do so? Now remember, if an institution is registered under 1023C, and if it is an educational institution or if it is an hospital, then the aggregate receipt from both of them should not exceed 5 crore rupees. If the aggregate receipt from both of them exceeds 5 crore rupees, then they will not be eligible to enjoy the exemption. Okay. Now, what is the aggregate receipt of this Kala Niketan? This Kala Niketan has a hospital and also has educational institution, and the aggregate receipt from education and hospital is greater than 5 crore rupees, as you can see over here. Now, because the aggregate receipt is greater than 5 crore rupees, Seva Niketan will not be eligible to enjoy exemption under 1023C. I hope it is clear to all of you. Is it clear? I hope it is clear. Now, second question. What is the amount of corpus donation received by the trust would not form part of total income? It means, in short, we need to answer how much corpus donation is exempt under the income tax law. So, remember, if a corpus donation is received by you, then it will become exempt if you invest in the mode specified in 11.5. Suppose if I receive 10 crore as corpus donation, if I want to make this exempt, I have to invest that in the mode specified in 11.5. So let's see how much corpus donation they have invested in the mode specified in 11.5. So corpus donation received during the year are invested as follows. 10 lakh rupees is invested in post office saving bank, so that is exempt. Then 5 lakh rupees is invested in fixed deposit, that is also exempt. And because these two are covered under 11.5, it is mentioned in the mode specified in 11.5. 10 lakh rupees is invested in NBFC. So this is not covered under 11.5. Okay. This is not covered under 11.5. So only the first two transactions are covered in 11.5, and therefore 15 lakh rupees will be exempt in this particular case. So the question is, how much donation will not form part of total income? It means how much donation will be exempt under the income tax law? It is 15 lakh rupees. I hope it is clear to all of you. Is it clear? Now, what would be the amount? This is one of the most important question of this particular case scenario. What would be the amount of specified income taxable under section 115 BBI at the rate of 30% for 24-25? See, under 115 BBI, there are 4 to 5 activities which the government has said you should not do. If you are engaged in any of the 4 to 5 activities, you will be eligible for 115 BBI and you will be liable for tax at the rate of flat 30%. Now let's see what all mistakes the assessee has done. First of all, the assessee has received 80 lakh rupees. Assessee has received a corpus donation of 55 lakh rupees. You can see on the board. The assessee has received a corpus donation of 55 lakh rupees for building, for purchase of building. Okay. Now, instead of purchasing the building, the assessee is purchasing computer out of it. So the assessee is using corpus donation to purchase computer. That is wrong. Therefore, the provisions of 115 BB will apply. It was given for building. It was not given for purchasing computer. Provisions of 115 BBI will apply. Okay. I hope it is clear to all of you. Second time when provisions of 115 BBI will apply, because you are investing in a mode other than 11.5, 10 lakh rupees in NBFC. So if you invest in a mode other than 11.5, you will be liable for what? 115 BBI. So 30 lakhs plus 10 lakhs. 40 lakhs comes under 115 BBI. One more item will come under 115 BBI. This last one. Seventh point. In the last year, you have accumulated some amount under 11.2 and you have made a promise that I will utilize this for the purpose of what? For the purpose specified. So last year in 23-24, you have accumulated 6 lakh rupees and you have made a promise that you will utilize this for the purpose of the trust. But you are giving this as a donation to another trust. This is a violation of 11.2. And this case is also, if you violate 11.2, then the provisions of 115 BBI will apply. 6 lakh rupees, this will also come. Therefore, in all, 46 lakhs will be chargeable under section 115 BBI. I hope it is clear to all of you. Is it clear? Now, question number 4. What amount would be considered as application of trust for the previous 24-25, excluding the unconditional exemption of 15%? So, apart from the 15% exemption, what all things will come under application? Assuming that it has fulfilled the relevant conditions stipulated under section 12A. Now, what all things will come under application? Let's see. First of all, he has purchased the computer of 80 lakh rupees. Can you see this? Now, but out of this 80 lakhs, 30 lakhs is from the corpus. So that will not be. If you use the corpus and use the corpus money to purchase an asset, that is not allowed as an application. Similarly, if you take a loan to purchase a computer, that is not allowed as an application. It is only allowed when the loan is repaid. Otherwise, it is not allowed. That too, it has to be repaid now within 5 years. So if you take a loan to purchase an asset, that is not allowed as an application. Yes. If you receive a voluntary donation and from that you purchase an asset, yes, that will be allowed as an application. So this 25 lakhs will be allowed as an application. Okay. Now, the second one is a very, very critical part. There is an amendment which was brought by the Government of India in 2021, Finance Act 2021, applicable from previous year 21-22 and applicable from 1st April 2021. There are two amendments which the government has made. First amendment, when a corpus donation is received, it will become exempt only if you invest in the mode specified in 11.5. Then when you withdraw that corpus donation, when you withdraw that money from the 11.5 and use it for the objects of the trust, okay, so that will not be considered as an application. Again, I am saying, in Finance Act 2021, two amendments have come. First amendment, suppose I receive 100 lakh rupees as corpus donation. If I want to make it exempt, I have to invest in the mode specified in 11.5. Suppose I invested in the mode specified in 11.5, 100 lakhs will be exempt. Now tomorrow, if I withdraw that 100 lakhs from 11.5 investment and I use it for the objects of the trust as an application, it is not considered as an application. Then in the next year, when I deposit back that 100 lakhs in the mode specified in 11.5, at that time it is considered as an application. So this amendment came in Finance Act 2021. One more amendment came in Finance Act 2021. That is, if you take a loan and repay that loan, if you take a loan and purchase an asset, it is not considered as an application unless and until you repay that loan. This amendment also came in Finance Act 2021. Now listen carefully. Point number 5. I have deposited back 15 lakh rupees. How much? 15 lakh rupees towards post office saving, which were utilized for purchase of building for previous year 2021 and previous year 21-22 out of corpus fund of 10 lakh and 5 lakh respectively. Now listen carefully. This 10 lakh pertains to previous year 2021, during which the amendment was not there. This 5 lakh pertain to 21-22 when the amendment came back. So the question of the deduction is available on depositing back the money in the mode specified in 11.5 from when? From Finance Act 2021. Before that it was not allowed. So this money is pertaining to prior to amendment. Therefore, this money, even if you deposit back today, it will not be allowed as deduction. Yes, this money 5 lakh, if you deposit back today, you will get the deduction. Therefore, you will get the deduction of this 5 lakh rupees. So first 25 lakhs you will get the deduction, which I have already told you. Then 5 lakhs you will get the deduction. And the third application is very simple. You are giving a donation of 10 lakh rupees, out of which 2 lakh rupees is corpus donation. So corpus donation is not allowed as a deduction. Only a normal voluntary donation is allowed as a deduction. Therefore, 8 lakh will be allowed as deduction. But in that also there is a catch. Only 85% of 8 lakh is allowed as deduction. We all know that. Yes or no? Only 85% of 8 lakh will be allowed as deduction to you. So 85% of 8 lakh will come to 6.8 lakhs, and therefore the total amount will come to 36.8 lakhs. This is the correct answer. I hope it is clear to all of you. And last but not least, Seva Niketan claims that anonymous donation received during financial year 24-25 are not liable to be taxed under 115 EBC. Is the claim correct? Is the anonymous donation exempt? It is absolutely wrong. Anonymous donation is taxable subject to some exemption. Now, how much anonymous donation you have received? You have received an anonymous donation of 20 lakhs. Now, from this 20 lakhs, you will get one deduction. Only one single deduction you are going to get. What is that one deduction? It is 1 lakh or 5% of total donation. The total donation in the question is 105 lakhs. Whichever is higher, that will be allowed as deduction. That's it. So 1 lakh or 5% of total donation will be allowed as deduction. So you can claim this much as deduction, and the balance will be taxable at 30% tax. Actually, it is not 30% tax. It has to be 31.2%. We need to include cess also now, but they are not including cess. So the only answer which is available with me is this only, this last one. This answer is actually wrong. It is not completely correct. There has to be an implication of cess also of 4%, which ICAI has not taken over here, which is wrong at their end. Okay, I hope it is clear to all of you. Let's move on to the next case scenario. This is a beautiful case scenario number 27. There are two persons over here. One is Mr. Sahil and Mr. Akhil. Both of them are sending some money outside India as a remittance under liberalized remittance scheme, and we need to find out the TCS applicability for both of them. Okay, so let's talk about the first question over here. First of all, is HDFC required to collect tax at source on the amount remitted by Sahil? If so, what is the amount of tax to be collected? Now, pay attention, please. First of all, I will list down all the transactions in the chronological order, in the order in which the transaction has happened. So the first transaction in case of Sahil has happened on 10th of May. Second transaction has happened on 1st of July. Third transaction has happened on 5th of July. Fourth transaction on 29th September. I am putting in the order of what? The date. Fifth transaction on 10th October, 11th October. Sixth transaction on 1st of Jan 2025. And the last transaction on 10th of Jan 2025. So this is the order in which the transactions have happened. Now I will read the question. Is HDFC required to collect tax at source on the amount remitted by Sahil? So remember, the 7 lakh exemption which is given by the government is from the perspective of per remitter. It is not separately for HDFC Bank and separately for Axis Bank. It is not like that. Mr. Sahil is remitting money from 2 different banks. So is it so that he will get 7 lakhs exemption from HDFC and then 7 lakh exemption from Axis also? No. It's a aggregate exemption available to him. So we need to go in the order. What is the first transaction? The first transaction is this. Okay. Now when the first transaction happened, it was only 1,20,000 rupees. Therefore, no TCS will apply because first 7 lakh is exempt. When did the second transaction happen? The second transaction happened through Axis Bank. So this is also just 1,50,000 rupees. So it is not exhausting 7 lakhs. So again, it is exempt. The third transaction is 3,50,000. Again, it is not crossing 7 lakhs. So it is exempt. But when the fourth transaction happened through HDFC Bank, okay, at that time, the total remittance is 7,10,000. You can check. Total it. 3,50,000 plus 1,20,000 plus 1,50,000 and plus 90,000. If you total it, it will come to 7,10,000. So now, when this fourth remittance is made, the amount is exceeding what? It is exceeding 7 lakh rupees. So now, on the excess amount, what is excess amount? The total is 7,10,000. Therefore, the excess amount is just 10,000 rupees. So now on this 10,000 rupees, 5% TCS will apply. Sir, why 5%? I am sending for education purpose, but you are not taking a loan from a financial institution in India, na? If you would have taken a loan from a financial institution in India and then you would have remitted, then it would have been just 0.5%. Here it is not 5%. Okay. So now HDFC Bank will deduct on 29 September 10,000 rupees, not 29 September, on 10th of May. Sorry, on 29 September, HDFC Bank will deduct TDS on 10,000 rupees, 5%. Let's check. 29,000, 10,000 rupees, 5% will come to 500. Now, when is the next remittance made to HDFC Bank? On 1st of Jan. So now already, obviously, the 7 lakh is exhausted. So on entire 1,35,000, 5% TCS will be deducted on 1st of Jan 2025. So that comes to how much? That comes to 6,750 on 1st of Jan 2025. I hope it is clear to all of you. Is it clear? So this is how you are going to compute the things. Now let's go ahead with the next question. Question number 2. Is Axis Bank required to collect TCS? If so, when? Let's see when Axis Bank is required to collect TCS. Okay. So now Axis Bank, when is Axis Bank going to collect TCS? Obviously, Axis Bank is going to collect TCS here on 10th of October. Axis Bank will not collect TCS on 1st of July because that time 7 lakh was not exhausted. But now on 11th of October, it will collect TCS and on 10th of Jan, it will collect TCS. It is towards again education and it is out of loan. So now Axis Bank will collect TCS only at the rate of 0.5%, because now you are remitting for education outside India and the amount is taken as a loan from a financial institution in India. I hope it is clear. That's the reason here it is only 0.5%. So Axis Bank 0.5% on 11th of October and 10th of Jan. I hope it is clear to all of you. Is it clear? I hope it is clear. Now, third question. This is a simple question. Is tax required to be collected at source on the amount remitted for tour package to USA by Mr. Sahil? Now, Mr. Sahil is sending how much money outside India? Mr. Sahil is sending outside India 5,20,000 rupees for a US tour. Now, we all know that if you take a service from a tour operator, that is overseas tour package and program, then up to 7 lakh it is 5% and above 7 lakh it is 20%. So here the limit is the amount is 5,20,000. On that 5%, flat TCS will be applicable. No exemption of 7 lakh is applicable for overseas tour package and program. I hope it is clear to all of you. Is it clear? Now next question. Does Make Your Trip required to collect tax at source on the amount received from tour package to Bali from Mr. Akhil? Now who is Mr. Akhil? Let's see. What is the residential status of Mr. Akhil? Mr. Akhil is a non-resident. How did you come to know, sir? Because he works in Dubai. He hardly comes to India for a few days. He works in Dubai 10-15 days. He comes to India. Therefore, he is a non-resident. Now, when he came to India, he booked a tour to Bali, Indonesia, for his wife and his son and for himself. So, if a non-resident visits India and books a tour through a tour operator, whether TCS under 2061G is applicable? And the answer is no. There is a separate relaxation for non-resident coming to India on a visit. Then, if a non-resident is coming to India on a visit, then the provision of 2061G are not applicable. I hope it is clear to all of you. Now, what is the total income of Mr. Akhil? Assume he has shifted out of the default regime. It means Akhil is following old regime. So we need to compute the total income of Akhil. Now, what all things will come in the Akhil's income? Akhil's income, Akhil is here. So Akhil is non-resident. Therefore, only income which is accrued in India and only income which is received in India will be taxable in case of Akhil. Rest of the incomes will not be taxable in the case of Akhil. So first of all, Akhil is earning some business income of 4,20,000 from a retail shop in India. Now, whatever salary he is earning from Dubai, that will not be taxable in India because that is accrued outside India, received outside India, and Akhil is a non-resident. Now, this business income will be taxable in India. This Canara Bank FD will be taxable in India, and then this saving bank interest will also be taxable in India. Now he is following the old regime. Old regime, 4,20,000 business income, Canara Bank interest and saving bank interest, and from saving bank interest he will get deduction of 80 TTA. Therefore, his total income as per the old regime, because we are following old regime, we can claim 80 TTA. Therefore, as per old regime, the income is 5,40,000. Last but not least, what would be the income amount of tax liability computed in the most beneficial manner? Whenever this sentence will come, it means you have to compute tax liability as per old regime as well as per the new regime also. You have to follow both the regimes. So in this case, as per the new regime, the income will increase to 5,48,000 because in new regime you will not get this deduction of 8,000 rupees. As per new regime, your income will be 5,48,000, and as per old regime, your income will remain 5,40,000. Compute the tax, whichever is more beneficial. The new regime is more beneficial because the answer is coming to 12,900. Sir, rebate will not be given. No. Akhil will not get rebate because Akhil is a non-resident. I hope it is clear to all of you. So let's move on with the next case scenario. It's a very small case scenario. Only 3 questions are there. It is also on penalty chapter 270A. 270A penalty is very important for exam. Be very careful. Which of the following statements regarding penalty on addition of 2,80,000 towards personal expenditure is correct? Now let me see the question first of all. Sharma Private Limited has filed the return with a loss of 18 lakhs. Okay. Then the tax auditor in his report has reported a disallowance of 2,80,000 towards personal expense. And then when the software processed the return, the software added back 2,80,000. So whether on this 2,80,000 which is added by software, whether penalty will be applicable on that 2,80,000 which is added by the software, the answer is no. Okay. And that is the reason, since the addition is an adjustment referred to in 143.1, because if a software add back anything, then penalty is not leviable on that particular item. Be very careful. Penalty is only leviable if the AO finds something in assessment and not if the software finds something. Okay, be very careful. Now, what is the amount of penalty leviable under 270A as a consequence of assessment under 147? If the addition was not on account of misreporting. So it is not a misreporting case, it's a not normal case of underreporting. So at the time of 147, how much was the income? The income was 3,20,000. And how much was the income previously assessed? Income previously assessed was 11,60,000 rupees loss. So your 11,60,000 rupees loss, be very careful, which was previously assessed under 143.3. So under 143.3 it was a loss of 1160, and under 147 it is an income of 320. Therefore underreported income is how much? Income reassessed, that is 3,20,000 minus negative 11,60,000 income previously assessed. So this negative will become positive. Therefore underreported income will come to 14,80,000 rupees. And the SSC is what? It's a private limited company. The tax rate of the SSC is 25%, as you can see over here. So I will apply 25% tax rate over here, and surcharge will not apply because income is just 14,80,000. 4% cess, that will come to 384,800. On that I will apply 50% penalty because it is not a case of misreporting. Therefore penalty will be only 50%. I hope it is clear to all of you. Now assuming that the additions made under 147 are not on account of misreporting. Okay, it is not a misreporting, but only on account of underreporting. S claims immunity from imposition of penalty under 270. So can S claim penalty imposition immunity from penalty? Yes. Immunity from penalty can be available only in 50% cases, not in 200% cases, as we have seen in one of the MCQs earlier. Therefore, in this case, you will get the immunity subject to some conditions. And initiation of proceedings under 276C by filing an application in this regard. What other conditions S has to satisfy? See, if he wants immunity, he has to fulfill certain conditions. First of all, he has to pay tax and interest within the time specified in the notice. This is the first thing that he has to do. Second thing he has to do is he should not appeal against the order of 147. Against 147 order, he cannot appeal. So if he pays tax and interest within the time period mentioned in the notice of demand, which is generally 30 days, and if he does not prefer an appeal against the assessment order, his immunity can be considered under 270 AA. I hope it is clear to all of you. Let's go ahead with the next case scenario, that is case scenario number 29, which talks about royalty FTS along with the implication of DTAA. Okay. Now let's read the first question. Is Trailer Limited India required to deduct tax at source on the payment made to Omega Inc? If yes, what amount of tax is required to be deducted at source on the said payment? Now let's read the question. Read the case study once and for all. First of all, Omega Inc is a foreign company. It is situated in country F. It maintains an online web platform through which it provides end user computer software through an end user license agreement. Now the Trailer Limited is an Indian company. Now Trailer Limited has entered into a contract of 6.7 crore with Omega, for which there is an agreement which is approved by central government. Now pay attention please. Omega is a foreign company and Trailer is in India. Now, therefore India is a source country and country F is a resident country. Okay, this is something that you need to understand. India is a source country because the royalty and FTS is getting accrued in India, and country F is what? It is a resident country. Now if you read the DTAA extract of article 12 over here, it is said that the royalty and fees for technical service arising in a contracting state. Where it is arising? It is arising in India. Arising in India and paid to a resident of other contracting state. So whom we are paying? We are paying to the resident of country F, may be taxed in that other state. So as per this paragraph of article 12, royalty and FTS will be taxable in country F. Therefore, as of now, you will not deduct TDS. Okay. Now let me read para 2 also. Okay. Did you understand what I said? It's a pure interpretation of DTAA. As per the DTAA, the royalty and FTS will be taxable in the country of residence. Which is the country of residence? Country F. Therefore, it will not be taxable in India. Okay. Now, as per para 2, however, such royalty may also be taxed in a contracting state in which they arise. So, as per para 2 now, it is saying that it may also be taxable in India, but subject to some condition. According to the laws of the contracting state, according to the laws of India. But if the recipient is the beneficial owner of the royalty or FTS, the tax or charge shall not exceed 10%. So now this paragraph is saying that the royalty may also be taxed in India, but only with one condition, that the tax rate in India should not be more than 10%. Now please tell me, what is the tax rate in India for a royalty and FTS? It is 20%. And what does this paragraph say? This paragraph para 2 says that it can be taxable in India if it is not more than 10%. Therefore, as per this para also, it cannot be taxed in India. Why? Because as per this para, the royalty is only going to be taxed in the source country if it is not taxed at more than 10%. But in reality, we all know that royalty is getting taxed at what? 20%. Therefore, by this paragraph also, it shall not be subject to tax in India. Therefore, the answer to first question is no. Trailer Limited is not required to deduct tax at source because of what? Because of the relaxation of DTAA. If DTAA would have not been there, then Trailer Limited would have to deduct the TDS in this case. DTAA is saving Omega Inc from tax and income tax law. How it is saying? Para 1 is saying it will be taxable in the resident country, that is country F. Para 2 is saying it may be taxed in India, but only if the tax rate is up to 10%. Because the tax rate is 20%, it cannot be taxed in India as per para 2 also. Therefore, Trailer Limited is not liable to deduct TDS because the income of Omega Inc is not liable to tax in India. Now, second question. Would Trailer Limited be required to deduct tax at source on the payment made to Omega if there was a DTAA, if there was no DTAA? Now, if there is no DTAA, then definitely you have to deduct TDS. Why, sir? Because then DTAA will not save Omega Inc. And you have to deduct the TDS. How much TDS? How much payment you are making? 6.7 crore. At what rate FTS is taxable? 20% plus 2% surcharge also, because the income is more than 1 crore of a foreign company and it is up to 10 crore. If the income is more than 1 crore and up to 10 crore, 2% surcharge is applicable. Plus 4% cess is also applicable. Therefore, the answer to this question will come to 1 crore 42 lakhs 14,720 rupees. I hope it is clear to all of you. Third question. What would be the tax liability of Omega Inc if there is no DTAA between India and country F and it incurred an expenditure of 20 lakhs for providing end user software to Trailer? The answer will remain same. If there is no DTAA, definitely it is taxable, same as question number 2. Plus, deduction of expenses are not allowed under 115A. We all know that under 115A, deduction of expenses are not allowed. 6.7 crore will be directly taxable at 20% plus 2% surcharge plus 4% cess. I hope it is clear to all of you. So they have twisted this with an extra point, that is, if we incur an expense of 20 lakh, what will happen? Nothing will happen. Expenses are not allowed under 115A. Okay. Now, would Omega INC be required to file the return of income for AY 25-26 if there is no DTAA between India and country F? See, if there is no DTAA between India and country F, okay, if there is no DTAA between India and country F, then what will happen? Then in that case, the Omega INC would be liable to tax at what? Would be liable to tax in India. Okay. And they will be paying tax as per what? As per 20% tax, 2% surcharge, 4% cess. That is as per the tax rate given under 115A. Now we all know that. What does 115A says? That if a foreign company earns FTS from India and only FTS from India, only royalty from India, and their TDS is deducted as per 115A, that is as per surcharge, cess, everything is deducted as per 115A. It is not deducted at a rate lower than 115A. It is deducted as per 115A, and they don't earn any other income. Then there is no need to file the return by the foreign company. Therefore, in this case, no, not required to file the return if the trailer limited deducted TDS on such income. So if the trailer limited will deduct the TDS properly, then Omega INC will not be liable to file the income tax return. And the TDS has to be deducted at what? Not at a rate lower than 115A. If the TDS is deducted at 15% or 18%, then return has to be filed. Now you have to be very careful. The relaxation from return filing is only if the TDS is deducted as per 115A. I hope it is clear to all of you. So this is what this beautiful question is all about. Let's move ahead with the next question. Next question is on non-resident taxation. So let me read the first line first of all. That will give us a lot of information about the question. The following information pertaining to Mr. Apurva. He is an Indian citizen and is a non-resident Indian. Therefore, there are high chances that the provisions of Chapter 2LA will apply over here. Special provision which is applicable to NRIs, non-resident Indian. Because Mr. Apurva is very clearly, we can see he is a non-resident Indian. He is an NRI. Who is an NRI? An Indian citizen who is a non-resident is called as NRI. Now let's see what all answers will come over here. What is the amount of dividend taxable in the hands of Mr. Apurva? And at what rate TDS is required to be deducted? See, Mr. Apurva is earning a dividend of 1,30,000 rupees. Okay. So this will be taxable at 20%, we all know. Okay. Because dividend in the hands of non-residents are taxable under 115A at 20% plus 4% cess. And the TDS will be deducted at 20.8% under section 195. Will I get any deduction of expense against the dividend? No. For non-residents, deduction of expenses are not allowed. For residents, it is allowed. Only interest expenses allowed up to 20% of your gross dividend. Only interest expenses allowed for residents. If Mr. Apurva would have been resident, he would have got deduction of interest expense up to 20% of the gross dividend. That is, what is the gross dividend? 1,30,000. What is 20% of 1,30,000? It is 26,000. Up to 26,000 he can claim deduction. But for non-resident, Mr. Apurva is a non-resident as of now. Just a second. My neck is paining. Mr. Apurva is a non-resident, and if he is earning dividend, it is flat taxable at 20% and 4% cess. Surcharge will not be applicable because the income is very less. Okay. Now what is second question? Assuming that Apurva is a resident, then how the things will change? If he is a resident, then his dividend income is 1,30,000. Okay. Now to earn this dividend of TPO Limited, okay, he has taken a loan in point number 3. You can check, and he has paid interest of 30,000 rupees. Can you see? Can you see? For TPO Limited, he has paid an interest of 30,000. So I have told you he will get now deduction of interest up to 20% of dividend. So 20% of dividend comes to how much? 26,000 rupees. So 26,000 rupees he can claim as a deduction. Okay. And balance will be taxable. Now TDS will be deducted under which section, at what rate? TDS will be deducted for resident. Dividend income is subject to TDS at the rate of 10% under section 194. For resident, it is 10%. And for non-resident, it is 20% plus surcharge if applicable and cess. I hope it is clear to all of you. Okay. Now, what is the amount of interest on debentures of SLP Private Limited taxable in the hands of Apurva, and at what rate? Now, let's see SLP Private Limited. Now, SLP is a private limited. Therefore, the Chapter 2LA provisions are not applicable. Why, sir? Because in Chapter 2LA, debentures of private companies are not covered. Therefore, this debenture will go under 115A. Chapter 2LA is not applicable for debentures of private company. Chapter 12A is not. Chapter 12A is applicable for debentures of public company, deposits of public company. Debentures and deposits of private company are not covered in Chapter 12A. Therefore, this particular interest which is earned, which is 1,35,000 rupees, this will go where? This will go under 115A. It will be taxable at 115A at how much rate? At 20% tax rate plus 4% cess. Okay. So 20% tax plus 4% cess. This will be subject to tax. They are saying that ignore surcharge and cess. So let's ignore surcharge and cess, directly talk about the tax rate. So 1,35,000 will be taxable at 20% flat. I hope it is clear to all of you. Okay. Now, fourth question is the most important question. What would be the amount of long-term capital gain in the hands of Apurva on sale of debentures of Fixed Limited? As per the provisions of Chapter 2LA now. Now, we need to follow the provisions of Chapter 2LA. Now, is the debentures of Fixed Limited covered? Fixed Limited is a public company, and public company debentures are covered under under Chapter 2LA. Therefore, here you will do the computation as per Chapter 2LA. Now, what is the sale consideration of the debenture? 18,25,000. What is the expense on transfer? It is 7,000 rupees. So 18,25,000 minus 7,000 will be your net consideration. Now, when have you sold this? You have sold on 15th of March. Now, within 6 months on the date of transfer, if you reinvest in the specified assets, then you can claim exemption under 115F. But you have to invest the entire net consideration. If you don't invest the entire net consideration, then only proportionate amount of capital gains will be exempt, not entire amount will be exempt. So here, it's a very simple question. So here 18,25,000 is your sale consideration, 7,000 is your expense, 18,18,000 is your net consideration. You have to invest in the specified assets, and listed company shares is covered in the specified assets. So you have to invest in the specified assets within 6 months. Now, how much you are investing? You are investing only 4.8 lakh. Therefore, proportionate exemption will be allowed. How much? Whatever is your gain, long-term capital gain is 13,53,000. Multiply by investment in new assets. How much you are investing in the new assets? 4.8 lakhs. Divided by net consideration. How much is your net consideration? 18,18,000. Therefore, this much will be exempt and balance will be subject to tax. I hope it is clear to all of you. Is it clear? I hope it is clear. Now, last question. Assuming for the purpose of this MCQ, Mr. Apurva is a resident. If Mr. Apurva is a resident, then what will happen? Then how this answer will change? Then how the answer of capital gains will change? Then it is very simple. You will not get this exemption. If this exemption is only for NRIs under Chapter 2LA, this benefit is not available to all non-residents also. This is only available to NRIs under Chapter 2LA. Therefore, if Mr. Apurva will become resident, then this benefit will not be available. Therefore, the capital gains will be 13,53,000 rupees. I hope it is clear to all of you. Let's go on to the next case scenario number 31. Such a beautiful and small case scenario. I hope all questions in the exams are of such a length. But always remember, if the question is small, there will be some great amount of twist inside that. Okay. Now, in respect of amount paid by Flax Private Limited for advertising services provided by Marshall INC, which of the following statements are correct? Let's see. Flax Private Limited availed online advertisement services by Marshall INC of USA. Assume that Marshall does not have a permanent establishment in India. Let's assume. Okay. We have to assume that Marshall does not have what? A permanent establishment in India. Now, it paid 10 lakh rupees and the outstanding amount, it paid 10 lakh and the outstanding amount was 2 lakh for the said online advertisement service. So listen carefully. Suppose I am Flex Private Limited, I am an Indian company, and there is a Marshall INC, which is a foreign company. That company, assuming that they don't have any permanent establishment in India, they are providing me online advertisement service. I am paying them 10 lakh rupees and 2 lakh is outstanding. Therefore, the total service availed by me is of 12 lakh rupees. So it's a classic case of equalization levy, and on entire 12 lakh, equalization levy is applied on accrual basis. The amount which is paid 10 lakh and amount which is accrued 2 lakh, entire 12 lakhs will be subject to equalization levy at the rate of 6%. You can check it over here. So entire 12 lakh will be subject to equalization levy of 6%. So 72,000 will be the answer. 6% of 12 lakhs comes to 72,000, and it has to be paid by whom? It has to be paid by the Indian company. I hope it is clear to all of you. Now, would Flax Private Limited be liable to pay interest and penalty if the amount of equalization levy is remitted on 20th June 2025? Now, let's see when this has to be paid. Now, this amount is paid and the amount outstanding is on 31st March 2025. Therefore, maximum it has to be paid by 7th of the following month. Now, they are paying when? They are paying in the month of June, after 3-4 months. Definitely, they will be liable for what? They will be liable for interest and penalty. Definitely. Yes, it would be liable to pay both interest and penalty. Because as per the provisions of the equalization levy has to be paid by 7th of the following month. If it is not paid by 7th of the following month, there is a charge of interest at the rate of 1% and penalty equivalent to the equalization levy, which is 72,000 rupees. Third question. Would Marshall INC require to deduct tax at source on amount paid to the consultant of USA? Now, let's see what is this transaction. Marshall INC, as we all know, is a foreign company. Okay. Marshall INC is a foreign company, as we all know, has taken technical services from another consultant of USA for expansion of one of its business units engaged in toys manufacturing in India. The consultant gave his report in USA and no part of the services were provided in India. The country does not have a DTAA with India. Now pay attention. Remember, if one NR is giving services to another NR, if one NR is giving services to another NR, that is in the nature of what? FTS or royalty, and that services are utilized in India for the purpose of business and profession, then that amount which is paid by the first NR to another NR, it is deemed to accrue or arise in India as per section 916 and 917. 916 and 917 very clearly says, if one NR pays royalty or FTS to another NR, and if the another NR use that services in India for the purpose of business and profession, then it is deemed to accrue or arise in India. Therefore, this transaction is deemed to accrue or arise in India in the hands of what? In the hands of the consultant from USA. Marshall INC has taken services from the consultant of USA, assuming that consultant is what? Assuming that consultant is what? Is an individual. Therefore, yes, TDS is to be deducted at 30% plus surcharge, if any, plus health and education cess under section 195. I hope it is clear to all of you. But sir, one line is given over here. The services were not provided in India. Yes, that line is of no use, because for interest, royalty and FTS, there is no need to provide the services in India. The only condition is the services should be utilized in India. Further, for royalty, FTS and interest, there is no need that the non-resident should have a place of business or business connection or any other presence in India. All these requirements are not required for non-residents to pay tax on royalty and FTS. I hope it is clear to all of you. So this is what this small case study is all about. Let's go ahead with the next case study. Case scenario number 32. And let's see the first question over here. How much tax to be deductible at source by T Private Limited on the fee for technical services paid to XYZ INC? Now let's see what T Private Limited has done over here. T Private Limited is an Indian company. It is an wholly owned subsidiary of Falcon Limited, paid 50 lakhs to XYZ INC of country M as fees for technical service. So T Private Limited has paid what? 50 lakh as what? 50 lakh as FTS to XYZ INC. Now the services were rendered by the employees of the branch of INC in India. There is no DTAA between India and country M. The T Private Limited has entered into certain international transactions during 23-24 and 24-25. Now we need to answer how much TDS will be applicable here. Now who is the service recipient? T Private Limited. Who is the service provider? XYZ INC. Now how much TDS will be applicable here? 115A is not applicable here. Why 115A is not applicable, sir? 115A is not applicable because the non-resident and the Indian resident does not have an agreement which is approved by central government. Therefore 115A is not applicable. Here even 44DA will not be applicable, because for 44DA also the non-resident and the Indian company should have what? Should have an agreement which is approved by central government. Here normal provision will apply. As per the normal provision, the tax rate will be for foreign company will be 35% plus 4% cess. Surcharge will not apply because the income does not exceed 1 crore rupees. I hope it is clear to all of you. Now how much dividend received by T Private Limited would be liable to tax for assessment year 25-26. Let's see how much dividend will be taxable. Now T Private Limited invested in SS Private Limited of country Y and received 550 lakh as dividend. How much dividend is received? 550 lakhs. Now this is received in 24-25. Now it declared dividend and distributed an interim dividend of 250 lakh on 10th of November 2024. Now listen carefully. This dividend of 550 lakh, this is which year income? This is current year income. And in the current year, you have distributed 250 lakh as dividend. Further, you have also distributed 230 lakhs as final dividend, but that has been distributed on 12th of November 2025. So now, how much is the dividend earned by you? The dividend earned by you is 550 lakh. How much is the dividend distributed by you within 1 month before the due date of filing of return? This amount is distributed, 250 lakh is distributed within 1 month from the due date of filing of return. Therefore, this will be allowed as deduction under ATM. This 230 lakh will not be allowed as deduction because the due date of filing of return is 31st October. You have to distribute by 30th September. You are distributing on 12th of November. Therefore, this provision is not applicable. Even if the due date of filing of return is 30th November, even if the due date of filing of return is 30th November, still you should distribute this by 31st October, 1 month prior to the due date of filing of return. Then only this amount would have been allowed. Therefore, in this case, only 250 lakhs will be allowed as deduction. 230 lakh will not be allowed as deduction. Okay, I hope it is clear to all of you. Next one. How much of the head office expense can be claimed by Indian branch of Falcon for assessment year 25-26? Now this is a case, very simple case of section 44C. Now as per 44C, if there is a foreign company or a non-resident who has a branch in India, then the Indian branch can claim some head office expenses. How much? It is 5% of adjusted total income or actual head office expense attributed to Indian branch, whichever is lower. Now adjusted total income they have directly given in the question, check. Otherwise, they have to compute adjusted total income. But fortunately, they have directly given us. Adjusted total income is 80 lakhs. So 5% of 80 lakhs or The head office expenses allocated to India, that is 18 lakh. Whichever is lower, that will be allowed as deduction. Check it, please. So 5% of adjusted total income, that is 5% of 80 lakhs, that is 4 lakhs, or actual head office expense, that is 18 lakhs. Whichever is lower, that will be allowed as deduction under the income tax law. I hope it is clear to all of you. Is it clear? I hope it is clear. Now, the fourth question. Can the income tax department prefer appeal before ITAT in respect of the complete relief obtained by Falcon from CIT appeal? Now see, if the income tax department wants to appeal in ITAT, then there is a monetary limit which has been changed. Earlier, the monetary limit was the tax effect has to be more than 50 lakhs. Now it has been more than 60 lakhs. Very recently in October 2024, they have changed the limit. I have told you in the class also. Okay. Later on, I have changed in the book also. I have told in the amendment video also. I have put a separate video also in your session. Okay. In your Google Drive also. For regular batch also and also for the exam oriented batch. Now listen carefully. So can the income tax department prefer an appeal before ITAT? They can prefer an appeal before ITAT if the tax effect is more than 60 lakh rupees. Now we need to see how much will be the tax effect in this case. So in this case, the undisclosed income is 90 lakhs. Now on this undisclosed income, if we compute the tax as per 115 BBE, because for undisclosed income 115 BBE is applicable, where 78% tax is applicable. So if I compute 78% of 90 lakh, it comes to somewhere around 70 lakhs something, 70.2 lakhs. Now because this 70.2 lakhs is greater than 60 lakhs, yes, therefore the income tax department has the right to appeal to whom? To ITAT in this particular case. Check it please. I hope it is clear to all of you. Let's move on to the next case scenario. Case scenario number 33. What is the first question over here? What is the amount of dividend income includable in the gross total income of A Limited for AY 25-26 under the provisions of Income Tax Act 1961? Now let's see how much income A Limited's gross total income will include. This is A Limited. It is an Indian company. It has invested in the shares of certain Indian and foreign companies. The details is as follows. Okay. Now, from the first company is an Indian company from which they are earning dividend of 2 lakh rupees. Now, they have also incurred some interest expense to earn that dividend. So how much interest is allowed? It is allowed to the extent of 20%. So therefore 20% will be allowed. Therefore 2 lakh minus 20% comes to how much? 1,60,000. In second case also 4 lakh minus 20% of the dividend. You will not get 90,000. You will get only 80,000 deduction. Therefore your taxable income will come to 3,20,000. I hope it is clear to all of you. Like that you have to do it for everyone. 6 lakhs is the income you are earning from foreign company, and from that you will earn 20% dividend. You will get deduction of 20%. You cannot get 1,30,000, you will get 1,20,000. Therefore this comes to 4,80,000. From 3,20,000 you will again get 20% deduction. Therefore 64,000 you will get deduction. Therefore this is 2,56,000. If I total all of them, that will be the taxable dividend which will be included in your total income, which is 12,16,000 rupees. You can check it over here. How much it is? It is 12,16,000 rupees. Okay. If you total all four of them, it comes to 12,16,000. Question number 2. What is the deduction allowable under ATM? Now, what does ATM allows you? ATM allows you to take deduction under of dividend received. Whatever dividend you have received, whatever dividend is included in the IFOS, compare with whatever dividend you have paid to your shareholder 1 month prior to the due date of filing of return, you can claim that as a deduction. Now, how much dividend is included in your total income? It is 12,16,000. Okay. And how much dividend you have paid 1 month prior to the due date of filing of return? See, you have paid 6 lakh rupees in June 24, plus you have paid 7 lakh rupees in July 25. Both of them are 1 month before the due date of filing of return. This 6 lakhs is in the same financial year 24-25, and this 7 lakhs is before the due date of filing of return, 1 month prior to the due date of filing of return. Therefore, the dividend distributed is 13 lakhs. But your actual dividend is how much? Only 12,16,000. Therefore, your deduction will be restricted to 12,16,000 rupees. Now, in the last year ICAI compilation, they have taken this answer as 13 lakhs, which was wrong, which I have told in the last year video also, that is wrong, that your deduction under ATM cannot be more than the income included in your total income. How much is your dividend income in your total income? It is 12,16,000. Now, you cannot claim more than 12,16,000 as a deduction under ATM, but in the last year ICAI has included ATM. I have told that is wrong. Now they have corrected. I think so they have seen our video of MCQ case scenario. All other teachers have said that is correct. But I said that no, that is not correct. That is wrong. So they have changed it to 12,16,000 now. I hope it is clear to all of you. Now, what is the tax liability rounded off of Mr. Akash under the provision of Income Tax Act if he wishes to make maximum tax saving? Now, whenever this sentence will come now, it means you have to compute as per both new as well as old regime. Now, let's see what Akash is earning, and first of all, let's see the residential status of Akash. Now, Akash and Arav are two brothers. Okay, first of all, we need to identify the residential status. Akash and Arav are two brothers. Both of them were born in India. Their parents and grandparents are also born in India. Akash is an Indian citizen and he lives in Hyderabad and he earns a salary of 1 lakh rupees. So Akash is in India only. He lives in India, he lives in Hyderabad. Therefore, his residential status is resident and ordinary resident. Therefore, for him, world income is taxable. Now, which all income Akash is earning? First of all, Akash is earning salary of 1 lakh rupees per month. 1 lakh rupees per month, which will make around 12 lakh rupees per annum. Okay. From that, you can claim standard deduction. Under the old regime, you will claim 50,000 standard deduction. Under new regime, you will claim 75,000 standard deduction. Apart from that, is Akash earning anything else? Akash is also earning some dividends. Dividends from where? Akash is also earning, Akash is earning some dividend in the current year. How much dividend he has earned in the current year? 60,000 he has earned in the current year, and this 70,000 he has earned in the next year. So ignore this 70,000, okay? Because this is declared in the next year, it is received in the next year, therefore it is taxable in the next year. But this 60,000 is taxable in the current year and Akash is resident. Therefore, Akash can get the deduction of interest expense also. Interest expense is allowed as deduction to residents. It is not allowed to non-residents. But Akash will not get 15,000. He will only get 20%. 20% of 60,000 amounts to how much? It amounts to 12,000. Therefore, Akash will claim 12,000 deduction. And therefore, the Akash dividend income will be 48,000. Now, let's compute the income of Akash. What is the income of Akash? Let's compute that. See, pay attention. First of all, I will compute as per the new regime. Then I will compute as per the old regime. As per the new regime, the salary of 12 lakhs minus 75,000 standard deduction, 11 lakh 25,000. And other source, that is dividend income of 48,000, which I have told you. 11 lakh 73,000 tax as per the provisions of new regime comes to 78,990 rupees. Now, if I do as per old regime, if I do as per what? Old regime, the only difference will be this will become 50,000 now. If this becomes 50,000, your income will increase by 25,000, correct? Because if you're reducing your deduction by 25,000, the income has to increase by 25,000. Therefore, now the income will increase by 25,000. If I increase the income by 25,000, it will become 11 lakh 98. On 11 lakh 98, I will compute the tax as per the old regime. Therefore, what is more beneficial? New is more beneficial. Therefore, Akash should go for the new regime because new regime is more beneficial. In new regime, the tax is coming 78,990 rupees. I hope it is clear to all of you. Now, let's talk about the next question. What is the residential status of Mr. Arav for AY 25-26? See, Arav is not staying in India, but Arav is also an Indian citizen. His parents, Arav is not Indian citizen also, okay? Arav is a citizen of country Y, check. Since many years, since 15 years, he is a citizen of country Y. But his parents were born in India, his grandparents were born in India. By that logic, Arav is a person of Indian origin, okay? Arav is what? Is a person of Indian origin. Therefore, for a person of Indian origin who comes to visit in India, okay? For a person of Indian origin who is coming to visit in India, every year, see, Arav comes to India for 4 months, okay? 4 months means approximately 120 days. So, if Arav is a person of Indian origin who comes to visit for India for 120 days or more, and if his Indian income is more than 15 lakh rupees, then Arav will be considered to be resident and not ordinary resident. But Arav's Indian income is not more than 15 lakh. It is 14 lakh rupees plus he is earning some dividend. He is earning some dividend. How much dividend he is earning? He is earning a dividend of 90,000 rupees from which he will not get any deduction. Okay, because he is a non-resident, so he will not get any deduction. And he is earning some other dividend which is taxable in the next year. So this will not be taxable. Just like Akash, this dividend also will be taxable in the next year. Therefore, Arav's total income from India is not exceeding 15 lakh rupees. Therefore, the residential status of Arav will be called as what? Non-resident. Okay, I hope it is clear to all of you. Therefore, Arav is a person of Indian origin. He is coming to India on a visit. Is Indian. If he is coming to India on a visit for less than 120 days, then definitely is non-resident. If he is coming to India for more than 120 days and up to 181 days, and if his total income from India is up to 15 lakh rupees, then also he will be what? He will be non-resident only. Now, last question. What is the tax liability of Mr. Arav under the provision of the Income Tax Act? Again, if he wishes to make maximum tax saving, ignore TDS. Arav also wants to make maximum tax saving, ignore TDS. Now, Arav is non-resident, that we have already computed. Now, what is the total income of Arav? See, Arav's only income which is accrued in India or received in India, that will be taxable. See, Arav is earning some share of profit from country Y. We are not interested in that because that is earned in the foreign country. Why will be interested in that? So, what is Arav doing? Arav is earning some FD, interest, 14 lakh rupees. And Arav is interest 90,000 rupees dividend. Okay, that's it. Deduction of interest will not be allowed against the dividend. So Arav is earning 14 lakhs plus 90,000, 14 lakh 90,000. Okay. Now this 14 lakh 90,000 will be subject to tax now. How? As per the old regime, as per the new regime, dividend will be subject to flat 20% tax for non-resident as per 115A. Dividend will be subject to flat 20% tax as per 115A, and the remaining other normal income will be subject to slab rates. Obviously, the new regime will be more beneficial. Therefore, Arav will go for what? Will go for new regime. in this question also. You can check it. Why? Obviously, the tax on 14 lakhs as per new regime will be far beneficial as compared to tax on 14 lakhs on new regime. And the dividend tax is anyway same only. Therefore, this is going to be far beneficial as compared to the old regime. Therefore, RO will go for what? RO will go for new regime. I hope it is clear to all of you. Let's move on to the next case study number 34. This is the best case study out of all the 35 case studies according to me. You have to be very careful with this case study. I am reading the case study once for you all, and then I'll be reading the question. This is one of the best. This is the best case study out of all the 35. Subhash is a retailer of car spare parts. He started his business in May 22. His turnover for 23-24 is 10.5 crore. He generally purchases goods from Car Accessories and Company only. Car Accessories and Company manufactures and sells spare parts directly to customer as well as through e-commerce platform carparts.com. Car Accessories last year turnover is 15 crore. The purchases information by Subhash is given here under date of credit, date of payment, value of spare parts without GST, GST and total value including GST. Apart from that, they are also making some purchase below. That's a standalone purchase. Okay, that we will talk about in the later MCQs. Now, is Mr. Subhash required to deduct tax at source in respect of purchase transactions made directly with Car Accessories and Company? If yes, when and what is the amount of tax to be deducted? Now listen carefully. Mr. Subhash is a buyer and Car Accessories is a seller. Buyer's last year turnover is more than 10 crore. Seller's last year turnover is also more than 10 crore. Therefore, if the buyer's last year turnover is also more than 10 crore and the seller's last year turnover is also more than 10 crore, in that case, the buyer has to deduct the TDS under 194Q. But there are few things that you have to keep it in mind under 194Q. Under 194Q, TDS is deducted on credit, see on the board, or payment, whichever is earlier. Okay. If a credit is earlier, then deduct on credit. If payment is earlier, then deduct on payment. Second, the TDS has to be deducted when the purchases exceeds 50 lakh rupees. Only then TDS is applicable. Third, if the credit is first, then TDS will be deducted on the amount excluding GST. And if the payment is first, then TDS will be deducted on the amount including GST. Be very careful, there is a CBT circular on this. If the credit is first, then TDS will be deducted on amount excluding GST. If the payment is first, credit is later, then TDS will be deducted on the amount including GST. You have to be very careful. So Subhash is liable for deducting TDS. Let's see the first transaction. What is first? Credit is first or payment is first? Credit is first. Payment is later. So you will check the amount excluding GST. The amount excluding GST is just 45 lakh. Therefore, no TDS now. No TDS is required by the buyer. Okay. Second transaction. What is first? Credit is first or payment is first? Credit is first. Therefore, now you will check again the amount excluding GST because the credit is first. Now, is the purchase exceeding 50 lakhs? Yes. How much it is exceeding? It is exceeding by 10 lakh rupees. So on 10 lakh rupees, 0.1% will be deducted on 18th of June 2024. Check it please. So 1000 on 18th of June 2024. Is everyone clear with this? I hope it is clear to all of you. Okay. Now, third one. What is first? Now in the third case, the payment is first. If the payment is first, then you have to deduct areas including GST. So now on this 0.1%. This will come to 2537. Okay. And the answer to this question is not C. The answer to this question is A. The ICAI has given a wrong answer. Really? Yes, ICAI has given wrong answer. The answer to this question is A. You can check in the answer also. You see, they have given option C, but the answer is 2537. Can you see this? They have given option C, but the answer is not 2100. It is 2537. Therefore, the answer is not C. The answer is actually A. I hope it is. Last year it was correct. Now this year they have made a mistake. So now the answer is A. It is not C. So according to A, we will go with the answer. In the last case, what is happening first? The credit is happening first. Because the credit is happening first, now you will deduct TDS on excluding GST. So 1050. Check it please. 1050 on 14th of Feb. This is how you are supposed to answer this particular question. Beautiful case study. There are multiple learnings out of this case study. That if the credit is first, then you will deduct TDS excluding GST. If the payment is first, then you will deduct TDS including GST. Okay. Now, is Car Accessory and Company? This question is also a beautiful question. First two questions are beautiful. Rest of the three questions are routine questions. Is Car Accessories and Company required to collect tax at source in respect of sale transaction with Mr. Subhash? If yes, when and what is the amount of tax to be collected? C. Between 194Q and 2061H. You will give priority to whom? TDS, not to TCS. But if TDS is not deducted, then the seller will collect TCS. And while collecting the TCS, you have to always include GST. Listen carefully. Between 194Q and 206C1H, you will give priority to TDS. But if TDS is not deducted, then the seller is liable to collect TCS. Now in this question, if you see the first transaction, is the buyer deducting TDS? The answer is no. Why? Because the amount is not exceeding threshold. Now think from the seller's perspective. For seller, the sale is of 53,10,000. Okay. And while collecting TCS, there is no question of whether GST will be included or not. GST will always be included in TCS. Therefore, the seller has to collect TCS now on what? On excess of 50 lakh rupees. What is excess of 50 lakh rupees? 3,10,000. So on this transaction, did you understand why on this transaction seller is collecting TCS? Because the buyer has not deducted the TDS, so seller is collecting TCS. The first priority will be given to buyer only, but buyer will not deduct because the threshold excluding TDS is not exceeding. But the seller has to collect TCS because for seller you don't have to consider excluding GST, you have to consider including GST. So the seller will collect TCS on 3,10,000, 0.1%. Now on rest of the transaction, the seller will not collect TCS because on rest of the transaction the buyer is anyways deducting the TDS. I hope it is clear to all of you. Because the next three transactions the buyer is deducting TDS, so seller is not liable to collect TCS. Seller is only liable to collect TCS on the first transaction, 310 rupees. On 3,10,000 rupees, he will collect 0.1%. That comes to how much? That comes to 310 rupees. I hope it is clear to all of you. I hope it is clear. Is it clear? Beautiful case study. Third question. Assume that Mr. Subhash has started the retail business of car spare parts in May 24. Assume that this is the first year of business. In such case, who is Subhash? Subhash is the buyer. Would the answer to MCQ 1 and 2 be different? Yes, obviously. If Subhash has started the business in the current year. Then in MCQ 1, okay, 194Q is not applicable. Then on all the transaction, the seller will collect TCS. In the first transaction, he will collect TCS on 3,10,000 rupees. So answer to this MCQ 1 will change to D. What is D? Sorry. If Subhash, sorry. Let me read the question again, once again. Assume that Subhash has started the retail business. Yes, if this is the first year of business of Subhash, then Subhash is not liable for TDS. Because in first year of business, the last year turnover is 0. And if your last year turnover is up to 10 crore, there is no need to deduct TDS under 194Q. What about second transaction? In second transaction, Subhash will be liable to collect TCS on all 4 transactions. See, earlier on second, third and fourth transaction, Subhash was not collecting, the seller was not collecting TCS. But now because the buyer is not deducting the TDS, so seller has to collect TCS on all 4 transactions. So let me show you now. The seller will collect TCS on all 4 transactions. On this also 3,10,000, on this also 17,17,000, on this also. But when? TCS is always collected on the date of payment. TCS is not collected on date of debit or receipt, whichever is earlier. So therefore the TCS will be collected on 2nd June, 30th June, 17th August and 28th Feb. You can check it over here. So answer to this will become B. So what is B? 2nd June, 30th June, 17th August and 28th Feb. That is on the date of receipt. Always remember 194Q is applicable on payment or credit, whichever is earlier. But 206C1H is always applicable on receipt. It is not applicable on accrual basis. I hope it is clear to all of you. Now the next question. Are the provisions of tax deduction and collection at source attracted in respect of transaction with car parts company? Who is carparts.com? Carparts.com is an e-commerce operator. If yes, who has to deduct TDS or TCS at what rate? Now let's see what car parts has done. Okay. In addition to above, Mr. Subhash also purchased spare parts of car accessories for 12 lakhs, including GST of 18%. Through carparts.com on 31st December. The payment was made directly to Car Accessories and Company on 15th of Jan. PAN is duly furnished by Subhash. Car Accessories and Companies.com. The GST portion is indicated separately in the invoice, but it is not shown separately when the goods are purchased through carparts.com. Now listen carefully. Now I am buyer, you are seller, and there is an e-commerce operator. Now do you remember that if I buy goods from you through an e-commerce operator, then 194O will prevail over 194Q. Remember or not? Again I am saying, I am buyer, you are seller. If I buy goods from you, through an e-commerce operator, then the liability to deduct TDS is on e-commerce operator. Generally, e-commerce operator will deduct TDS excluding GST. But here the e-commerce operator has to deduct TDS including GST because the breakup is not given in the invoice check. And therefore they will deduct TDS at the rate of 0.1%. Why? Because the purchase is made after 1st October till 30th September. The rate of TDS under 194 was 1%. From 1st October the rate has been reduced to 0.1%. Therefore, multiple reasons I am giving you all together. Car parts will deduct TDS because 194O will override 194Q. You can go and check the provisions of 194Q in our book. It will deduct TDS including GST because GST breakup is not given. And it will deduct TDS at 1% because the purchase is made on or after 1st October 2024 till 30th September the rate was 10%. The rate was 1%. From 1st October the rate has become 0.1%. So beautifully ICAI has what? Made this case study. And last question of this case study. If Mr. Subhash has not furnished the PAN, then what will happen? But has furnished his Aadhaar. So that's okay. Instead of PAN you can furnish Aadhaar these days. It's okay. PAN and Aadhaar are interchangeable documents provided it has to be linked. It has to be linked. So if you are giving Aadhaar instead of PAN, it's all okay. Your TDS will remain at what? Your TDS and TCS will remain at 0.1%. Nobody will change your TDS and TCS. I hope it is clear to all of you. So let's move on to the last case study given by the ICAI, that is case scenario number 35. In respect of, it's a very simple case study now. In respect of payment made by NICE Limited for advertising services provided by Trio Inc. Which of the following statements are correct? Let's see what NICE Limited is. What Trio Inc. is doing. Whenever the word advertising will come, obviously there has to be some implication of equalization levy. Now Trio Inc. is a company incorporated in country T. It is engaged in manufacturing of computer hardware. It also owns online social networking site Attire. NICE Limited is an Indian company. It imports computer hardware from Trio Inc. Now during the previous year 24-25, it did not import any computer hardware, but paid 5,50,000 on 24th July for advertising. NICE Limited neither deducted tax nor equalization levy. Now what has to be done? So NICE Limited is an Indian company. Trio Inc. is a foreign company. That foreign company is providing us some what? That online advertisement. We are making the payment for that online advertisement of 5,50,000, which is more than 1 lakh. Therefore, NICE Limited is liable to deduct equalization levy at the rate of 6%. 6% of 5,50,000 will come to 33,000 rupees. So they have to deduct how much? 33,000 and penalty of 33,000 for non-deduction. Okay. So if they don't deduct, then there will be a penalty of how much? 33,000 rupees in the hands of NICE Limited. I hope it is clear to all of you. Now, are NICE and Xylo associated enterprise? Let's see whether NICE and Xylo are associated enterprise. Now, NICE Limited has advanced a loan of 2.5 crore to Xylo. Now, as on the date of the loan, the book value of the assets of the Xylo is 4.52 crore. Now, if I do 2.5 crore is the loan and the book value of the assets of the other company was 4.52 crore. So it is greater than 51%. Okay. Now, because of this reason, both of them are associate enterprise. Now, one more reason they are giving us. Out of 10 directors of Xylo, 5 are appointed by NICE Limited. So is this the reason because of which they are associate enterprise? No. This cannot be the reason because of which they are associate enterprise. Yes, because of directors, there can be a relationship of associate enterprise, but only if you appoint more than half of the directors. 5 out of 10 is not more than half. It is exactly half. If there would have been 6 directors out of 10, then this could have also been the reason. Third, Xylo repaid the entire loan. That doesn't matter. Whether Xylo has repaid the loan, it doesn't matter. At any time during the previous year, if it is 51%, if the loan given by one entity is 51% of the book value of the assets of the other entity, then both of them are deemed to be associate enterprise. Later on, whether it is repaid or not, it is of no use. So this is the reason because of which both of them are associate enterprise. So answer is A. Yes, since loan advanced by NICE Limited to Xylo is not less than 51% of the book value of total assets of Xylo, therefore both of them are deemed to be associate enterprise. Okay, I hope it is clear. Third one, compute the amount of long-term capital gains arising to Trio on transfer of listed shares of XYZ Limited. What would be the tax treatment of such capital gains under the Income Tax Act? So now, Trio is selling some shares of Indian company. Let's come here. Trio is selling 3,500 shares on 9th of November 2024. Held by it in an Indian company for 102 rupees. So it's a classic case of 112A. Why? Because it's a listed shares. And as you can see in the question also, the STT is paid on purchase and sale both. And they have also given the fair market value on 31st Jan 2018. Therefore, it's a classic case of what? 112A. Now, in case of 112A, how do you compute the capital gains? What is the full value of consideration? The full value of consideration is 102 rupees. How do you determine the cost of acquisition? I am finding the capital gains for one share first of all. Then I will multiply by 3,500 shares. I will get the total capital gains. Now, cost of acquisition, how will you determine? Step number 1, actual cost. What is the actual cost of the shares? These were bought for 36.4 rupees. Actual cost is 36.4. See on the board. Second, then you have to compare this lower of the FMV on 31st Jan 2018, that is 90. Compare with the sale consideration. The sale consideration is 102. Whichever is lower will be your step number 2. So lower is 90. And then step number 2 and 1, whichever is higher, that will become your cost. Therefore, the cost is 90. Therefore, my capital gains is 12. Okay, I hope it is clear to all. This is grandfathering. You have to apply grandfathering. There is nothing to teach in this. So 12 is the capital gains for one share into 3,500. That will make how much? That will make 42,000 rupees is the capital gains. Therefore, the capital gains is 42,000, but the tax will be 0. Why? Because up to 1,25,000 rupees it is exempt. Yes or no? Check it please. So therefore, 42,000 will be the capital gains. However, it will not be subject to any tax because the assessee will get exemption of 1,25,000 rupees. I hope it is clear to all of you. Okay. Now, last but not least, question number 4, the last MCQ of our MCQ booklet, and my commitment is over here with respect to MCQ which I have made to you. Last question. Which of the following statements are correct in relation to remedies available to NICE Limited under the Income Tax Act? If it is not satisfied with the draft order passed by the AO, C. NICE Limited is subject to transfer pricing. So in case of transfer pricing assessee, what the AO does, AO makes a plus NICE Limited. In case of transfer pricing assessee, the AO makes a draft order first and gives an option to the assessee. Then the assessee has an option to accept that draft order or to object that draft order and go to dispute resolution panel. So here assessee has two options. Either assessee can object and go to DRP, or assessee can accept that, let the AO pass the order and then go and file an appeal to CIT appeal. Both the options are available with the assessee. Therefore, the assessee can object to DRP against the draft order, or it can wait, let the officer pass the final order and file an appeal to CIT appeal against the final assessment order. And therefore, the answer to this question is either A or B. You can follow either A or B. Either of the two remedies are available with you. Okay. So this is what this case scenario MCQ is all about. I hope you all have enjoyed this.